Good morning, everybody. Let's see, we are Tuesday and we are having an interesting opening morning already. As I was preparing this, the markets went live and GameStop was not looking healthy at all. It ended the day yesterday at 210 after taking a really bad dive late in the day and then kept going down overnight and into the early morning, hitting 186 as a low. And then let me zoom in a little bit here down in the corner. And then this morning, right after the market opened, it spiked up to 212. And then now it's right back on its way back down to 201 and dropping. So there's the zoomed in one. So very, very interesting and not necessarily fun start to the day for GameStop. It might be, I'm not saying I hope it is, but it might be the end of the road for this last surge that's been going on for the past week with GameStop and AMC and some of these other exciting stocks. So doesn't mean we're selling now. We've got the diamond hands, boys. You know, we are hanging on to these. There's no reason not to at this point. Um, Especially things like AMC and Express, they haven't met their full potential yet. They still have a lot of ground to make up. So I could see still AMC, even if they have a bad day or just a bad morning this morning, still just taking off later in the afternoon. You'll see I do have this limit order of 14.99 right here. This morning, pre-market, super early in the morning at 3:15 in the morning, hit 1488, so it's very close to that sell order. It was looking good early pre-market, and then it just went downhill since. Opened right at about 13.5, and now it's down to 13.14. I wouldn't say actually 13.07. I wouldn't say that it's in a very, very bad place right now, but it's not looking great. GameStop continues to drop heavily. It's down 15% already on the session, and it's only been 10 minutes. AMC down nearly 8%, cost down 9%, Express down 7.5%. So it is not looking great for these stocks this morning already. Again, though, we're only 10 minutes in, but just after what happened late yesterday afternoon, um, well, I guess I should say the last 10, 15 minutes of the market actually were looking pretty good for some of these stocks. But the 2 or 3 hours before that in the afternoon yesterday, really ever since it all started when I talked about this a lot yesterday, it all started when the guy from Ava got online on CNBC and started talking about their stock, which I'm actually excited about their stock, but it surged people away from GameStop and AMC and some of those. So you saw the situation where people were selling off their GameStop and just putting their money in AVA just because the guy was on CNBC and talking really good game, boosting his stock. Ever since then, and after that, you know, AVA went down, GameStop went back up, but ever since then, it never fully recovered to what it was before that CNBC interview, which was at like 10 something, 10:15 yesterday morning. And we're just seeing it just not at all recover completely. Looks like GameStop's getting a little bit of a floor, not quite exactly. I mean, it's hard to tell. Express is wanting to level out, so that's good news. If Express can turn back around, that would be fantastic. GameStop, it's a tough one whether that's really going to level out there at 187 or so and come back up or not. AMC now at 1267, making a slight turn, but nothing great. We look at the TQQQ, the triple leveraged ETF that tracks the Nasdaq, and it is up. What is it? Up 2.5%. So right now, early morning, right out of the gates, we got the Nasdaq and the S&P are positive. The Dow is just barely negative, but I would not say any of those are so far positive or negative that they're going to influence the rest of the day. Those things could change very quickly. If you guys weren't tracking Bitcoin, also overnight Bitcoin I wouldn't say it crashed. Don't go crazy there, but it did go down pretty significantly. It went down probably 11, 12% from its high on Sunday. So down into the 54s, or sorry, 54s, or actually 53, just barely 53.6, 53.5 or something was its low. Late, I would say, late last night, early middle of the night kind of a time frame. And now it's back up to 55.6. So coming off of its high last week of 61. I was talking about this a little bit yesterday that I said I wouldn't be surprised if it dips down to 50 if that follows the pattern of the last two surges and dips, the one in January and the one in February. This one's coming earlier in March than the last two did. Well, not necessarily. The one in January came really early too. So January, the peak was on January 8th. February, the peak was on February 21st. And March, the peak was on March 13th. So there's nothing really rhyme or reason about it, but seems like there's a peak um, mid-month at some point, and then it goes down about 25% both times. So if that goes down 25% from 60, then let's see, 60 times 0.75, that'd be 45. So I don't know if it'll back off all the way to 45. If it backs off just 20%, then that's what 61 times 0.8 is 48.8. So I think if it dips down to 50, it's a good opportunity to get in if you have some money to get in. Again, that's just my plan, not necessarily advice for you, but that would be my plan. I think it'd be good to dip a little bit more in when it gets down closer to 50. If it never gets down to 50 and you just miss that dip, not a big deal. I don't think it's a big deal because I still am not completely convinced that there's not a bear market coming on Bitcoin. There are a lot of other people that are way smarter than me that are saying that we're just at the beginning of this current surge. This current surge, they're saying, could get up to $200,000. I don't know if I completely believe that. Not that I don't want to believe it, I just don't know if I believe it because that would be just almost too incredible of a surge. It's already become too incredible of a surge. In the last year, it's up 1,000%. To say it's going to go up another 400% of what it currently is, yeah, that would be insane. That'd be what 20,000% increase if I'm doing my quick math correctly for people that bought it a year ago. So I don't necessarily see that happening this go round. However, I am becoming more and more convinced that Bitcoin is a legitimate store of value for the future and going through its cycle. So I just need to learn more about it and time it right. But I am putting now an allocation into buying the dips in Bitcoin. It's not much, but a little bit myself. That's my personal strategy. Going down, see what else we have that's on our watch list. Rocket's up slightly. Roblox is up slightly. ARC is up slightly. Riot Blockchain is down quite a bit. That doesn't surprise me with the recent dip in Bitcoin. It doesn't necessarily track the market, but it has the sentiment of the market. So if Bitcoin or the other cryptocurrencies are going down, it could very well easily go down as well. Riot crashed earlier in the month. It was at $35, $34 a share just on March 5th. And now it's back up to 57, just a week and a half, really a week after that happened, it was already nearly double in price. So, Riot's one of those where it's similar to the price of Bitcoin in its recent surge over the past year. Actually, it's a greater surge percentage-wise. Let's see, AMC down 10%, Express down 10%, GameStop down 20%, Churchill Capital up 8%, and I believe I may have missed the boat getting in around $22, $23 a share. It might be on its way to taking off. I don't know if that's permanent. I mean, we saw it with Neo. It took off and then it tanked. So I don't know if it's completely past any tanking period, but we'll see. I do think there's a lot of opportunity with Lucid and Churchill. If Lucid finally actually releases a real car and really has some production on it, I think it's got a chance to really take off that stock quite a bit. It's compared to Tesla, for example, it's ridiculously undervalued. However, a lot of people are saying that it is way overvalued based on just the fact that it's never produced a car. I mean, CCIV itself has a market cap of $8 billion and it's never built a car. Ford, for example, who's built millions of cars over 100 years, is only $51 billion. So that's tough. Tesla, for example, is $675 billion in market share. It's just absolutely bananas. Anyway, let's click on the news. They are way smarter at this stuff than I am, and we will see what they have to say.
Coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
"24/7 access to diverse global markets. Right here."
That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready.
Well played.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Jenny Horn. Here's a few of this morning's movers to keep on your radar. Shares of Jabil surged after reporting second quarter profit and revenue that beat expectations. The contract manufacturer said this was due to broad market strength, a more favorable product mix, and excellent operational execution. For 2021, the company raised its revenue outlook to $28.5 billion from $27.5 billion, with its core earnings guidance raised to about $5 a share. Jabil has risen over 125% in the last 12 months. Macy's is lower after reporting early results from its previously announced tender offer. Macy's subsidiary, Macy's Retail Holdings LLC, commenced a cash tender offer to purchase up to $500 million in aggregate principal amount, or the maximum offer amount. The terms and conditions of the agreement were listed in an offer to purchase release back on March 2nd. And DraftKings is higher after placing a $1.1 billion private offering. This offering will be available to institutional buyers with the convertible senior notes due in 2028. DraftKings granted initial purchasers a 13-day option to buy an additional $165 million worth of notes. Net proceeds are expected to be just over $1 billion, and the sale is expected to close on March 18th. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. Let's talk some stock picks and trade. Joining us from Plum Funds is Mr. Tom Plum. He's the Chief Investment Officer. Tom, welcome back to the show. Let's start off by talking a little MasterCard and the connection to consumers spending, a stimulus check, and also savings that have built up. Walk me through the case here for MasterCard as opposed to, say, a Visa or an American Express.
Hey, Oliver, it's great to be back again.
Thank you.
But when we've looked at this market that we've seen a little bit of a pause between some of the great growth stocks from last year, which really were secular trends and a lot of digital wallet, to more cyclical growth companies this year. And what we talked about is the melding of the two, and MasterCard is basically the poster card for doing that, because when you look at it, they're going to benefit from resurgent or recovery in travel and entertainment expense from businesses, from individuals, from hospitality having some comeback, from cross-border, and just general business activity. And when we think of that with a company that historically, even last year, with a 10% decline in revenues, was able to maintain a 42% after-tax profit margin. We look at what's going to happen this year with revenue growth, and we think we got a company that's going to grow over 25% a year, possibly for the next couple of years.
Wow. So there's something in addition here to the overall economic recovery, right? It seems like there is a kind of market share, both expansion and maybe a little bit of market share take on behalf of MasterCard versus competitors?
Well, all of them will do pretty well. I mean, but what you have seen is a huge change that we don't think is going to reverse to contactless payments, to more and more buying things online, to business being more efficient and looking at how you can instantaneously transfer cash. And MasterCard is one of the leaders, has great intellectual property, has a lot of initiatives in the crypto aspect of the market. So we think it's going to be one of the best beneficiaries of all these changes.
I was also just about to ask there about the crypto side of it. Is any of that benefit of the contactless payments being usurped from the traditional credit card companies by the crypto community, or does ultimately that money still find its way back into the forms that are accepted commercially, which of course is still for the large part traditional cash and the credit around it?
Right. I mean, much of the world is still cash payments, and we're seeing that expand around the world, in the United States especially, but also in South America, Africa, where historically they've been cash payments, and now they're moving to digital, using their phone, using things like MasterCard to back up any type of electronic wallet or digital wallet. Whether or not, something like Bitcoin, your previous guest, why would you use a Bitcoin if you thought it was going to appreciate in value to buy a cup of Starbucks coffee that you were going to consume and it was going to disappear? The crypto technology is really valid, and companies like MasterCard are incorporating it for security, for transfer of assets or transfer of money around the world. And we expect them to continue to use that technology because it is really pretty valid.
Tom, stick with us. We're going to do some trading here. I want to hear another pick of yours, but we're going to look at MasterCard first. Let's go to Tom Wyatt, who's standing by. Okay, Tom, so the bullish case for MasterCard there, and winning even in the face of some of the crypto adoption. The stock sitting at $382 right now, just below the highs that we made a few sessions ago. Walk us through the case you see for how to trade this higher.
Well, I think there's a bunch of different option strategies you can pick to get that bullish tint on it, whether it's selling cash secured puts that are out of the money to the downside, selling put verticals. But the strategy that I looked at was a little bit different with a better risk reward ratio if you think it's going to creep back up to that 400 level over the next maybe 3 weeks or so. So I looked out to the April 9th weekly series. So you're giving yourself about 24 days until expiration. And I'm going to buy it an unbalanced butterfly here for a debit. And the debit that you take in on this, which is about $4.30, it might be a little bit higher. The stock has reversed into the positive now. But if I buy the 380, 395, 400 skewed call butterfly to the upside and pay roughly about a $4.30 debit, $4.30 per spread, $430 is my risk on this type of strategy, where the apex of profitability is up at $3.95. Now, they report earnings after April monthly expiration, so if you expect MasterCard to kind of grind higher, this might be the strategy because with that apex of the profitability at $3.95, you can more than double what your potential risk is on this type of trade. You've got, because you're skewing it a little bit between the strikes on the butterfly, you're also, you don't have any upside risk. Everything is profit above that break even, and in this case, it's $384.30 to the upside. Even if you pay a little bit more, maybe $5 debit or something like that, you're going to have a break even about $385. And you can see from the risk profile there, you do not have any risk below that at expiration on this type of strategy. So it takes advantage of a grind higher with the expectation that it's not going to maybe explode. But even if it does, you're still going to double your money if it goes above 400. before expiration in 24 days.
Okay, so looking to get exposure to quite a bit upside here in MasterCard before this thing starts to peak out in profit. So able to capture a breakout if we can get past the previous highs from the last week. Tom, we're going to come back to you in a sec. We got one more from Tom Plum. Tom, walk us through Copart, because we've heard a lot about the auto pickup and the demand for vehicles during the quarantine period. But what about repurposing and crunching them into pieces and selling them? Isn't that what Copart does?
That's a big part of their business. They repurpose, they basically salvage, they sell cars that can be fixed, cars that can be taken apart, cars that end up being scrapped. But it's through an online auction system. They basically have 175,000 cars available every single day in the United States. And dealers in this area, basically, they're the leader. They go to Copart. More driving, more buying of cars, more using and repurchasing cars, more accidents, more salvage. So we expect a lot of the things that will drive this company forward to be there in 2021. And we're actually expecting that as the economy goes up, more people are going to be driving, and there's going to be more accidents, and there's going to be more maintenance, and there's more need for companies like Copart.
Okay, stock's slowing down a little bit, but has been a big winner here over the past year. Tom, good to catch up. Thanks for the picks. We're going to trade some Copart now. Thank you, Tom Plum, Chief Investment Officer, Plum Funds. Hey, Tom White. Okay, hit us with the CPRT trade.
Yeah, a little bit more aggressive here on this one. If you think about it, Copart's down about 13% year to date, so it's definitely underperformed. And if we definitely see a pickup in their business, as Tom, commented on, then you can expect the stock to go up. But what I wanted to give myself on an options example here, this type of strategy, is give myself some duration, some time for this thing to recover. Even if it gets back to unchanged on the year, you're going to do well on a trade like this. And I went out to the May option series, so you've got about 66 days until expiration, just over 2 months, and that's giving me that duration where I'm going to buy that at-the-money call, the 110 strike call in May. Then against it, to reduce my cost on this particular trade, I'll sell the 125 strike call, creating this bullish $15 wide call vertical to the upside. Now, if I pay roughly about a $5.10 debit, that's going to be my entire risk on it. And you can see from the risk profile there, break even 115.10 to the upside. So you only need to move about $5 higher over the next 2 months to get to that break even point. Now, by paying $5.10 on a $15 wide, I've got nearly $10 wide, $10 in profit on this type of trade. So the risk profile sets up well for a rebound in Copart, where you're risking over only one to make a double on this type of trade. So this might be the way to play it if you expect Copart to continue to move or reverse those losses that we've seen and continue to move higher. You got to think this stock's traded over 130 just a couple months ago. So if it gets back to those levels, this would be a nice trade to have in your pocket, and you're defining your risk on this type of strategy.
Okay, Tom, thanks. 2 different ways to get bullish exposure: MasterCard and Copart. Thanks, Tom, our contributor here on the network. When we come back, we're in hour 2 of the show. We've got a big, important check-in on earnings coming up this afternoon for a sector that has run wild during the quarantine work-from-home period. That's cybersecurity. CrowdStrike will give us an update as the stock has lost some of its momentum the last 2 months. Will this number be enough for it to break the $200 level in either direction? The place CrowdStrike has traded at many occasions this year. We'll be right back to preview the earnings.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/educationday.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Welcome back to Morning Trade Live. We're in hour two of the show. The NASDAQ is on the run this morning, breaking away day two in a little reversal from recent leadership. The Russell behind after slipping at the open. Economic data this morning didn't help so much the story for recovery that drives those small caps as we missed on retail sales, missed on industrial production. We'll take a look at some other economic data points. We're going to trade CrowdStrike ahead of its earnings. Stock's been sitting at $200, an area that in the past has been support. Will that be the case this time around? We're going to check out options trades and looking at volatility as the VIX trades today under 19. Right now, 19.57. Whoa. We're talking post-COVID lows, perhaps, if we can use that term now that it is no longer the top fear of fund managers surveyed by Bank of America who are more fearing inflation. So we'll discuss the changing sentiment here as we continue our emergence from the regimes of the last year. Chartmaster has a few takes for us on the technicals after analyst upgrades and downgrades. Right now, let's talk about some data. Let's look at the overall market as we've got equities mixed and flipped from our usual dynamics lately. Ben, that means that today we actually have strength in the NASDAQ as opposed to the Russell. Maybe some of the weaker data this morning playing a role there, but we got a few other numbers here. Let's start with the housing market index. What are we looking at for a very reliable part of this recovery?
Looks like we're about 30 minutes in the day, and we are not seeing as bad a day as it seemed at first. We've seen a little bit of a recovery from GameStop, AMC, and Express. Nothing too significant, obviously. At least they're not crashing as bad as they were. But GameStop still down 15% after a negative day yesterday. And look, Express actually taking a dive here just in the last 3 minutes. Down to 459. Cost trying to make a little bit of a recovery, assuming the cost just a little bit. We'll get the it's not crashing anymore, but it's not doing great. It's kind of following a similar line to AMC, where it went down, then it's bounced, and then now it's just going sideways for a while. So keep an eye on that. You look at the rest of the market, NASDAQ seems to be going up. See what we got up here. S&P's up, NASDAQ's up somewhat significantly, and Dow is slightly down. Russell's slightly down as well. So T triple Q is going to keep going as long as the NASDAQ's flying. So that thing is good up 3.5%. That's a big one. But looking at these stocks, we're not seeing too much greatness happening today, but at least we're not seeing it crash as greatly as we saw after GameStop opened. So hopefully that means that we'll find a little bit of a bottom and then turn back around. That would be amazing if we can turn these around and head north.
Again, I think with the Fed and all the focus here on the indices and the new all-time highs, I think that
forecast 7% now. The cause of all these changes? Well, mostly the 1.9 trillion in new relief ushered in by the Biden administration. We asked our respondents to gauge the impact, estimated to add about 2% to GDP growth this year and about 0.5 point to inflation, and it lops 0.5 point off of the unemployment rate. All of this comes with a belief the Fed will likely begin this year to reduce its asset purchases and hike rates in late 2022. There are forecasts that are ahead of where the Fed seems to be, so that could be a bit of a tension being set up between the markets and the Fed. Back to you guys.
Steve, really quick, I wanted to get your take on this op-ed by former Vice Chair Blinder in the Journal today. He says he's guessing, but he says the Fed will be perfectly copacetic with inflation rates as high as 2.5, maybe even higher for 2 to 4 quarters, that it's really a 3 handle that would make them nervous. How much street cred do we give him for that?
I think Alan probably has a very good idea of what the Fed is thinking. He's been there. He knows those guys. Look, this is a very new regime we're under, not anything I've seen in the last 20 years of covering the Fed. The Fed indeed is aiming for higher inflation. You got to take them at their word. Jay Powell's a man of his word. He says he's aiming for inflation above 2% for a while. I think that's what he's aiming for. And we'll see really if the market and the body politic allows him to abide that higher inflation number.
Steve, when you keep referring to GDP above 6%, what I think, some at 6.5, whatever it may be, I just wonder, does that create its own new dynamic of growth? I guess that might be reflected in the more than 4% GDP outlook for 2022, but in a way, is it uncharted territory given it's been so long since we've ever seen a number that high?
It is uncharted territory, and it can, David, create its own growth dynamic if the people doing the business and the investment believe it will be sustained. What you don't want to do, David, is go out and build a factory or open a store because you have temporary stimulus there. If you think that those numbers are going to be sustained, then you might expand as a result. It's one of the problems of temporary stimulus. It's hard for businesses to make a call on whether they ought to invest behind it.
That is a good place for us to start the conversation with our next guest, Steve Leisman. Thank you. With President Biden's stimulus package finally passed, the White House is turning its attention to infrastructure, among other things. Our next guest calling this, quote, a moment to invest boldly in a future that is more sustainable and equitable. Barbara Humpton, CEO of Siemens USA, joins us now. Barbara, great to have you on.
Morgan, it's great to be here.
Okay, I do want to talk infrastructure and specifically this letter you penned, this open letter. But first, and we just heard housing data. We heard about air travel starting to come back. Economic growth forecasts for the year looking stronger than initially expected. Given the fact that you have so many customers across so many industries here in the U.S., what are you seeing in terms of the manifestation of that recovery, especially given the fact that it was really the industrial and manufacturing part of the economy that sort of started that recovery in the first place?
Well, that's right. You know that throughout the pandemic, Siemens has really been on the front line helping our customers respond to both response and recovery. And so we were doing everything from helping data centers expand to meet the demands of this digital transformation we're in, to helping manufacturers as they ramped up production of PPE, pharmaceuticals, and medical devices. And of course, we've been very involved in developing tests and tools that will help the nation respond to coronavirus. And so what we've seen is that this has been a moment that, of course, we've been disrupted by the pandemic, but we were already on a path of digital transformation. And of course, we've seen these transformations actually speed up, a compressed transformation, if you will, throughout the coronavirus pandemic. So here we are helping a nation deal with the next phase, which is reinvention. We have this brilliant moment ahead of us to take advantage of all we've learned throughout the pandemic and actually build forward, build back better. And we're seeing the opportunity to do that not only through technologies to open up schools safely, and that same technology can be used for buildings, but also to help ensure the continued health and safety of our manufacturing workforces and perhaps even the transformation of rail infrastructure.
Yeah, I want to get into all of that. First, though, I mean, just given this conversation we were having with Steve, if we see 6% plus GDP growth this year, especially on the back of trillions of dollars in stimulus plans, is that something that would incentivize Siemens USA to make more investments right now?
Well, we are indeed deeply invested in the U.S. We've made over $40 billion of investment over the last 15 years. We've been here over 160, and we see the future as being very strong. So yes, we believe that some of the growth trends that will come are going to naturally lead to our growth here in the U.S.
From an increase in significant infrastructure spending. I just wonder whether or not you have a sense as to whether that really is possible, given the split we see in Congress. The last bill obviously went through reconciliation. No Republicans support it. Do you have any sense at all in terms of the political will to actually get something through a Senate where it could require 60 votes?
Well, we've always seen that infrastructure is one of the most bipartisan topics we have on Capitol Hill. And we also know that there's never been a more powerful moment to invest in infrastructure. You see, at a moment when we are making decisions about how to invest, how to spur the economy, how to ensure we get back to pre-COVID conditions and perhaps grow stronger, what we're seeing is that investment in infrastructure, according to United for Infrastructure, $1 invested would yield close to $4 worth of economic growth. So there's no better place to invest. So we're confident that all of the motivators and drivers are aligned, and that in this moment we have the chance to consider topics that are really vital to so many legislators: equality and sustainability, making sure that we're dealing with resilience, the reliability of our grid, of our transportation systems. Again, a powerful moment for investment in infrastructure.
Which again, I think speaks to this digitization of everything that we're seeing and the acceleration of that trend that the pandemic has basically triggered here. In terms of if we do get an infrastructure deal, how does that position Siemens, whether it is through some of those technologies that you offer to companies and governments, or whether it's through some of these products that the pandemic has made look even more attractive?
Yeah, you know, Siemens is unknown to so many people, but what's powerful about Siemens is that we have technology in the backbone of the industries and the infrastructure that support this economy. So everything from manufacturing to buildings to the connection of the grid in decentralized grids, et cetera, these are all powerful technologies that are going to be helping us in these coming months. And one of the reasons that I penned my open letter was to help raise our hand and demonstrate the kind of capabilities we know exist today that can be brought to the table.
The idea of a digital twin, I'm just going to nerd out here for a second, but the idea of a digital twin, which you also propose in this letter, that not just having a national stockpile of emergency items, of actual physical goods, but to have a stockpile of digital ones. What would it take for the government to do that? And given the fact that we're in the midst of all of these state-sponsored hacks, how do you keep it safe?
Mm-hmm. No, we are actually today in possession of tools that will help us drive this vision. Secure tools for manufacturing that allow us to capture the intellectual property of makers everywhere. We're talking about the digital instantiation of a physical object. And think of the Mars rover, right? The rover that just landed had actually been designed, developed with the help of Siemens digital twin technology. So we could simulate how will it perform. And you saw how brilliantly it performed, not only this one, but prior rovers as well. That same technology can come to manufacturers today so they can capture the digital twin of a product that they have contemplated. Even if there's not demand for that product in the moment, by capturing the digital twin, we assure ourselves that if there's ever a need to go to scale, to produce in mass, we can then distribute that digital twin, protecting the IP of the maker, and actually produce at scale to meet the need of the nation.
Yeah, which could, of course, have huge implications when you're talking about things like supply chain disruptions and companies pushing for more onshoring, nearshoring of those supply chains as well. Barbara, we have to leave the conversation there, but great to see you. Thanks for joining us. Barbara Humpton.
Wonderful to be with you. Thanks, Morgan.
When we come back, more from my exclusive interview with the chairman of OxyContin maker Purdue Pharma. And later, Robinhood rival eToro. It's going public in a $10 billion SPAC deal. We're going to speak with the CEO and with the deal maker behind it, Betsy Cohen, who is taking the company public through one of her SPACs. Squawk on the Street is right back. Don't go anywhere. Purdue Pharma, of course, a company behind much of the opioid crisis in this country, one of many, filing a Chapter 11 plan of reorganization this morning, related disclosure statements with the U.S. Bankruptcy Court for the Southern District of New York. The result of the plan that has been submitted would be basically a vast majority of $10 billion in proceeds would be used by states to abate the opioid crisis. And they can't be diverted, these funds, for other purposes. Nonetheless, there is still some potential opposition to this in the form of some state AGs. I'll reference a joint statement from many of them who simply say it's still not enough. Not enough from the Sackler family, not enough in general. We're disappointed in this plan. While it contains improvements over the plan that Purdue announced in September 19, it falls short of the accountability families and survivors deserve. And so it does leave the possibility that creditors, so to speak, could still move against this potential settlement. I did have a chance to sit down with Chairman of Purdue, Steve Miller, and asked him why this is the deal they should take.
The reason that we are proceeding with the plan of record is, A, we have the support of the majority of the creditor groups because they understand that is what will best create value rather than trying to do a fire sale of the assets at this moment in time. Nonetheless, the plan calls for reviews of that long-term. The possibility is that the company might get sold. But in the near term, this is the best way to create value to go to the victims of the opioid abuse problem.
Yeah. And the Sackler's family's role here. Originally, and I remember when you and I spoke 18 months ago, I guess, early on when you took over this not enviable task. They were at $3 billion originally. They're now at I think it's $4.5 billion. $225 million of that is going to the DOJ, but a $4.5 billion overall contribution from the family. What do you say to those who say that's simply still not enough?
Well, this has been a lengthy debate over the last 18 months. And yes, the Sacklers moved from their initial $3 billion offer to what is now $4.5 billion. And the question is, how much longer do you want to keep debating it? Or is now the time to take the money and use it for a valid purpose, as opposed to continuing to have this legal battle?
Unfortunately, Steve, as you well know, 2020 was a very bad year for opioid overdoses. I think some 80,000 people, broadly speaking, but much of that from synthetic opioids. It continues to be a terrible, terrible problem for our country, doesn't it?
Yes, but whether or not there's OxyContin, the illicit heroin and fentanyl problem is now the headline problem for America to deal with going forward. Our plan is to continue to provide opioid abatement answers, and this $10 billion should go a long way to helping the public health.
We want it to be very different from the, of course, famous settlement with the tobacco companies, Morgan, only 3% of which they say actually went towards tobacco cessation and things of that nature.
Yeah, we're going to see how all of this goes. I mean, David, you've been all over this, and it comes, of course, in the midst of Arkansas also suing Walgreens over the opioid crisis. I mean, we could talk about all the finger pointing, all the lawsuits, the shakeout that we're seeing in the midst of this other pandemic, right? The opioid pandemic. I mean, I was just looking at the stat for Arkansas specifically in 2019, second highest opioid dispensing of any state. 80.9 prescriptions for every 100 persons. That's higher than the national average. Here's the national average. 46.7 out of every 100 persons. Let that number sink in for a second. How many people are getting painkiller or have been getting painkiller prescriptions, using other, as he just noted, illicit drugs as well? We can talk about following the science in the pandemic. The other piece of the science in this pandemic is the fact that you have seen drug abuse, overdose, alcoholism, suicide rates all climbing as well, with people being locked in and being curtailed socially. So I have a feeling we're going to be talking about this a lot more for a long time to come, David.
Yeah, I mean, as the pandemic thankfully recedes, we may be refocused on this because, again, as you say, and as I pointed out during the interview, I think it was 80,000 deaths to overdoses last year. Now, that includes a lot of different drugs, but the main culprit is fentanyl. Heroin, things of that nature. They're still making OxyContin, by the way, and it still does have...
There's still a place for it.
Yeah, I mean, there is still, exactly. There is, unfortunately, a lot of people suffer injuries in which it is very, very helpful, Carl, to be able to have this drug available. The company, under this plan, would be put into a public trust in which the proceeds from its sales would continue to go towards these abatement efforts. But again, that is something that seems to have at least aroused some opposition from some of these state AGs. So, Carl, we'll continue to follow this story, an important one for the country, of course.
Yeah, and as a side note, David, you do mention tobacco use. City's got an interesting note out today in which they essentially guess that the cigarette smoking in general could go to zero in this country by 2050 as a side narrative, and they downgrade MO as a result. When we come back, a Robinhood competitor, eToro, going public in a $10 billion SPAC deal. We're going to talk to the CEO in a moment.
Welcome back. It is now time for our ETF Spotlight. We're taking a look at the Tech Spider ETF, ticker XLK. It's rising this morning, up more than 1%, up more than 80% from a year ago. The group's biggest holding, Apple, getting a price increase over at Evercore to a street high of $175. That stock more than doubling over the past 12 months. It's still negative year to date. It's higher this morning. The analyst behind the call will join the gang next hour on Squawk Alley. We're going to take a quick break. Stay with us. Welcome back. I'm Rahel Solomon, and here's your CNBC COVID update at this hour. Moderna is starting a study in which babies as young as 6 months will get its COVID vaccine. Right now, the Moderna vaccine is only authorized for adults, but children make up a quarter of the population, so getting them vaccinated would help the country achieve herd immunity. European drug regulators say that they are firmly convinced the benefits of the AstraZeneca vaccine outweigh the risks. They are, again, strongly urging countries to keep vaccinations going, even as its experts investigate blood clots in a small number of people after they were vaccinated. A report is expected on Thursday. France, Germany, and Italy, however, are among those European nations that have suspended the shot. After initially pausing AstraZeneca vaccinations, Thailand is again administering the shot, with the country's prime minister getting his on camera to show his confidence in the vaccine. And as shipments arrive in Australia, that country says it will keep vaccinating.
And in any large vaccine rollout, we do expect to see unusual events, and we monitor very closely and carefully for those. But this does not mean that an event that happens after vaccination has been given is indeed due to that vaccine.
So clearly, a lot of questions remain. David, I'll send it back to you.
Okay, well, thank you. Betsy Cohen backed SPAC FinTech 5 announcing a $10 billion deal. It's taking what is a Robinhood competitor, eToro, public this morning. And you can see getting quite a positive reception from holders in FinTech Acquisition Corp 5. Joining us now is Betsy Cohen, chairman of FinTech 5, renowned SPAC investor, along with Yoni Assia. Gentlemen and ladies, thank you both for being with us this morning. Betsy, I want to just start with you on the deal itself, if I can, before we get to Yoni and talking about the business model. It wasn't that long ago that at least press reports had this company being valued at roughly $5 billion in a potential traditional initial public offering. Why in such a short time did its value go from $5 to $10 billion?
I think it's the kind of growth that viral growth that you see among companies of this sort. This is a year in which eToro added 5 million new registrants to its list, topping 20 million altogether, which is a significant increase and shows the acceleration of growth and acceptance of the product in the marketplace. As you've seen with other companies like Robinhood and Stripe and some of the others, valuations can grow quickly because the businesses are growing quickly.
Yeah, and Yoni, you are growing quickly. In your slide deck here, I'm looking at 1.2 million funded accounts, about 605 million of revenue last year. Give me some projections here, given that the projection based on your value is about 9.7 times 22 revenues. So what are you expecting in terms of funded accounts and overall numbers?
Sure. So first of all, last year was an amazing year for us. We grew 147% year-over-year revenues to over $600 million in revenues. And we started 2021 with a perfect storm, both a crypto rally, markets in all-time high, and a significant increase in customer demand worldwide, both for crypto, commission-free stocks, and obviously for a very unique patent technology of combining a social network together with a trading platform, enabling our users to invest and to automatically copy top traders from all around the world. We are projecting to reach over $1 billion revenues in 2021 and over $2.5 billion in revenues in 2025. And to see the growth of the number of funded accounts grow about 90+% in 2021 versus 2020, and grow over 5 times by 2025.
All right, those are impressive potential numbers, obviously pointing to what is a very impressive valuation. Now, you operate largely in Europe and Asia Pacific. I mean, that is by far the bulk of where your business is. Is there an opportunity for you to move into the Americas, or are you going to continue to focus on those geographical areas for your platform?
We're definitely moving into the Americas. We've launched our crypto trading platform in the US in 2019. We've recently seen triple-digit growth.
Here we go, guys. We might have the same situation that happened yesterday, where they are talking to another founder of a SPAC company, and if we see GameStop and AMC these all of a sudden start turning down and tank, while there's over here FTCV, sorry, and it looks like they've had a pretty good day so far. You know what? They haven't. If this does the same crap that happened yesterday, what is it? FTCV. FTCV. Oh, and I want to buy 50 shares at market. I'm just going to do it. I'm going to buy 50 shares of FTCV and see what happens. If it does the same thing yesterday that yesterday's did, oh man, I might have missed the boat here. Let's see, cancel replace order.
And I noticed as well in these footnotes you forfeited 1.28 million SPAC sponsor shares.
There it goes. All right. It looks like it took my first order. Yeah, 1269. Boom, there you go. Okay, so I'm going to take that one. That was a 50 shares at 1268. That was what, 600 something bucks.
Leads to better price discovery, but we also realize that it is very much in focus right now, given everything that's going on with Robinhood. How are you thinking about it as you expand into this market?
And we'll see what happens. So let's watch this interview. It's probably going to be a 5-minute interview. And we'll see, will FTCV go up, which is basically eToro looks like, and GameStop and AMC at least go down as it goes up. That is exactly what happened yesterday, and let's see if that happens again. I would be fascinated if that happens again. And if it does, I'm gonna sell the crap out of my FTCV shares that I just bought when it spikes up to like 16 or 17. I should probably just put in that sell order now. FTCV trade 50, and I'll put it at 16.99. So there, if that takes, I put it right there. If that takes, that would be what, 250 something dollars, $300. 16, I'm doing terrible math in my head right now. 16.99 minus, what did I end up buying? Filled at 12.69, $4.03 times 50 shares, 250 bucks. So I'm gonna try to make an extra quick 215 shares. Right now I'm up $9, so I'm making $9 on my trade that I just put. See what happens. But you know what? Surprisingly, these others are still going up. So they're not, people aren't going to go dump their shares and put them over into eToro right now just because they're on CNBC. But I mean, you've got to get out of that CNBC or this eToro as soon as they get off the air. Maybe 2, 3, 4 minutes off the air.
Following a tremendous year in 2020, a part of us thinking about the next stage of growth of eToro is taking it through this transaction to become a publicly traded company. We do believe as we scale up the platform and add millions of users into the platform, it's always good to make sure that you have the required funding to fuel your growth expectations.
Finally, Betsy, I noticed the PIPE investors will not be subject to a lockup. Why is that?
I think that they're purchasing and committing to purchase, ahead of time and with certain information. And they are long, many of them are long only shareholders. And looking to support the growth that Yoni just described over the next 2 to 5 years. And so their interest in selling is not prominent, but their ability to sell within their particular structures is an important element to them.
Okay. Well, Betsy, always appreciate your joining us for your latest deal. Yoni, thank you as well.
Thank you very much.
In the meantime, guys, watch Nikola this morning under some pressure as they file to raise
a little underwhelming compared to yesterday. Let's see what happens here. Yeah, it's a little underwhelming compared to yesterday. They Ava went on and saw a massive spike in volume and trade price. I mean, it just went from about $13 up to 17 within a matter of 15 minutes during the interview, and a few minutes after the interview. And then we saw GameStop and all these others tank. And I know those related. It wasn't just a coincidence. So I'm a little surprised we didn't get that. I don't think this interview was as long. I don't think it was as powerful as yesterday's interview. So that's probably why, unfortunately. But it's worth taking a flyer. I mean, I think that eToro still is a good platform to go somewhere once the public trading officially gets, they changed their name and all that stuff. It's officially trading publicly now. But once they change this to be eToro, I think this will also provide some context on the valuation of Robinhood if it goes public, which I think it will. And then I know a lot of people hate Robinhood just because of the GameStop thing, but if it weren't for that, I think everyone would still be very high on Robinhood right now. So anyway, we'll see what happens over here. I've still got my limit order in to sell. If it kind of drifts up slowly, I might bring that limit order back down to, $14.99 or something. See if I can dump it today, make $100 or so. Anyway, damn it, we're in a commercial break. I didn't even notice that. Again, sorry about the commercial breaks here on CNBC, but I guess they don't pay for the commercials. But I think their coverage is way better than TD Ameritrade's TV. So that's why I like to keep it there as much as possible. So hang tight for a few minutes, let them pay for their ads, and then we will come right back and see what else is going on. It looks like AMC is trying to make a little bit of a comeback. GameStop will surge and then drop. Same with Cost and Express surging. Anyway, they are back.
Playbook on tradingnation.cnbc.com. More Squawk on the Street ahead.
Welcome back to Squawk on the Street. I am Dominic Chu. Stocks are mixed so far this morning, with energy and financials pulling back, as you can see behind me here. But on the upside, we've got technology and communication services out there, the outperformers over here. Well, within technology specifically, most of the leaders are players in the chip and semiconductor sector, including names like Micron, also Applied Materials and Lam Research as well. Those chip stocks were among the groups that came under the most pressure during the recent tech pullback. But one of the ETFs that tracks those names, the VanEck Vectors Semiconductor ETF, ticker SMH, is up by about 10% from its lows last week. So again, some big moves in technology stocks and specifically chips. So Morgan, I will send things back over to you guys at Squawk on the Street.
Dom Chu, thank you. The stealthy F-35 is back in the kill zone. House Armed Services Committee Chairman Adam Smith recently called it a, quote, rat hole after the Air Force's top general announced a study on future aircraft mix, raising questions over whether the service, which does call F-35 its fighter fleet, quote, cornerstone, will ultimately buy the more than 1,700 jets once envisioned. So Cowen's Roman Schweitzer says the Joint Strike Fighter program has a, quote, near-death experience with every new presidency. Remember those Trump tweets? And with a projected cost of $1.7 trillion over its life cycle, perhaps it's not surprising. But this time could be different. An exploding deficit, shifting defense priorities, and a fighter that, after years of cost overruns and performance hiccups, is so high-tech now, so capable, that some officials and experts argue you might not need as many. So what does that mean for Lockheed Martin and some of those key suppliers like Northrop Grumman, Raytheon, and BAE? Well, head of aeronautics Greg Ulmer says Lockheed Martin is working to keep cutting costs. The most common variant, the F-35A, is now under $80 million. That's a 70% drop from the first production contract.
We've been able to reduce our cost in sustaining and maintaining the F-35 by 44% in the last 4 years alone. If we look forward in the next 5 years, we see another 40 to 50% reduction in terms of our ability to reduce our cost even further.
In the midst of all this job owning, worth noting that Lockheed is negotiating a long-term services contract with the DoD around sustainment. But overall, about a quarter of Lockheed's revenue is F-35. So far, it's delivered 625 jets globally. There are another roughly 245 in production in Fort Worth, which is its main facility. It has a few others around the world. When I was there in Fort Worth broadcasting live 4 years ago, 141 aircraft were in various stages of assembly. So the question, guys, now isn't whether F-35 goes away or whether it's been deemed a failure, as some media reports have said in recent weeks. It's whether the DoD buys all of those 2,400 plus jets that were initially planned and how quickly. So to that, with 3 U.S. services, 7 partner countries, 6 more allies, all buyers, Ulmer, at least, does say that based on the backlog that he sees, based on the interest, including the international interest, he doesn't, quote, really see a threat to the quantity of the production system. But I have a feeling we're going to keep talking about this because, Carl, in addition to being a weapon system, F-35 is also very much a jobs program. More than 250,000 jobs here in the U.S., both direct and indirect, are supported by this program.
It also ties into the ongoing discussion about interest rates in general, Morgan, and the degree to which the government's debt service costs, if it goes up really marginally at this point, you're talking multiples of the defense budget for an entire year. So it will see in the coming years whether that in fact comes under pressure.
Absolutely. And given the fact that, as I mentioned, those shifting priorities at the Defense Department, plus you have things like modernization of the nuclear triad, there's all of these key priorities. The budget's flatlining. We've seen the defense stocks, particularly last year, sell off pretty dramatically, in part because there's this expectation that with this new administration, with a democratically led Congress, not only could we see a flatlining in coming years, but you could see even steeper cuts. So far, some of the different CEOs I've spoken to say they don't expect that, but this gets to that bigger, broader debate and one that has been affecting investors, Carl.
All right. Fascinating look. Defense always important to keep an eye on, as is retail. Much of the XRT today is in the red. You've got names like Dick's Sporting Goods, Land's End, Gap. The fund's top holding, of course, is GameStop, which, as you can see, back below 200, got to 174 earlier on. Stock's down 15% today. More Squawk on the Street in a moment. It's been a year since restaurants across the country shut down because of the pandemic. As in-person dining is returning now with some limited capacity, what will the outlook be for the restaurant and dining sector? David Palmer joins us this morning, Evercore ISI Senior Managing Director, covers food and restaurants, and has a pretty good note this morning entitled The Restaurant Post-COVID Setup Handbook. David, welcome back. Good to see you.
Great to see you, Carl. Thank you.
It sounds like your overall take is that consensus estimates for comps, especially in casual dining, are too low. The question is how low, right?
That's right. When it comes to casual dining, the stocks have come a long way, but it's interesting that the street numbers really haven't come up as much. When you think about the combination of factors out there, the GDP growth that's happening, and Hyman and team here at Evercore, they think you could be looking at nominal GDP growth of 15% in 22 versus 2019. Oftentimes we'll look at 2019 as the base year of a recovery. Well, who's to say we might not get way past that, especially when a lot of these chains have added off-premise business and their competitors are closing stores lately. So, but we're going to need to see those upside scenarios for the stocks to work. So it's going to be a big evaluation time for casual dining coming up.
Yeah, I know you got some favorites in DRI and in Brinker as well, I think. We'll talk about why those two are special. And then in quick service, I wonder how much of that off-premise do they actually keep once we get to at least closer back to normal?
Yeah, when it comes to, just to pick on two names out there that have had big off-premise sales layers that have been added, it would be Chipotle and Chili's, which you don't normally put those two together. Brinker's Chili's business, 90% of Brinker, they added a tremendous off-premise sales layer. They were 20% off-premise before COVID. Now they're 50%. We'll see where that settles out. And if you're looking at the out-year sales, to say that they might be 15% above 2019 levels, not hard to get there if they maintain a lot of that off-premise business. Similarly, Chipotle had a lot of business through digital, and now they have the most loyalty members per restaurant in our coverage. When it comes to fast food, though, the funny thing is that the global multinational names, franchise names, those stocks haven't worked very much. And, to some degree, you wonder when they will get in the game. Obviously, vaccines have been slower to roll out overseas, but perhaps the best stock upside is in names like McDonald's or Yum Brands from here.
David, I mean, we've seen millions of workers in the restaurant industry laid off in the past year. In the midst of faster, perhaps, adoption of some of these digital technologies, automation, how many of those workers will again have jobs? And I guess when you are talking about that broader tech adoption, whether it is, as you just mentioned, McDonald's or others, what does that mean for the stocks themselves and the bottom line?
Well, the restaurant, you point out a good point, which is that restaurants are really going after tech right now. They've had a big wake up, having 90% of their sales at a typical drive-through format location. 90% of the sales have all of a sudden been going through that drive-through. So everybody's thinking about, do I have my mobile order set up? Ultimately, with $15 wages down the road, people are thinking about efficiency, and they certainly want to keep their franchisees as whole as possible. There is no clear job loss that's going to happen from digital. Rather, it's really about productivity and driving speed, checks, aggressive selling, all sorts of stuff. But down the road, much further down the road, that's something that could take the edge off of the employment or bodies needed at the restaurant. That's not the focus now. Everybody's just trying to get people through that drive-through more quickly, for example.
Speaking of that, David, it's hard to remember, but before COVID hit, I mean, it seemed like every other day there was some headline about menu innovation or new menu items, each player trying to outdo the other. And I would assume you think we're going to get sort of back to that environment as they start competing for this fresh wave of dollars.
In the fast food side, it's going to be the barbell again. You can feel all the chicken sandwich news, all the premium news that's happening right now. So you're going to see, you saw the quesadillas from Chipotle, you see all the chicken sandwich wars that are happening right now. And basically, that's going to be great for one side of the equation, but you're also going to need value. A lot of people have been left behind so far in this recovery. And so for that 20 to 25% of the fast food users that need value, that's going to be around. And right now, you're going to see companies, the big chains, they're going to have to feature value at the one end to go along with their premium chicken sandwiches on the other end.
That's fascinating. No, we're definitely in for an interesting new chapter, and it's a great note as people try to get their playbooks in order. David, thanks as always. Great seeing you. David Palmer.
Thanks.
All right, well, I'm officially hungry. Check out the biggest gainers on the NASDAQ 100, though, as we do see that average bounce back. Moderna up more than 6%. Micron, Applied Materials, Lam Research, those semis getting a bounce today. Also, Fox is up about 3% right now. Squawk Alley is going to start on the other side of this break.
Good morning. It's 8 a.m. at Apple headquarters in Cupertino, California. It's 11 a.m. on Wall Street, and Squawk Alley is live.
DJ Elon Musk there to start the show. Good Tuesday morning and welcome to Squawk Alley. I'm Deirdre Bozo with Carl Quintanilla. John has the morning off. Ahead this hour, $3 million worth of NFT sneakers sold, and get this, just 7 minutes. Evercore takes Apple to a new street high, and we break down the latest season of Fortnite. But Carl, we are going to begin with markets.
We will indeed, Dee. Barron's has a piece out this morning looking at the recent volatility in tech stocks, noting that the last time we had this kind of divergence between the Nas And the Dow, you got to go all the way back to the early 2000s and the dot-com bubble. What does that mean for your money? Lo Tony's with us, founding managing partner of Plexo Capital, to weigh in on what the environment's like right now. Lo, welcome back. Good to see you. Thanks for helping us kick off the hour.
Absolutely. Thanks for having me.
So it's not just Barron's. B of A does a fund manager survey. They've got some new numbers out today. Says it's the biggest drop in tech exposure in about 15 years. I just wonder, what are you making of this narrative of a rotation out of tech? And if you believe it's happening, to what extent is it going to happen from here on out?
Yeah, I think what we're seeing is the market has already priced in the Biden stimulus package, and now we're trying to see how it plays out. We had already seen a little bit of reflationary pressure coming in, kind of trying to get the economy back to the historical levels of where inflation was. And so I think what we're seeing is just a lot of managers taking the historical perspective of transitioning over to those sectors and companies that are going to benefit from the rise in yields and the other things that are going to come along with this.
At the same time, though, if we're looking at GDP growth, the way in which some people are forecasting, I have to imagine that's going to lead some elements of technology just to earn their way out of that valuation hole.
Yeah, no doubt. I mean, look, there's going to be a higher bar for these tech stocks now that there are alternatives to be able to make the types of returns that investors are looking for. That said, I am a long-term bull on technology. And in fact, I would say that there's so many things that have changed since the last time that we've seen this divergence between tech stocks performance and the historical stocks that one would look to in this type of economic environment.
Lo, good morning. It's Deirdre. As a long-term tech bull, then what do you make of this sort of divergence we're seeing within the sector this year? You're seeing some of the legacy names like Oracle, Cisco, even IBM actually outperform some of last year's tech darlings. Does that last? Is this a secular sort of shift, or is it just a trade perhaps for this year as we look ahead to a reopening?
Yeah, it might be. I think, look, one of the things that had happened is, a lot of those historical legacy names have proven the ability to become bellwethers by changing their business models, but that lagged a little bit from some of the more darling new names. So, I think we'll just have to just take a seat and just watch and observe everything. Long-term, again, I am a bull, but there's a lot of things that the market needs to sort out, and there's some new elements that haven't been in place for the past couple of decades.
Okay, so take Cisco and IBM's push into cloud, wanting to become big players in this space, but competing against the Microsofts and Amazons and Googles of the world. Do you think that this is a long-term trend? Can they actually compete? Do you believe the numbers that you're seeing? We had a conversation last week with a few analysts that said there wasn't a whole lot of transparency when it came to those companies and their cloud ambitions.
Yeah, absolutely. There is zero incentive for them to be able to open the kimono, so to say, and actually show the progress to date. Let's be clear. There is no alternative for them except to try and compete in these markets. They've got a long road to go, but the good news is they have the balance sheets that at least give them the ability to make those investments and try to compete.
Lo, there's some headlines this morning that a few more states, for example, are joining in on the Texas lawsuit against Google. I mean, we've spent the last couple of years talking about antitrust risk and regulation risk. In general, do you see that as a true long-term negative, or is it, in a way, and not to be crass about it, but is it the cost of doing some business?
Yeah, I would really lean more towards the latter. I think that, again, and I've always said this, we're in an environment where the regulators tried to foster the ability for innovation to happen, which is a good thing, like taking a more laissez-faire approach. However, now that we're seeing how intertwined these tech companies have become in our personal lives and also the corporate side, we obviously see the need for some additional regulation, and the markets are struggling to try and understand, what does that mean long term? But, again, let's just be clear. These things will figure themselves out. Technology is too important. These companies have the most powerful business models that we've ever seen. So it will play out. It'll just take a little bit of time, and the waters might be choppy until we get there.
All right. I want to get your take, Lo, this morning on NFTs. We're going to talk about it a little bit later on in the hour as well. But Times did a really interesting piece over the weekend about essentially investment manias, I think is how they kind of characterized it. The trading cards, the digital art, the crypto, the sneakers, the sports clips. How are you processing all of this? It's come in such a hurry. What do you make of it, and where do you think it goes, at least in the near term?
Okay, look, I worked at both eBay and Nike. At eBay, I ran the collectibles business, and I saw this before. I saw it in the form of Beanie Babies. At Nike, I worked on the online marketplace, and we saw it with all of the tier zero, the most desirable things that people bought from Nike. So look, I think this is a convergence, and we're looking at the ability for people to now have this combination of the rise that we're seeing in Bitcoin and some of the other cryptocurrencies, kind of coupled with their desire to be able to own some of these rare things. There is a difference now, which is these digital assets can be tracked. They can't really, be lost, so to say, although I guess they can be stolen, as we've seen. And look, something is as valuable as someone is willing to pay a price for it. So, look at, Beeple, the digital artist that recently sold, I don't know, about $70 million in one piece. And it's kind of like, Bansky meets Bitcoin.
Yeah, no, it's true. And I mean, believe me, I think even Beeple's trying to get his head around it. The follow-on, though, is that it's all being made possible by excess liquidity, stimulus checks, people at home, people being bored, people on social media. Does that make it any less legit? Those very strange factors that have fed the boom.
I don't think it makes it any less legit. I think what we should be looking for is it more of a bubble? Is it too overheated by the fact that there is so much boredom, as was pointed out, the fact that there is some excess, monetary gains coming into people in the form of stimulus. Are people going to spend their stimulus checks on, digital sneakers, or are they going to spend it on, food and rent? I think, look, this is an important time for our economy. We need to make sure that we're able to have the lessening of this significant shift that we've seen, where the rich got richer in last year in 2020, and it's been hard times for others. But yeah, look, those are some of the dynamics at play, and we're seeing it play out. And this is just a microcosm of kind of everything that we're seeing.
Right. And Lo, that's sort of a sentiment that we heard last week when we spoke to a number of people in the NFT space. You have to be collective, know which artists to look for, perhaps Beeple over Taco Bell tokens. But do you think that NFTs, are really becoming an alternative investment class for a new generation of traders that, are trading stocks on Robinhood? Why not NFTs to see value appreciate in certain things, just sort of like trading cards were once seen as part of a diversified portfolio a long time ago?
Yeah, absolutely. Yeah, that is, I think, one of the key points, which is your comment on the generational shift. What we're looking at is, we have the ability to understand a lot of things in the physical world in the older generations. These younger generations have a deeper understanding of things in the digital world. And when I think about things like, sneakers, for example, you look at the aftermarket for sneakers, and it's hard to be able to actually get your hands on them if you're a collector. Well, the digital realm has provided us with a way for collectors, both on the buy and the sell side, to actually be able to participate at scale in ways that they would not be able to do so if it were not for digital. So is this an opportunity to be able to have these new digital assets, these NFTs, be part of a portfolio? I think that the younger generations are saying resoundingly yes.
Yeah, it's kind of hard to refute that, at least at the moment. We're going to watch it closely, Lo. Really great seeing you. Thanks again. Lo, Tony.
Thank you.
And we're going to talk more about this all because see those sneakers on your screen? Love them or hate them. For $3 million worth of them in just 7 minutes. More on that NFT craze with the founders of Artifact. That's coming up next, so do stay with us. Our next guests are the creators of NFT sneakers, selling over 600 pairs for over $3 million in just 7 minutes, by the way. With us now are the founders of Artifact, Benoit Pagotto, Stephen Vasilev, and Chris Lee. Good morning, gentlemen. Nice to see you guys and not your artifacts. First question for you. I get the appeal. We did see them earlier. I get the appeal. I actually really like the look of these sneakers, but there are many out there who I've been talking to that just cannot understand the idea of paying thousands of dollars for sneakers that you won't actually get to wear. So Benoit, let's start with you. In your words, why are people shelling out money and so much money for these things?
I mean, I think people are shelling out so much money because we really created something unique when we work with Ferocious on this concept, and we're really trying to pioneer how people are thinking of buying sneakers and items in the future as collectibles first. And then of course, you have the utility of wearing them. So just one precision, by the way, these sneakers, everyone who bought them, they're also going to get physical ones if they redeem it on time by the 10th of April. But the value of it is that the NFT of the sneaker is actually acting like a blueprint. So without that NFT, you can't access to the physical goods. So it's acting as a key to give you access to extra experiences, and one of them is having the physical version of that. But I think we had so much success because we were in the middle of a maelstrom. You know, what's happening right now in the crypto art community and all of this NFT revolution is really amazing. I've never been in a space like that. And how we work with Ferocious, how we did the content, how we did the design, and Ferocious is an amazing artist. We think he's like the next Keith Haring. I think all the planets aligned to make something that's now kind of like a benchmark on how you do these things. And everyone wanted to support, and the community has been behind it. And it's the first time it's done. So, you know, it's very exciting, and people manifested their excitement with the money they put in to buy it. And what's crazy is now they're reselling on the secondary market already. So the craze is not over.
How much have they appreciated on the secondary market, Stephen?
So they've gone up about 50%. We were selling them initially. We sold 3 models at 3,000, 5,000, and 10,000. We've seen them go for up to 15,000. So there's definitely a market and the demand. What's great is every pair is trackable on the blockchain. So it's very easy to see the scarcity, which is awesome.
Okay, Chris, that's pretty amazing that in such a short time they've already appreciated these digital sneakers by about 50%. And those people aren't going to get the physical ones, I assume. So the point of them, though, is not to wear them in real life, but in the so-called metaverse, these sort of digital worlds that Roblox and Fortnite and others are creating. So, you know, my question is, how do you make sure that there's no fakes in the metaverse? Does that matter? I mean, when you think about luxury products in the real world, there's a huge problem with counterfeits. Do you see that becoming a problem in the metaverse? How do you sort of combat that when you have a sneaker like this?
I mean, the advantage we have is, go ahead, Chris. Sorry. Yeah, go.
Yeah, so you won't, because everything is on the blockchain. For example, you know, like, how do you authenticate a basketball jersey signed by Michael Jordan? It's really hard because when you go to Authenticator, they're going to have to try to verify the signature to see if Michael Jordan even signed it. That's why they always ask for paperwork. Is there a picture of Michael Jordan signing it? But with blockchain, say if Michael Jordan made a wallet or he started selling his own NFTs on, say, Nifty, OpenSea, Wearable, it would be traced back to Michael Jordan. And on top of that, every new collector or buyer that buys it, it traces that a purchase with, you know, the timestamp, what day they purchased it, how much they purchased it for. So I feel like there can't be copies. And if there are copies, you can easily tell where the original source came from.
That's interesting. Benoit, I wonder, I mean, obviously, you guys are having to explain the basics of this, and you probably will have to explain the basics for a while as people get up to speed. Is that frustrating, or do you think that's just part of being on the cusp of something that is truly new?
I mean, I think it's part of our role, you know, because we are acting as like pioneers and with the community. Again, like, it's not us, it's a whole community movement that's happening right now. And our core belief is that when communities start to organize themselves and they want to make a big change in the world, they can. And right now, that's what's happening. It's way bigger than just NFTs. It's like a whole movement, all, you know, part of the population and creators and collectors are making the change and making things happen every day. And I've actually been in that before. You know, I was in esports before, and I had to explain people, you know, why it was the new form of sports and entertainment. So it takes time. When you're in a part of like something new, you always have, as part of your role, to educate and spread the message and explain people how they can connect in that world and be part of the movement. So we're not tired yet of explaining if it's totally normal, because for us it's natural, because we come from video games, we come from collector of goodies and anime, all of this stuff. Right now for us it's natural because it's all the things we love and know that we can manifest and create with and make revenue with. But I think the revenue comes because what we do is very genuine, and educating people and getting them up to speed is something we need to do. But at the same time, we know people will never understand. Just like today, there are still people who don't understand why esports is so strong and such a cultural movement. So these people, we won't spend too much time explaining.
Okay, Stephen, last question to you. With such demand for the sneakers and even that appreciation that you guys spoke about in the secondary markets already, how do buyers of these original, the first set of sneakers, know that you guys won't turn around and issue 50, 100, 1,000 more of these digital sneakers, devaluing them? I mean, that's kind of what trading card companies did in the 90s, ushering in the junk wax era. How do you avoid that in NFTs and specifically with your sneakers?
So for us as a brand, we keep our integrity. So we never release more than what we say we've done. For example, the Atari sneakers that you see on screen right now, when we sold them, we actually burnt the rest of them to increase the value for the original people who bought the items. So we're really focused on two parts, the collectors and the artists. So we focus on empowering the community and bringing in new artists to skin our shoes and give them a revenue cut in a fair way, because it's a new generation that's starting. And then on the collector side, we value the collectors who are spending this money. So we don't want to overproduce, and we actually do the opposite and destroy NFTs to increase the value.
Everyone starts with that intention, Stephen. How do you make sure you stick to that philosophy?
We just make sure that we
can
value
swear
our collectors.
But that's part of our brand, our DNA. Yeah.
Okay. We hear you. Gentlemen, thank you so much for joining us this morning. Benoit, Stephen, and Chris from Artifact.
No, thank you for receiving us, and thanks to everyone supporting us in the community, and thanks for you guys for covering this. It's super exciting.
Great discussion, guys. Thank you. You saw that Apple chart up. Take a look at it. Evercore today, new street high, 175, bull case 225. We're going to talk to Amit Jaryanani in a moment when we come back.
Welcome back. I'm Rahel Solomon, and here is your CNBC News update at this hour. Homeland Security Secretary Mayorkas is defending the Biden administration's handling of the surge of migrants along the U.S.-Mexico border. He says that a Trump policy of turning away single adults and families is being continued, but that minors are being held in temporary shelters until they can be placed with relatives or sponsors in the U.S. Senate Majority Leader McConnell is warning Democrats will create a, quote, completely scorched earth if they do away with the Senate's filibuster rule. He says that such a move would make it harder for President Biden to advance his agenda. Visa and MasterCard are postponing planned credit card fee increases until next year. The fee hikes had drawn criticism from lawmakers. The companies cited the pandemic's impact on businesses. And Tinder wants to help members swab while they swipe. The online dating service is offering free COVID testing kits to 1,000 members, one for themselves and one for their match. Dating in 2021. And that is our CNBC News update for this hour. Squawk Alley returns in just a moment.
Our next guest has Apple at a new street high today. Price target 175. Says the stock is less of a product story, more about services. Expects revenue to cross $100 billion by 2025. With us this morning, the analyst behind the call, Evercore's Amit Daryanani. Amit, welcome back. Great to have you.
Thanks for having me.
I'd love to get you to talk a bit about the product service narrative, but also this idea that the valuation over time really reverts to something that we see in consumer staples rather than in tech.
Yeah, absolutely. And, there are two parts of this narrative if you think about it. One is this is inherently going to keep becoming less about how many iPhone units is Apple selling, but really how we're going to monetize this 1.6 billion iPhones that are out in the wild right now in the install base, right? And on the services side, the way we kind of frame this is, listen, the average iPhone user is spending about $62 a year on iPhone services, right? Compare that metric to what you spend on a Netflix, a Peloton, and Amazon Prime, all these other things, this number could easily keep growing. And as long as it keeps going through install-based growth and from new services being offered, we think services alone can grow mid-teens for the next 4 or 5 years. Variables, really quickly, I think the narrative there is AirPods, despite the fact that, we see them fairly often, it has a less than 10% attach rate to iPhone users. Same is true for Watch, by the way. To the extent that number can get to about 20% attach rate, you should see these businesses grow high teens as you go forward. And that's kind of a big theme of less about iPhones, more about monetization of the install base.
Oh, that's interesting. So where does that leave people who've been trained over the years to react to every incremental headline about supply chain, about production growth, about the marginal improvement in the camera product offering? And what about the concern that we used to have, at least, about margins, and that is that they're not as robust and they're not as transparent about services margins than they have been on product?
Yeah, listen, as an analyst, I would love for Apple to be more transparent on a whole host of things, but I wish for a lot of things that don't come true, I feel. Where does that leave people that model this by iPhone units? And by the way, I still run a model on iPhone units. It becomes a lot less relevant as you go forward, right? I feel like the model we should all be running is how is the iPhone install base tracking versus how our iPhone units selling. I think that metric has to change in terms of what is important. The other part, by the way, to the point you mentioned, services inherently and wearables have higher than corporate margins, which means not only is the growth skewing to the install base monetization, but this could drive margins and EPS a lot faster than what people have seen historically out of them.
Good morning, Amit. It's Deirdre. I know you're talking a lot about services, but there's a lot of, or at least some uncertainty there, especially movement on the regulation front in terms of payments and the App Store. Just recently, Arizona House passed a bill that would allow developers to avoid that so-called Apple tax. How do you build that into your case? And do you think this is a risk or something that, will kind of peter on like we've sort of seen regulations over the last few years?
It's a great question. And certainly if I had to poke a bear thesis into our entire narrative, it is, can regulation undermine, everything you said, in addition, think about all the issues they've had with the Google licensing deal as well, right? So I think what can happen from a regulatory basis could absolutely be a big risk or a risk on this narrative as you go forward. Now, on the Apple tax or the services tax, right, we've kind of gone and said, hey, if they took that 30% take rate down to 10%, that would imply the total EPS could get impacted by 7-8%, right? And so that's the kind of headwind we're working with. Our assumption would be that, Apple probably has the least amount of regulatory risk compared to big tech as you go forward. And as you said, these things might just peter along for a longer time than be a material headwind. At least that's our hope right now.
Right. So you're saying that even if that commission went down to 10%, you still think that services could be the growth driver? Is that what you're saying, Amit?
Absolutely. And I think the part that, in fairness, that people underestimate on Apple services is their ability to launch new things like Apple TV or Apple Arcade or Apple Fitness and make it a several $100 million, if not $1 billion business rather quickly is something that I think you'll see more and more of Apple as you go forward.
Hey, finally, Amit, everybody's got to have an opinion about an Apple car. And I know it's early. It's so early that there's a big divergence in opinion between, on the one hand, largest available global TAM. On the other, it's so far out that it's impossible to model at this point. Where are you on the car?
So one of the things we do in this report we had was we say, what, you're getting a free call option on a whole host of moonshot projects, for lack of a better word, right? Apple Car is one of them, but I would say that the 3-4 other ones that we outlined in the report. I think you will have an Apple Car, and it will be a physical product that Apple will be out with along with their own software. Apple likes to integrate everything from hardware to software to componentry. I think you'll get it. 2024 seems very aggressive. I would say 2025, 2026 is probably the right time in, but I do think you get it within this decade.
Well, it's a robust, thorough note at 126 pages, Amit. We won't get to all the nuances, but congratulations on it, and thanks for coming on. I look forward to talking again soon.
Absolutely. Thank you very much for having me.
Coming up on the show, the tech that you will need to link home and office. Joanna Stern breaks down the essentials for remote and hybrid work. That's coming up next. Stay with us.
If you're worried about your return to the office, or if you're reflecting on the stresses of a hybrid work model, our next guest has some advice for you. The Wall Street Journal's Joanna Stern has a great piece looking at the tech that you will need to link your home and your office. Joanna, it's great to see you again. Welcome.
See you guys.
You know, it seems like every day we're
office.
getting like a new corporate memo from some employer that's sort of outlining their plan for bringing people back. But one thing is clear is that we are going to need to either upgrade or at least maintain the tech that we are using from home, as I am right now, for example.
Yes, the home office, from all the experts, that they tell me it's going to stay. The setups that we've perfected over the last year, that's probably going to be a very core place of your future of work, in the sense that you will have your home office, and then some days you will go to your office. And in that sense, there's a lot of debate around how much time you'll spend in each place, but 2 to 3 days is what I heard from a lot of tech executives. They're all betting that we'll spend 2 to 3 days at home, the other in the office.
Right. So from your point of view, in terms of tech, is the real innovation and the real acceptance rate going to depend on software or hardware?
It's a combo of both. I think the tech industry is very excited about this because it means even more dependence on these tools, in the sense that in the last year, we were certainly dependent on these. But when you split the workforce, we were all at home, so we all sort of knew where we were. We didn't have to, we were over communicating, but not communicating in the sense of that we didn't know where people were. We knew they were home. Now we'll have these tools that we need to adapt to the fact that someone's in the office, someone's at home, someone's on a boat someplace, you can work anywhere. So from the software side, the Slacks of the world, the Microsoft Teams, the Zooms, the Google Workspaces, they're all working on tools to make that easier. A lot focused on video and audio. Heard a lot about a dependence on audio coming from Slack, some new sort of Clubhouse features, and the idea that you can just drop into a conference room. On the hardware side, again, even more dependence, because we're going to go back to these offices where we'll be talking to people everywhere. So we're going to have webcams everywhere in the office. CEO of Logitech, very excited about that. Had a really nice conversation with him about how he just visions the entire office having cameras.
It's a little scary of a thought, Joanna.
Yeah.
I know you love your dongle bag, right? How long have you had it?
I do. I was really hoping I would come on this show and talk about my dongle bag. In fact, I have it.
How long have you had it, Joanna?
Sitting right here.
How many days or weeks,
honestly,
though?
I knew that I would have to show my dongle bag publicly, so I did just buy this for reporting purposes. But this is going to be even more important, right? You're going to be dragging dongles and adapters and AirPods and headphones and laptops back and forth.
But Joanna, the reason I ask is because there is no way that I'm going to show my, dongle bag on TV, because it is an absolute mess. I mean, I've tried this a number of times, and there are just wires and stuff everywhere. It's like completely useless after a few days. So I just wonder, do you think it's possible that companies will purchase double, stuff that you can keep at home or on the go, and stuff that stays in the office? Sure, that may be more expensive, but you could avoid lost stuff, damaged devices. Is it possible that, the CEO of Logitech and other companies could see even greater than anticipated sales as we all, go back to work or a hybrid workforce?
Well, first of all, let's talk about your dongle bag. You need to clean that up. So we can talk afterwards about one that I recommend, but 100% on that, right? Logitech CEO told me that. Also the hardware makers that do make the software too. So the Googles of the world, Microsoft too, they also make speakers for conference rooms and webcams that connect to their software for conference rooms. Zoom partners, and they make whiteboards and connected whiteboards that work with video cameras and et cetera. So all of the office stuff is going to be in even more demand, right? As companies look to refresh their office spaces, many looking at sort of the hot desking, right? Everyone shares desks. So they're all going to be upgrading that infrastructure. Plus, they're going to want to make you feel comfortable at home. And so we've seen many of these companies, especially the big tech companies, give stipends to their workforce. Thousands of dollars, basically. I heard some companies tell me upwards they got to $2,000 for people to outfit their homes, right? So they aren't just buying nicer desks and furniture, they're also buying nice monitors and new laptops and new webcams. So all of that I expect to see a big surge in.
Joanna, I'm curious to know where you think this leaves Zoom, which obviously has gotten the zeitgeist, the lion's share of the zeitgeist post-COVID. I know you've looked closely at Teams and Google Workspace and Slack, which you compare to a Clubhouse for very quick meetings. Aren't we in a period? I mean, the street is very much in a mode where they believe that a large enterprise is going to consolidate vendors. Who's in the pole position in that case?
Zoom, I think, stands to be left behind in the sense that they only really focus on the video and the calling, right? And you've got Microsoft and you've got Slack and you've got Google, especially with these combined suites of products. So not only can you get the chat and the video, but you also get the suite of collaboration tools, the Google Docs, the Microsoft Words, the presentations, all of that kind of stuff in these combined packages. And certainly there's something to be said for a company just investing in one of those and saying, hey, we're going to do Google all the way, Google Meet in the conference rooms, Google Docs, slide sheets, etc.
That's fascinating. And then finally, I wonder, do you think there'll be a point as we get headline after headline regarding cybersecurity risk and hackings that employers will eventually say, look, we'd love to have you work remote, but this is an important meeting and we'd rather not have it online. Why don't you come in?
I think so. I mean, I did speak to a couple of CIOs for this piece, and I definitely heard quite a bit about amping up security and making sure that the IT departments are really focused on that. What does that look like? I think that sort of idea that, hey, this is an important meeting, whether it be because they want FaceTime or because it's more secure, come into the office is something we're going to hear a lot more of. And again, that's that hybrid model. You really only go to the office to collaborate with people. If you're doing solo work, if you're on CNBC, you stay home.
Yeah. Well, certainly, at least on some of the banks and some of the trading businesses, they're putting the emphasis on being back. We'll see how the summer goes and talk about that when we get closer to Labor Day. It's a great piece, Joanna. Great seeing you as well. Talk to you soon.
Yes, and I hope to be coming to talk to you guys in a studio and that be part of my hybrid work, that I go to you guys.
Okay.
We hope so too. Keep your eye on Roblox this morning. Stifel initiates it with a buy, saying it is a compelling play on the convergence of content and social. Price target there, $85. As you can see, it's at $76 and change, up more than 5%. We're back in just a moment. Our next guest is the first company to take advantage of a new rule passed by the SEC just yesterday, increasing the maximum amount of money that can be raised through equity crowdfunding. That's now $5 million total. And with us now is Sahil Lavingia, founder and CEO of Gumroad, backed by the likes of Max Levchin and Chris Sacca, as well as Basecamp CEO Jason Fried, who participated in Gumroad's latest round. Good morning, gentlemen, and thanks for being with us. Sahil, let me come to you first. How does or doesn't this move sort of change the dynamics in the startup ecosystem? It further democratizes investing, sort of like Robinhood has done for trading, but at the VC level. But could it increase risk as well, lead to more startups that perhaps haven't been vetted by VCs or investment professionals that do this for a living?
I mean, yeah, it's certainly possible, but crowdfunding has been around. As you mentioned, the limit's gone up from 1 to 5. The first crowdfunding round was in 2015, I believe, and there have been basically 0 cases of fraud or scams in that market. These deals are still vetted by these crowdfunding portals. On the other hand, public markets have seen plenty of fraud, so I don't think that this is sort of going to increase. Or really, I think sort of the average person, the little guy, quote unquote, is actually pretty sophisticated and can do their own research and make good investment decisions. The other thing I would add is regulation. Crowdfunding is heavily regulated. So we had to file a Form C. You can look that up. If you go to raise.gumroad.com, you could read all of our financials. You can see the history of the companies, and that's a requirement for all companies that are raising these kinds of rounds. SPACs, on the other hand,
right, and I think that's fair. Yeah, okay, that's fair. Jason, let me come to you. I mean, we've just seen over the last year and a half, year or so, the explosion of SPACs on the scene. Do you think that we'll see kind of a similar effect here, a proliferation of startups and this type of crowdfunding investment?
I do. I think SPACs are a bit disingenuous, personally. So I like this more direct form of investing where you know what you're actually buying into. And small investors can finally get involved. I think that's really nice. Forever, there's been a very, very high wall. And anytime there's a high wall, there's something hiding on the other side that's really good that other people can't get to. And I think it's nice to lower that wall. And so I'm excited to see where this goes. I do think this direct investment into small private businesses is ultimately a good thing, as long as people, of course, do their homework, which they should do with any investment. But at least it's direct and it's clear,
Jason,
and then I appreciate.
Why are SPACs disingenuous? Aren't you just putting money with someone who you trust to make the right investment? How is that different than sort of putting money directly with a founder? You may not know as much about them as, say, someone who is going to take a big stake in that company through a SPAC.
Well, at least you can see the financials of the company itself that you're putting money into. With the SPAC, yeah, you're betting on somebody, which is fine, but you don't really know what they're going to do down the road. People's point of view changes, and I don't know. I just think they're a bit disingenuous. It's a bit of a mystery investment.
But you do see the financials when it comes time to keep that investment in that special purpose acquisition vehicle or get out. So how is it different?
Well, you see them later. Yeah, that's true. But you put money in with a person first, and then they decide if they want to buy or bring other private companies public. So yeah, I mean, look, I find them to, I'm just giving you my opinion. I find them to be a bit strange and disingenuous for that reason. But I just appreciate the direct investment into something where you know exactly what you're buying, you know exactly what you're buying, when you're buying it, what you're getting into exactly. There's just it's a more direct, in my opinion, honest way to put your money to work. But people are free to do whatever they want, and maybe I'll be proven wrong over time. Maybe not. Doesn't even matter, I guess. Just my opinion.
Okay, so here, let me come back to you. As a founder, the idea of raising money from an experienced venture capital is their value add, who they can introduce you to potential deals and partnerships, help you find talent when you are pooling from such a large group of different individual investors, and they may be customers with a lot of value add, but how do you capitalize on that, take advantage of that when there's so many?
Yeah, I mean, look, like I've raised money from venture capitalists. I've raised money from Excel and Kleiner Perkins and other folks in the past. So I have that experience. I've co-invested with them. I have my own venture fund too. So I can get that help if I need it. And frankly, a lot of them are investors in Gumroad now. Several of them have invested directly via this crowdfunding round because it's open to everybody, including VCs. I think, getting help from more people is not hard. I can tweet out, hey, I need help with this, and I get 50 DMs, and then I go through them. It's really not a really big deal. And frankly, like a lot of founders who have raised money from Silicon Valley VCs, often are disappointed by how much value add they think they're going to get, and then they realize they're one company in a portfolio of 50. And if you're not Uber, if you're not Instagram, by the way, I've been in this position with Gumroad for several years. We started the company in 2011. You don't necessarily get the help you think you might, and it's up to you, frankly, right? Like you're the founder. It's your company. And so, yeah, I think it's okay to say, it's my thing. It's my responsibility to put my investors to work. And I think, we have 7,600 investors now. My guess is 7,600 investors are going to be a lot more valuable, especially when they're a lot of our customers and our community members than like a few bigwigs.
Jason, I wonder if we're talking about a broader population of participants, does that mean you'll get a broader dispersion of opinions about what kinds of investments you should be making, what kinds of disclosures you should be making? I mean, how far does democratization actually go?
It goes as far as it wants to go, and as far as it needs to go. I think having more people involved in something like this, it's a good idea. It gives people more say in how they want to invest their money versus just giving it to someone else to manage their money. I'm okay with it. In general, hopefully there's not, you don't want to have board meetings with 100 people or 1,000 people. You don't want to have to deal with that necessarily. And of course, that's not what this is. But yeah, I mean, there is a risk, of course, in having 7,000 investors invested in something. There's going to be a lot of opinions, a lot of different points of view. That's a new challenge, which is interesting. But of course, in public markets, you may have hundreds of thousands of individual investors in a stock. So it's not that much different. But I do think there might be a slightly different expectation, given how close they are with the founder. So I think that is something that's going to be interesting to see how that plays out over time.
Sahil, I think I heard from you the sentiment that sometimes VCs and the idea of value add are overrated. Jason, do you agree with that? Do you think that this new rule will change the dynamics? You'll see more companies, more founders go directly to their customers or individuals to raise capital?
I do think contact books or address books are highly overrated. I mean, to give away significant percentage of your company so you can get an email introduction to somebody, I mean, come on, that's ridiculous. You can just email someone yourself, or you can ask around. You can get connections if you need to. And frankly, a lot of these connections aren't worth what they're sold to be. I mean, I'll give you another example of this. We've published a few books with major publishers, and major publishers like to promise you everything. At the end of the day, you've got to promote your book yourself. They're going to publish the book and get it in bookstores, but they're not going to promote the book. You have to promote the book. You have to do the work. So these ideas that like these big, powerful organizations or people are really going to make significant, are going to, I guess, help you make significant inroads into certain areas. I just don't really buy it. I don't see it happening that often. It can happen. But again, what's the trade-off? What are you paying for? What are you giving up to get that one email introduction? I just don't think it's worth it.
Right. Potentially a lot of equity. Okay. Thank you both, gentlemen, Sahil and Jason. Good luck, and we hope to talk to you soon, Carl.
Thank you. Thanks for having us.
Fascinating chat. Thank you, guys. By the way, this afternoon, do not miss a big exclusive on Closing Bell. Wilf is going to sit down with Palantir's founder and CEO Alex Karp at 3 p.m. Eastern Time. In the meantime, we got the VIX below 20 for the first time since mid-February. Back in a moment.
I like the so-called retail investors for lots of reasons. First of all, unlike many people, they're investing their own money with no safety net. Many of them are engineers, so they actually go out and evaluate our product. And by the way, they dispel a lot of kind of what I would call slanderous critiques of Palantir written by people that don't ever seem to have engaged with our product. And so I really like these people. I'm very happy we DPO'd. As some of, when you DPO, you give investors a chance to make money and not just big hedge funds on Wall Street. I'm very proud that normal people investing their own money with their own risk, making their own opinion, made a lot of money. And I'm working, and we are working at Palantir for a long-term outcome.
Carl, as we close out the show, take a look at the NASDAQ. It's up about 0.9% today. And notably for the year, up nearly 5.5%. And it's kind of approaching the gains of the S&P 500 this year, Carl. So shaky start, but we are seeing it catch up to the other indexes after some underperformance this year, Carl.
Yeah, I think the real chart, too, might be the VIX today. People talk about it getting below 20 as an important marker, but it is there right now. First time since mid-February. The judge is back. Let's get to the half.
Carl, thanks. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the biggest risk to your money and why for the first time in a year it is not the COVID crisis. What one big firm just said about the markets that has a lot of people talking today, we will discuss and debate with our investment committee. Joining me for the hour today are Josh Brown. Jenny Harrington is the CEO and portfolio manager at Gilman Hill Asset Management. John Najarian's with us. Michael Farr is too. He's the president of Farr, Miller and Washington. Let me take you to the wall, show you where we're currently trading today. Dow's been up for 7 straight days. We're down 100 right now. S&P new intraday high for it, 39.73, not that far away from 4,000 there. All the way on the right, 10-year note yield 160, almost 161. We are very much watching that, Josh, because Wall Street is very much talking about that today. Bank of America Fund Manager Survey, biggest tail risks right now, higher inflation, a taper tantrum. You've got comments today. BlackRock's Rick Reeder says the 10-year could hit 2%. Morgan Stanley says you could have more restrictive monetary policy sooner than expected. Discuss.
I think higher rates are probably a bigger risk for some parts of the market than others. I don't discount that threat overall as being something to just completely ignore. But the data suggests stock prices have tolerated much higher interest rates historically. And if rates are rising because the economy is growing and people are making more money, higher rates will be tolerated yet again. So this is nothing new. We've seen rates come off of emergency levels following World War II. Throughout the 1950s, interest rates rose. Stocks went up pretty much the entire time. There was one recession the whole decade. We saw rates rise throughout the 1960s. It was one of the best periods for stocks in human history. Rates rose in many periods of time where stocks also did okay. So a lot of this is a function of what else is going on, what are the other variables. So here's the big variable. The Fed thinks it's not going to have to raise rates based on its dot plot until sometime in late 2023. We all know that that's probably not going to stay that way, that expectation. When you look at the average economist talking about 6% GDP growth and the Fed thinking more like 4%, the truth is probably somewhere in the middle for this year. And it's probably more likely that we're talking about rate hikes sometime in 2022. So the market will have to adjust as those two opinions or data sets converge. And maybe that means a 10-year 1.7, 1.8. It's really not going to be a big competitor to people buying stocks instead of bonds until it gets closer to 3%. And I think if that's the reason why you're underinvested for your future right now, probably a mistake in the long term.
These same fund managers, are talking about 2%, Jenny, on the 10-year could be the level of reckoning. I mean, do you see this now as the biggest risk for investors, the trajectory of interest rates? Because there's so much optimism about the reopening, right? Josh has talked about it. We've all talked about it. We're going to go nuts. We can't wait to get out there and spend money and travel and do all those things we haven't been able to do for the last year. But with that comes the prospect of higher interest rates, which then forces someone's hand, perhaps, that affects the stock market.
Josh really nailed his description of it. And it's not about the exact number. It's not about 2%. It's not about 1.75. It's not even really about 3%. It's about how we get there and why we get there. And so let's say we're at 2.5% on the 10-year, but we've gotten there because we have a robust economy. Everything's going well. We're going to tolerate it. And then we're going to say like, oh, the next level is going to be 3% or whatever it's going to be. But we're going to adjust. It's all about the path. It's all about the economy, the economic support, the business climate that stands behind the number. It's not just about the number. I do think as interest rates go up, you see a shift in what's doing well. We've seen that really painfully, obviously, this year. So you see a shift. But I think it's tough to say interest rates have gone up, and that's caused a market correction. It hasn't. Guess what? The S&P's up 6%
No,
year
not
to date.
yet.
That's following a year where
Not
it's up
yet.
18%.
You're not wrong. I mean, it hasn't
No.
caused one yet, but you say it's all about the path. There are others who suggest it's all
what if
about
it
the
does?
pace.
So what if it does? Why is it so terrible to have higher rates and a stock market correction? You had one in 1994. You had a surprise rate hike from Greenspan because things were heating up faster than they had expected after very, very low monetary policy as a result of the SNL scandals and that recession in 90-91. So in 94, they have to raise rates. The market's caught off guard. The S&P corrects 20% and then triples. Who cares? Why is a market correction the end of the world? Arguably, we just had one in the NASDAQ.
20%. I mean, John Najarian cares. 20%. Just, okay. It's all good, Doc.
Oh, Josh, I guarantee, Josh,
what's
people
going to
will
happen?
be beating on your door if we see a big correction. If you see a 20% correction, Josh, people will be banging on that door. You talk about tolerance, and I agree that we can tolerate it, but I don't know that investors can, Josh. Investors are going to be pulling money like crazy if what you describe happens, because they are not very tolerant. And in
that's
particular,
their problem. That's because they're getting bad.
Well, but it'll be your problem.
That's because they're getting bad advice.
It'll be the stock market's problem. It'll be everybody's problem, Josh, because information
investors
moves
have
that
proven to us
fast
that they
these days.
Hold up. Let's not talk over
Guys,
each other.
investors have proven to us that they are tolerant. Sorry, they are tolerant. We tolerated down 20%
bought
for
it
the last 3 months of
time.
18.
Oh,
Yeah,
they may buy it
tolerated
again.
down
Let's be
20%
clear.
last
Hang
May.
on.
They're
Hang
going
on.
to cry.
Hang
Everyone's
on.
going to cry. It
Hang
hurts,
on.
but they tolerate it.
Hang on, please. Yeah, they may buy it again, but that 20% downdraft that Josh is talking about is going to feel like 50%. 20% is a lot.
Oh, yeah.
With the expectations of what's going to be happening in the economy and the feel-good, mojo that we're all going to have, Michael Farr, in getting our lives back, we're not going to be ready for a big market disruption. We're going to be thinking that, hey, life is good.
Ready for it?
Life is good. Why isn't the stock market going up? Michael Farr?
We're never ready for those big stock market disruptions, because when they come, there's always a story we haven't dealt with before. It's always the Fed's pushing something too hard, or there's something going on geopolitically that we haven't anticipated, and there are additional reasons for doom and gloom at those moments, which is how you get down 20 or 30%. They feel absolutely awful, and there's always but it's different this time kind of a moment. And Josh's point is the right point. This is when investors make their money. This is how long-term investors earn their stripes. And you endure periods like that. And the smarter ones out there and the more fortunate ones, sometimes I get lucky in those periods, and I'm able to buy when we're really down. I do have the strength and the tenacity and the gray hair to know when I should buy when they're down now. But I think what we're seeing, yes, there's a risk of this higher rate spike. In fact, if you listen to Dr. Jay Bryson at Wells Fargo, he says, look, over 6% GDP growth this year. Are you going to see this surge of inflation in August and September? Yes, you're going to see it. Will the Fed blink? Josh thinks yes. A lot of people think yes. But is it episodic? Does it just roll through the economy? No matter how I look at it, when I see $2.8 trillion in stimulus coming in a single quarter this year, with the government talking about more, I do not know how you keep stock prices down.
Well,
I think this market goes significantly higher.
Well, what one would think, right? Bridgewater today talking about the Fed's hand being forced as well. Let's bring in our Fed whisperer, if you will, Steve Leisman. He's our senior economics reporter. He's got his own exclusive Fed survey. He's with us. He's heard the conversation. And Steve, your survey seems to match up exactly with what some are worrying about today, whether it's the Bank of America fund managers or what Bridgewater is talking about, or even Morgan Stanley, of the Fed maybe coming in with a little more restrictive policy than people are ready for.
Yeah, they've definitely pulled forward the date of the first tightening. They think the QE will end this year in November. That's the average response. And they think the first rate hike comes in November 2022, rather than, if you go back 3 or 4 months, it was in the early part of 2023. But, I guess I wonder, Scott, what did you think was going to happen? If we're going to do 6% growth, And then you also have inflation ticking up. The average forecast this year sees inflation going from 1.7% to 2.4%. Certainly the 10-year is going to rise. And I think Powell means it when he says he wants to let things run a little bit hotter than they had in the past. And the forecast shows, Scott, that people don't think the Fed comes in until you're at 2.4, 2.5% in terms of trying to tamp down on the 10-year. He's happy to let it run. And it makes sense to let it run because if you have higher growth, a little bit more inflation, you should have higher bond yields.
Sure. And so, Josh, then this is much ado about nothing because 2.4, 2.5, we may not get there. Who knows? Maybe it's a year from now. So are stocks smooth sailing then until that happens? Until the Fed blinks or whatever you characterize it as and makes its very first move, is it smooth sailing for the stock market until that happens?
I hope it's not. I don't know why we were rooting for smooth sailing. There were 75 million millennials in the workforce. They're somewhere between the ages of 25 and 45. They are forced investors for the next 2.5 decades minimum at the high end. In some cases, 4 decades. They have no choice but to buy stocks. That's how the entire retirement system of this country has been built. So why would they be rooting for smooth sailing? Why would somebody who's 30 years old, who is forced to buy stocks for the next 35 years in a 401k, want all-time record high prices and no volatility? It makes no sense. It makes no sense.
Yeah, well, because
so
Jenny,
here's the question. Whoa. Here's the question. Where should interest rates be if the economy is growing 6%? We're going to get unemployment by the end of this year at the current trajectory down to 5%, which the Fed said is its target. And we're going to approach 2% this fall, hopefully, if we're lucky, in inflation. Where should rates be? Should they be at 0? Does that make sense to anybody that we should have emergency level overnight Fed funds rate at 0 with an economy growing at the pace that this one is growing? Of course rates should rise. It's not better or worse. It's just a different environment than the one we were in last year. The market will be volatile, it'll adjust, and then we'll live our lives.
Steve?
I think it goes without saying that during that process, you have volatility. And I think the members of this panel can speak about this more eloquently than I can. But you have volatility. Some people don't want to hold 10 years at 1. They do want to hold them at 1.5. And there's a bunch more going to hold them at 2 and more than 2.5. So those people that Josh is talking about are forced to hold equities. That number comes down, and you have stock trading hands to get into strong hands with higher interest rates and higher growth. At some point, the 10-year looks attractive to some people. By the way, it's worth pointing out rates are still negative around the world, so that does keep a cap on how high yields can go here in the United States because that'll attract an awful lot of foreign money at some yields.
It also influences what exactly I do want to hold, right? You were talking about holding stocks in general. Sure. Jenny, do I want to hold technology stocks at 2% on the 10-year, 2.2% on the 10-year, or do I need to be in cyclical stocks now in anticipation of the 10-year running to that and inflation running up to a point of where it starts to simmer a little bit?
This is where I hate painting in broad brush strokes. There's some technology stocks that you want to hold. There are some cyclicals that you want to hold. There was an interesting article out this week talking about how Willis Towers Watson, which is a big pension and endowment advisor, is starting to push their clients into active management and out of passive. And I think that's an interesting concept that we're going to see more of, because what it's saying is that it's not just own tech, it's not just own cyclicals, it's own specific companies. It's be a stock picker, maybe use an active manager if that's what works for you, and take advantage of individual companies who have the ability to outperform in the coming year. When I talk about tech, I can shun all the high-flying tech, like the DocuSigns and the Pelotons and the ones that are just trading at I don't even know, 1,000 times fake earnings. But then that's different. And even though I don't own Amazon and Google and Apple, I can say, hold those. You're probably going to be okay. And then this gets back to back to the path of the market. And is it going to be smooth sailing? Guess what? It's never smooth sailing. It's always bumpy. And so if it's always bumpy in the it's never smooth sailing. It's always bumpy in the short term. But in the long term, 10, 20 years, are Amazon, Apple, Google, Facebook going to be okay? Yeah, they're probably going to be fine.
That's fine.
It
But,
might
you know,
be bumpy in the short term.
I get it. And there are a lot of people who watch us who are invested for the next 10 years. And there are some people who are invested for the next 10 weeks or 10 months. Josh said there's going, Doc, to be an adjustment if rates continue to go up, if we start talking more about inflation. What's the adjustment going to look like? And what's it going to feel like? Where are things going to adjust in this market that our viewers need to focus on?
Well, the entire panel has said it's going to be uncomfortable. And sure, I do love uncomfort in that regard, Scott, because when people are not sanguine, when they're scared, that's when the opportunities present themselves. A year ago today, we were down 2,800 points in a single session. That is the sort of thing that, you know, we all worry about. Do we see that coming at us? No, not because of rates going higher, even though they go higher at a quickened pace. But one of the things we worry about, Scott, is that, for instance, Germany and France and the Netherlands pulling back from AstraZeneca. They were already behind in vaccinations. The fact that emerging markets, many of them, I know those aren't emerging markets that I just described, but emerging markets are having trouble getting or affording the vaccines. Now you've got developed markets in Europe that may be well behind us. They might be 6 months or more behind us, which does put a crimp in a lot of the growth prospects that we're hoping for. But it also might mitigate to some degree, Scott, some of that inflation. Because if Europe can't really participate because of some of the things happening over there with, again, that's the AstraZeneca, not Pfizer, not Moderna, not Johnson & Johnson. But if they back off from the vaccinations as they have,
right,
that might put a little bit of a lid on inflation because, again, those economies aren't going to rage like ours. So, you know, there's that push and pull that's going on. I'm not that concerned about rates where they are. I'm not even concerned with them at 2, but I am concerned that investors that think that they have the stomach for it will not have the stomach for it if we see massive disruptions, even though we're not thinking of the sort that we saw last year.
Everybody is gung-ho to go on the roller coaster, Doc, until the roller coaster turns you upside down and you start to get a little sick to your stomach. That's an adjustment, and that could be what people are going to have to deal with in terms of tolerance for what the market could deliver. Steve, the bottom line is it really depends on what the discomfort level is for Jay Powell and company and how fast we get to that point.
Yeah, there's a new relationship now between the bond market and the Fed, Scott, that is probably as much responsible for the rise in yields, and that's that the Fed doesn't have the bond markets back for the first round of inflation here. Indeed, the Fed has made a big change. It said it's going to go for inflation above 2%. It said it's going to be looking very strongly at getting back to work. Those people who are typically not even, I guess, even counted when it comes to thinking about recoveries. Minority unemployment is a big factor for the Fed. That tells the bond market that, hey, you're on your own for a little bit here. I don't think you're on your own for the long haul in the sense that if we have persistent inflation, bond yields that rise above a certain level that makes the Fed uncomfortable, I do think the Fed will act. But I think for the first round, the bond market's on its own.
God forbid.
That means the stock market has to watch its back.
I was going to say, God forbid the market has to stand on its own 2 feet for the first time in, you know, seemingly forever. So, Michael Farr, the best trade in the market right now, based on what everybody has said, sounds to me like it is large cap U.S. cyclical stocks. Am I wrong?
I think you're right, and I think it's some of those value names, some of the left behind names. I think if you think of Stephanie Link's 3 sort of legged approach that she's been taking for quite a while, some of the comeback stocks, some of those that have been left behind, and some of the leadership still make a lot of sense. I think, though, Scott, as I'm listening to Steve Leisman, Steve, I'm still kind of trying to figure out the real message from the Fed. On the one hand, they're still buying and they're still dovish and they're still accommodative. So they're not going away yet as far as the bond market's concerned. It's almost, when do they stop adding? When do they stop the repurchases? How do they message that, particularly if they see a 6% GDP year coming?
Well, the intent of the Fed chair is to message it such as a way that they do not create a taper tantrum. That is the first job of Powell. And he has also not a promise, but a forecast that the Fed is really going to hold on to those asset purchases. That they
can message that the right way. How do you message the taper in such a way that markets don't freak? Yeah.
You want my idea, Michael? I'm working on an idea here, and I haven't had a chance to flush it out fully, but I've got an idea. I'm calling it the taper and twist. It sounds like a dance. So what I think the Fed ought to do is when the Fed announces a taper, it would offer the chance or the potential for it to come in and buy the long end in such a way to limit any kind of tantrum the market may have. I don't know that Powell's thought about that. I don't know the Fed is thinking about that. But my thought these days is a taper and a twist so that the Fed does not repeat the mistake that happened in 2013 when the bond market went out of its mind because the Fed was thinking about reducing its asset purchases.
I still want to know, and maybe, Josh, take this first. For the next 9 months, like let's just, you got a lot of new investors in the market, okay? They're not necessarily thinking 10 years. They may be thinking 9 months. So given what you think may happen to the stock market, what is the best place right now to be? Is it, as I posed to Michael Farr, U.S.-centric large cap cyclical stocks, or what?
I swear I'm not trying to derail this conversation.
How about a stream in Wyoming, Scott?
Don't you recognize the incongruity of this premise? You have a lot of new investors in the market who are thinking more like 9 months. That's the problem. This ridiculous expectation that you're going to put money to work in March of 2021 and the world or the Fed or Jerome Powell owes you upside on that investment. Inside of 1 year, it's insanity. The problem that we have right now is that if you're a new investor, that kind of environment is all you've ever known, and you need to be disabused of the notion that that's all there ever is. You're going to be in drawdown. Oftentimes, that'll be the best time to continue to invest. But if you never see that, then how do you ever learn that lesson? I'm going to tell you something. We've had 15% average annual returns for the S&P 500 since the great financial crisis. That is an incredible period of prosperity for the market. I would also mention most of that period was accompanied by some of the most negative, ridiculously bearish commentary coming from everywhere from Wall Street to quote-unquote famous hedge fund managers, financial media, etc. But that's what it is. That's what the environment is giving you. You don't get that for free. So let's remind everybody, in 2018, with high GDP growth, fresh off brand new tax cuts, we had two massive corrections. One was 16%, one was 20%. You had to sit through those to earn that average annual return of 15% a year over the last 12 years. You have to learn to live with volatility. And this idea that we're going to avoid going from a recession to growth without any bumps in the road is childish. We've never had it. American investors have never had it. You're not going to have it this time either. You have to grow strong enough mentally to live through that and invest through that. Otherwise, I don't know what you're doing.
Of course. Well, those are great words of wisdom, Doc, but you may not get the kind of pullback that Josh says that would be good for everybody to have to go through, especially a newer class of investors, this cohort that has come into the market since the pandemic started. Again, I just go back to the original idea of pent-up demand. Josh has used the words, people are going to go nuts, right? I mean, who doesn't feel it? But is there an after effect of that on the stock market? Maybe there's not for a while.
Well,
maybe there just isn't.
Well, no, there will be, Scott. And one example is the $600 checks that everybody got, those STIMI checks that everybody got and spent in January. They just revised up that retail sales number for January to what, 7.6, Scott? Even though the February number was down, of course, the January number was revised up. Now, what happens when you get more than double that stimmy in this direct deposit that's happening as we speak, Scott? What's going to happen there? It's going to be spent in retail stores. It's going to be spent on Bitcoin. You bet it is, Josh. And I'm looking forward to that. I mean, my Bitcoin tripled, Scott, from the time that I told you in December when we were, exiting a lot of our stock positions, holding on to options, but exiting stock and buying Bitcoin. It has tripled. Will that happen with $1,400 stimulus? Yeah. Will AMC and GameStop, sorts of Reddit stocks, feel a lot of that love? You bet. Some of the more mature folks will do as Josh said, and they will regularly put money into the market rather than dumping it all in at once. But that is going to be what the tail end of this 1,400, Scott, is probably when we start feeling something that either makes Jerome Powell trigger finger get a little itchy or something, because that's going to be a big surge, this $1,400 surge that we're anticipating in many of those assets that I just described.
You can throw in, Steve, now Howard Marks, who is talking about the possibility of rising rates. He has his latest memo has hit where he says the biggest risk of all is the possibility of rising rates. I'm wondering, sort of, Steve, what you think the Fed is sitting back thinking about when they see the fact that in a year, we've gone from the depths of the decline in the stock market to now the S&P. We're talking about S&P knocking on the door of 4,000. We're talking about digital art selling for $40 million, and we're talking about these non-fungible tokens, NFTs, and sort of taking the world by storm, and Bitcoin at 60,000, and SPACs, and everybody's got one. Is that influencing the way they're thinking at all, or is his eye and it's just tunnel vision towards the ultimate end game of where inflation may go and how hot they're going to let it run?
I think there's two answers to that question, and I'll take the latter part first, Scott, which is when you talk about the SPACs and the NFTs and all that stuff, I think that represents a risk to the system that we haven't talked a lot about, which is, stocks may be, at least in terms of losing all your money, the safest place to be, or banks in terms of losing all your money or creating systemic risk. I think the banks are in pretty good shape. It's all this stuff that's outside the regulated system. Remember, that's the stuff that bit you the last time around. It was the CDO squareds and the SPVs and all those funky initials that really came and brought the economy down. I don't know that we talk enough about that stuff that's outside the system. As for the Fed, I'm a little confused about Fed policy right now, Scott, and I have to admit it. I feel like Powell and the Fed have drawn too bold a line in terms of not ending quantitative easing. I think they could have and should have been coming out of this $120 billion a month of purchases, a lot earlier and not really drawn that hard line. So I think they may end up doing that sometime this year.
Well, when you say, when you go on television and say you're confused about Fed policy right now, Steve, that says a lot more than just that one little statement. It's interesting to hear you say that. It's been good having you on. We'll talk to you again soon, Steve Leisman. Thank
Pleasure.
you. We're
Thanks.
taking a quick break. Only one person on the investment committee today is making a move in the market, a stock they're either buying or selling. We'll talk about it next. And what is the statement in and of itself? We will talk about that next. A reminder, you can always watch or listen to us live on the go on the CNBC app. We're back on the half right after this.
I'm Courtney Reagan, and here's your CNBC News update at this hour. New York Attorney General Letitia James says she's disappointed in Purdue Pharma's new $10 billion plan to exit bankruptcy. She says it's an improvement over a previous offer from the OxyContin maker, but lacks accountability and does not do enough for victims of the opioid crisis. In Myanmar, thousands of residents are fleeing an industrial zone after security forces killed more than 30 protesters over the weekend, and 5 Chinese factories were set on fire. At least 2 more protesters were killed by police today. After a month in the hospital, Prince Philip has returned home. The 99-year-old royal was treated for an infection and underwent a heart procedure. Well, Israeli archaeologists have announced dozens of fragments of new Dead Sea Scrolls. The fragments are believed to be about 2,000 years old and are the first such find in 6 decades. That stuff is fascinating. Scott, back over to you.
All right, Court, we appreciate that. Thank you so much, Courtney Reagan. All right, Dr. J. So Apple has a new target at Evercore. It ties a street high, 175. That's from 163. That's about a 38% move higher. I mentioned only one person on the show today had any moves, which was surprising to me in and of itself. The fact that you really only have 1 or 2 moves is equally as surprising because you're normally pretty active. Maybe not as active as your brother, but awfully close. When you've added to your Apple calls, what's that about?
Yeah. Well, Scott, just as you say, they got some targets raised over at Apple. 30% upside from here is what the note said. And we noticed immediately, starting right at the opening bell, that they were buying the 127 calls in Apple. So I joined them. They traded 72,000 of those in the first hour and a half or 2 hours of the day, Scott. That's extreme even in Apple's case. So I added to my exposure in Apple at that strike. I'm not so much chasing that 30% upside as I am trading a short-dated option just for the pop. It's already doubled, those calls have today. And I'm looking for, just the chance to get in there and keep selling upside calls against stock that I own, Scott, although it's not as attractive with the VIX breaking down to 19 and so forth, even though that's the overall market VIX, not Apple's VIX. But I like it, Scott. I also took some profits in AMD. We talked last week about the unusual activity and that they had that big meeting yesterday. So I took a little off in AMD. I put that back to work in Apple.
All right. Appreciate that, Doc. Thank you. All right. Let's talk about Starbucks today. That stock has hit a new all-time high. It got upgraded at BTIG. Street high price target goes to 130. We've made it our call of the day. Josh, you've been all over this for many months. What do you make of this call? It's a stock that you own. The average price target is now 113 on the street. Again, this goes street high 130.
Yeah, I had a really interesting conversation with a chief strategist at one of the big banks on the street, and he said something that really stuck with me months and months later. Just this idea that bad things are going to happen, like the pandemic, for example, but that CEOs are just going to sit back and take it and weather it and just do their best to muddle through. Nobody who makes it into the CEO chair at a Fortune 500 company is going to sit back and take anything. These people are type AA.
All right, guys, let's see what we're looking at here. It's 11:30, so 12:30 in the East. So all these dudes are probably at lunch right now, but let's see what's happening during the lunch hour. I've seen GameStop up and down since its low this morning at 172. It spiked way back up to 210. So if you got to take that right, good for you. Congratulations. But it's gone back down to 195. I've been just keeping over here FTCV after the call this morning on CNBC. It rode up a little bit, but it didn't do a whole lot. It was basically that call was, let's see, that was not what I wanted to do. That call was at 9:30. Yeah, it was this one right here. So they were on CNBC this morning. Didn't do a whole lot, and it went right back down. Didn't do a whole lot, and then it went back up again. Honestly, I don't know. Look at all this volume here at about 10:30. Probably also went on TV and did another interview on a different channel, and that's what got this going. And this is more like yesterday's surge that we saw with Ava. and it's been then now hovering up at the high 13s ever since. So, again, if you guys were watching me around 9:30 when they first got on TV, and I saw what the company was, I'm absolutely on board, and I bought some shares just to flip them same day because I was hoping it would spike up to 16 or 17 like it did yesterday with Ava, but it did not. So if you don't know, this FTC is an acquisition. It's a SPAC that is merging with eToro. So eToro, the online trading platform, is going public through a SPAC today, and that's what this is, FTCV. You'll see before that, if we go out to a 10-day, it was doing nothing like most SPACs do, just hovering around 10 until there's an announcement like we announced today. So that is what that is if you weren't watching earlier on CNBC. But it looks like they must have had another interview here because the volume just went through the roof. Maybe they had one there and then another one here. Because look at, you zoom in just the day. If you look at, they had a huge volume spike there and then it went down and then another volume spike there where, again, up to 1430-ish. So I had a really good surge there. And it's been hovering right there. So in the high 13s is not a bad price. Again, I don't know the long-term fundamentals of the stock, so I'm not at all recommending it. It was just a matter of that social sentiment of hopping on the train when they're on TV between their 3+ interviews that they're going to do on the first day of trading, with only the intent to flip it on the backside. So we'll see what happens. I'm going to be watching it through the end of the day. I might end up bringing down my sell order to a 14.9 or even a 13.9 just to get out, make myself, $100 or so, and then sell it. Sometimes that is what the motive is here on day trading is you get in, put a few $100 in, ride the wave, sell it, make $100, put it in your pocket, and then move on to the next one. I don't do a ton of day trading, but when I do, it's usually on those types of situations. I don't like to day trade the leverage stocks that often unless I just see something incredible happen. And I get in and ride that momentum up. So um, on the other meme stocks here, the question is, did the same thing happen today? It happened yesterday. So this was again right at about 10:30, really almost the same time as yesterday. And then this dip happened at 9:30. So what was this call? So this spike happened at 9:30. And it hit the peak, I guess, right at 9:30. This bottomed out right at 9:30. So you might have gotten a little bit of that same action we got yesterday from Ava. Not as extreme on GameStop and Ava, but a little bit there again. The spikes at 10:30. This 10:30 GameStop is right here, so nothing dramatic. And then this spikes at 10:48. And then 10:48, that's almost, so you might have gotten some of that, some of the same action we got yesterday, especially on the 9:30 and the 10:48 spikes over here, translated into a 9:30 and a 10:48 valley over here at GameStop. So a lot of the same people are watching TV and doing the same thing I'm doing trading, but what they're doing is they're selling their GameStop shares in order to have the cash free available to go put into this SPAC. Same thing happened yesterday with AEVA. And it's happening again today with FTCV. So very, very interesting stuff that we're seeing. Ideally, I would imagine that is just from retail traders that are on Reddit or just watching CNBC, and that's the news that they're getting and getting all their trading advice from, which again is fine as long as they know what they're doing. They have to know that once they're on TV and then they get off TV, there's a good chance that stock's going to just float down for the rest of the day. Let's see what, speaking of AEVA, let's see where it is today. So I'm going to go out to the 5-day, no, not 5, let's go to 5.5. So here's the spike yesterday when it was on TV, then it floated down for the rest of the day. Had another spike late in the day, probably because either they were on TV again or just a lot of people that bought over here were selling off before the close. And then it floated around here, and then it's dipped again after open, and then up and down ever since. But it's still higher than it was. So I put in a buy order yesterday at 13. It never got back down to it. Or no, sorry, it was at 12. Never got back down to it. It got to, no, sorry, it was 13. My mistake. It was 13. It got back down to just over 14, but never went down farther. That buy order expired. I didn't renew it. So I still think this is a good stock, but I think it's just overinflated due to the momentum of the SPAC being launched and it being on TV. I think we're seeing the same thing with FTCV. Same deal, as you can see, it's spikes because of this this public announcement. If you got in down here at 10, good for you. But I think it's going to trail down to once the traders get a hold of the fundamentals of the stock and really find its value, it'll probably go down. So that's why to me that's a day trading opportunity, 1 or 2 days at the most, and then it's probably going to go down until it finds a home and its real value, kind of like what we've seen with CCIV. And now CCIV is actually on its way back up. It's around 30. Once people got surprised by what its valuation was after the SPAC was announced, you saw it tank just like this. It went from, heck, it was up to 60, I think, at one point. It went all the way down to the low, right at about $20 a share. So that's what we're seeing with some of these. Looking over here at the rest of these guys, we got Express, GameStop, both making a little bit of a run here. So that's good to see. AMC making a very slow run. Nothing really worth getting excited about. Very, very slow stair step. But if they can get back up above 14, I'm going to be happy. But right now it's below 13. Express, again, I want that over 5, 6. GameStop, it's just going to be a day of runs, I think. And it's back up to only 8 below. 201. Bottomed out at 174, 172. So, if you got in at the bottom, good for you. You've gained, what is that, 15, 20%, depending on when you might have sold it or what you currently have in it. So, interesting day of volatility for GameStop. So, if you're in the market to just intraday and just take advantage of the volatility, you might actually make some money. Anyway, let's get back to the news.
By video, we will play it on the air. Email us, askhalftime@cnbc.com. We're back right after this. Ask Halftime time right now. Josh Brown, you are first, and I love the question because it's one I've been wondering about myself and would have asked you about anyway. Adam from the United Kingdom wants to know about CrowdStrike. Is it still a buy?
Hey, Adam. So I'm in the stock from lower levels, and I don't think that I would buy it today going into earnings because, as we've seen from Snowflake and other high-flying, expensive growth stocks, even when they report great results, you don't always get an instantly good reaction in the stock price. So if anything, what I would do with this situation, if you're not in it, is look for the company to report a number that doesn't wow the street. And if you really want to be a long-term investor, I would take advantage of that type of dip and buy in. But going into the earnings, very, very risky strategy. I don't have any edge on what they'll say tonight. I'm hoping for good, but expecting the possibility that it may also be volatile afterward. And I will react rather than try to react in advance. And that's typically been the way I've played these types of stocks.
Adam should watch Mad Money tonight, too, with Jim, because he's got an exclusive with the CEO of CrowdStrike. So that's very timely. Adam from the UK, tune in. There's George Kurtz is going to be on with Jim a little bit later. All right. Jenny, to you from Sandy in Colorado. I'm underwater in Magellan Midstream Partners. What do I do? What's your outlook now?
I wouldn't worry about being underwater on this one. I've owned it since 2006. They've paid and increased their dividend for 18 straight years, and they own 9,800 miles of refined product pipeline all throughout the Midwest. So until farm trucks and equipment and tractors and trailers are all being powered on sunshine and wind, there's going to be huge demand for Magellan's pipelines and the energy that it transports. I would stick with it. It's almost a 9% yield. The yield alone is going to get you out of that hole.
All right. Good stuff. Dr. J, to you. John in New York. Another John in New York. What's your take on Palantir? You got, Karp, the CEO, is an exclusive today on Closing Bell, so we're excited about that. You own the shares and the calls, so you should have a good opinion on what you think. What's the deal?
Right. Well, Scott, I couldn't buy it on the IPO, but I bought it right after that. I thought it was vastly undervalued where it was delivered to the market. It had tripled since that level, and now it's pulled back to around the 25.70 level, I think, Scott. 25, John, should be pretty decent support. 22.50, very strong support. When these guys get contracts, they are huge, and they're very actively out there looking for those big contracts. They're elephant hunting. I'm sure Mr. Karp will talk about that on Closing Bell. I will be tuned in for that, Scott.
All right, his conversation with Wilf, one we're looking forward to. All right, Michael Farr, Edward in Alabama. CVS has an attractive valuation. However, since I use Amazon instead of drugstores and grocery stores for my RX, the future seems dim. Is it investable? Inquiring minds want to know, Michael Farr.
Edward, this is one of the most frustrating positions I own because it's one of the cheapest, best, greatest kind of companies on paper I can find. I just can't get the performance out of it, but I'm holding it. I would buy it today. 10 times earnings, growing earnings at 10%, 2.75% dividend, and 70% of the people in this country live within 3 miles of a CVS, and they're all going to go there to get their vaccine and buy stuff as they walk in and walk out. I love this company. I just need to see the stock performance get better.
All right, good stuff. Thank you for that. The 10-year yield, it's holding at about 1.6%. The two-day Fed meeting is kicking off. We'll find out how the futures traders are playing that. We'll do it when we come back. There it is, 161. We said it was on the cusp of that at the top of the hour. We're back in 2. It's time for the futures outlook. Treasury yields, they are edging higher as we speak as that two-day Fed meeting begins. Scott Nations and Jeff Kilberg are here with us now. For more on that move, do you have where's the direction here now, Kilberg? We have too much momentum to the upside? Is Jay Powell going to say something today or tomorrow that's going to make the difference here?
I think he is. I think he talks and walks yields down. But similar to the fireworks we saw at the beginning of your show, talking about 20% pullback, I want to stick with that 20% pullback theme, but I'm going to apply it to the 10-year note. I'm looking for yields to go back down to 1.28. And how are we going to get there? It's an old vernacular from the floor, Judge. It's back and fill. I think on the charts, we saw those futures sell off dramatically. And of course, futures are inversely related to the yield. So I think we see a back and fill up higher in the futures, which is going to bring those yields down. But yes, you're absolutely right. Fed Chairman Powell, he will be the catalyst.
Okay. Scott Nason, is that how you see it? Yields coming down? He's going to talk them down?
I'm looking at fundamentals, Scott. And Killer and I could not disagree more on this one. And I think it's all about supply. When you look at the fundamentals, it's about time. Last week we had huge supply, well more than $100 billion. Today we're going to get a one-off 20-year, $24 billion worth of that. And Scott, on Thursday, we're going to find out what they're going to sell next week. And because the longest duration, longest maturity next week is only 7 years, the total number for next week could be $150 billion. That would be huge. And so I think supply is going to depress bond prices, and that's going to increase yields.
All right. Most important conversation, arguably, right now in the market. Guys, thank you. We'll talk to you again soon. We'll do final trades next.
All right, guys. Tendies. Buffalo chicken bites in a wrap. Got my tendies.
Final trade time. Jenny, you're up first.
Unum, 6 times earnings, 4% dividend yield. As unemployment goes down and interest rates go up, it's nothing but positive for this company.
Okay, we will keep our eyes on that one, down about 3.5% today. Mike, go far.
I like Truist. It's the merger of SunTrust and BB&T. It's got a 3% dividend. It's a little weaker today. This gets a 6% GDP growth. That's loan growth. This is going to be good for banks.
Yeah, pretty good environment for banks if rates continue to go up. That's for sure. Mike, thank you. Dr. J.
I talked about the semis earlier, Scott. Taiwan Semiconductor, also on our unusual activity scan. I added to that one today. I already owned it.
All right, the TRB.
Alphabet, best looking chart in all of large cap tech, going higher.
All right, everybody, thank you. Let's get one more market check, too. On a day, the Dow's been up for 7 straight days, got a little bit of work to do. S&P sets a new intraday high. We're watching the 10-year as well at 161. That does it for us, the exchanges now.
Hello, everybody. I am Brian Sullivan. Here is what's ahead on the exchange. Get ready for tax hikes with stimulus done and infrastructure on the books. Is there any way to avoid the IRS coming for you? Biden advisor Jared Bernstein is here. Hot stocks on fire. More states considering legalization. We'll speak with cannabis company Columbia Care about the industry following another record year. And 2021 Players Champion winner Justin Thomas will join us. His win, his investments, and how the game has changed 1 year after the pandemic began. Plus, rapid fire, all coming up. But right now, let's kick it off with the markets and your money and another guy who's got a pretty good short game. One that I saw myself, and he beat me by like 32 strokes. Dom Chu is here now with Don't Rub It In. We'll play again.
We will play again, but here's what I would say. I think you're embellishing it just a little bit. We had a competitive round on your home course. We'll do it at my home course the next time. We'll see what happens. But yes, the short game aside, this is what's happening with the markets right now. Very balanced. You could call it a holding pattern, if you will. If interest rates really are the driving force behind a lot of the volatility, it would make sense for some traders and investors to wait for a for-the-record statement from the Federal Reserve later on tomorrow before they do any kind of real movements in their portfolios. Hence, you've got a Dow that's down just about 1/3 coming from record highs. The S&P 500, again, near record levels right now, 39.71, and the NASDAQ Composite up about 2/3 as well. A couple places to watch in the market right now. Check out what's happening with the retail-oriented stocks, because we got a weaker than expected retail sales number earlier this morning. Weather somewhat of a factor, but it's given some traders and investors a reason to take profits in a very winning trade over the last several months. Darden Restaurants is coming off record highs. It's off about 4%. It owns the Olive Garden. Tapestry, another retail-oriented company, off about 2.5%. Ralph Lauren off 3%. And the overall retail ETF, the equal weight XRT, that's the ticker, off about 2% as well. Caveat there, GameStop is a huge part of that particular trade. And then a winning trade as of the last couple of weeks. Check out what's happening with the semiconductor stocks, because they were leaders on the way down from the recent highs, and they've bounced back. The semiconductors ETF ticker SMH actually fell by about 16% from recent highs to lows. It's bounced back 11% now. But look at the ETF there. Applied Materials, one of the biggest gainers in the S&P today, and Micron as well. All of these on a year-to-date basis have recovered pretty strongly from their recent highs to lows back up to where we are now. So, Brian, retail and semiconductors, and I'll be watching for any tips on the short game from Justin Thomas later on. We'll see you.
All good stuff. 3 for 3. Dom Chu, wouldn't expect anything less. And by the way, that's about what he beat me by. Dom, thank you. Okay. All right, on a more serious note, the $1.9 trillion American Rescue Plan just beginning to find its way into the economy and to your bank accounts. And as the ink dries on the bill, the administration can now turn its attention to infrastructure and potentially taxes. Joining us now to talk about it is Jared Bernstein. He is a member of the White House Council of Economic Advisors. Jared, it's good to chat with you again. There's so much to unpack here. A lot of headlines about potential stimulus and about the potential for either corporate and or personal income tax hikes. What can you tell us? Are tax increases on the way?
Well, let's not get too ahead of ourselves here. I will speak to that question. It's a good one. It's an important one, and I have an answer for you. But as you said, The American Rescue Plan has been legislated. It is now upon the land, and we're talking about 100 million shots in arms and 100 million checks in pockets. That's one of the president's near-term goals. His Help is Here tour is out there today with the president and vice president out in the country explaining what this package is going to do, emphasizing small businesses today with $15 billion in flexible grants to some of our smallest, most severely impacted businesses, many of whom have been left out by earlier parts of the measure, including $28 billion for a new grant program to support some of our hardest hit small restaurants, areas that were hardest hit by the pandemic. Now, what you're talking about, this is deficit finance. What you're talking about is building back better, infrastructure, clean energy, more permanent programs in the child care and elder care space. And the president has consistently said that permanent programs should be paid for to enhance their fiscal sustainability. And that is the future agenda. We're not there to unpack it yet, but that he has been forthright about.
The $25 billion for restaurants, Jared, let's focus there. And I understand how legislation works. It's very hard to use a scalpel when sometimes all you have is a sledgehammer. I get it. However, was there any discussion internally about, instead of $1,400 for everybody, where the majority of American families, let's be honest, they don't need it. They don't need it. That's not me. That's Goldman Sachs, Deutsche Bank. There's 30 million families that desperately need more because they were wiped out. Is there any conversations about, as opposed to $1,400 for everybody, $10,000 or $20,000 for those in restaurants or others that got obliterated?
So I think we have kind of a fundamental disagreement on the targeting of the plan. It's not 28 billion for all restaurants. It's 28 billion for the hardest hit restaurants. And if you look at the checks, I've got a number for you to throw out that I don't think has been widely appreciated. The Tax Policy Center, which does, really top shelf work on this kind of distributional outcome, they found that the after-tax increase for families with kids in the bottom fifth, so the bottom quintile, their after-tax income increase was 35%. For the middle class, 9%. For the top 1%, 0%. I consider that to be targeting that is very much commensurate with who's experienced the pain of this pandemic and who still is, particularly in the small business sector. Paycheck protection programs, of which the rescue plan adds over $7 billion, that's not reached the kind of mom and pop, small businesses, black and brown entrepreneurs that the president has pulled for ever since he started talking about that. And so that's another improvement here. So I think the targeting is better than your comments suggest.
Well, okay, but Jared, you came on an economics program. You're going to deal with people that actually understand the tax code, as I do, and I will tell you this: what you're saying is correct. Obviously, I would expect nothing less. But there's a difference between the stimulus checks and the increase in the earned income tax credit. It's not only size, but its availability. Those, I think, are more factored into the numbers that you are referring to, which is that EITC aid, not only for people with kids, but people without kids. It goes up and it expands it. And most people I talk to in DC believe it will be extended forever. Have we seen the beginning? Maybe these are, I don't know, dirty letters for you, Jared. Have we seen the beginning of a universal basic income?
Well, no, in the sense that I was saying before. I take universal basic income to mean universal. Everybody gets, something like the same amount. But of course, the packages that we've been talking about all have phase outs. And in fact, in the final deal in the Senate, the phase out for the checks actually became steeper. So again, if I'm talking about the Tax Policy Center numbers, those are all in after-tax numbers. I'm not pulling out the checks or the unemployment or the EITC or the child tax. That's all in. 35% for families with kids, boost in after-tax income in the bottom fifth, 0 at the top 1%. That doesn't sound like universal basic income.
Well, I don't even mean in a bad way, Jared. It's certainly there has been many other people who you've seen who have suggested this is sort of the way into that as well. Whatever, people may love it, they may dislike it. Either way, let's be clear, it does help those people in need a great deal. Agreed on that. Well, I'm going to ask you to step outside of the federal government a bit. You know as well as I do, you can't grow an economy until people can go to work. Millions of people can't go to work because their kids can't go to school. I understand these are state and local decisions, Jared. I get it, so you may not want to go after them. But has there been any conversation from the top levels of your office or the White House or anybody to schools that remain mostly or entirely closed and said, what do we have to do to open you back up?
This is such a great point. You couldn't be more correct. And it's a point that's getting a little bit lost as everyone's kind of looking around the next corner at reopening, re-engaging with commerce. There's actually a lot that has to happen between now and then. And this, again, is where the American Rescue Plan comes into play and where the Help Is Here tour that the President and Vice President are out on are touting precisely this. They're not going out into America just to sell the plan. They're going out there to talk to the folks who have to implement it. And in fact, we've made an increasing emphasis on implementation recently, getting Gene Sperling on board, who's going to help with that. It's a very important part of the plan, something Biden has muscle memory of from the old days back in the Recovery Act. And when it comes to safely reopening schools, when it comes to controlling the virus, when it comes to the fundamentals of producing and distributing the vaccine, we have to work from federal to state to local with, really a granular touch there. And it's something the president did when he was the vice president. And again, it's part of his muscle memory. We don't get from where we are to where we need to be in terms of launching a reliable recovery without those steps, Sully.
Well, how do we do it then, Jared? I mean, 30% of schools never closed in person. That's the dirty secret that you don't read about in the media. 42% of kids are in school, I think, almost all day, or at least most of the day around the United States. I'm talking about public schools, not just private. So how do we get LA and
you're
others
asking the right question
to open up?
You're asking the right question. So here's the answer. You're asking the right question. This has to be done on a granular kind of first touch scale. And that means that federal authorities cannot do what the prior administration did, which was to kind of say, state and localities, you're on your own. We have to work with them logistically. And if you listen to Jeff Zients, who's in charge of the virus logistics, along with a large team of folks, that's what you're hearing. And we have the same processes in place for safely reopening the schools. We are meeting consistently with all the stakeholders, governors, mayors, by the way, who disproportionately have consistently, Democrat or ours, D's or ours, have supported this aspect of the American Rescue Plan to make sure that we implement the plan in the most effective way. We have to work with the teachers' unions. We have to work with the superintendents and their organizations. All of those groups are part of these logistics. Now, I'm not saying that, the president is meeting with every school board in the country, but he is certainly instructing his lieutenants to make sure that we're taking that kind of logistical approach that's heretofore been lacking.
Well, listen, for the kids and for the safe return of teachers, I hope that certainly we can do it because many districts have proven that it can be done. Let's hope it can be done. Jared Bernstein, we appreciate your time, Jared, taking some tough questions. Appreciate it. Speak to you again. Take care.
My pleasure. Talk to you soon.
All right. A news alert in the bond market right now. And by the way, one that could move stocks as well. This one, a 20-year auction. Let's get over to Rick Santelli for the results now. Rick, a lot of people watching that yield outcome.
Yeah, very unlike that 7-year auction about 3 weeks ago. That was a real nasty one. This one was a spectacular auction. 24 billion, 20-year bonds. And the neat part about it is it's the 11th auction. So the 10 auction averages are strong and in place, and pretty much we beat them across the board, whether it was bid to cover at 2.51 or indirects, directs, everything was solid in this auction. Dealers only take 21.6%. The yield, 2.29, a full 2 basis points below where the when issued market was trading. Lower yield, higher price, zoom, zoom, zoom. As I said, I gave it an A. Most likely you're going to see a little bit of a dip in yields as we see right now from 161 down to 159. Just because there's a bit of a tailwind. It's a single standalone auction. It was well bid, and it really does accentuate this notion that the Federal Reserve and the markets aren't necessarily on the same page, but for this particular auction, it certainly seemed like investors are buying into the notion that doves will fly tomorrow. Brian, back to you.
Well, they better get it right. First off, you don't see a lot of A's from Professor Santelli, and tomorrow the Federal Reserve on notice. Bond market has spoken. Rick Santelli, thank you. A rare A. Appreciate it. All right, well, you may not realize it, but 1 year ago today was the peak of the market pandemic panic. Really the true realization of what we were up against, kind of hitting us, punching us all in the face, and hitting stocks and the markets in a big way. And if it seems like 1,000 centuries ago, here's a reminder of just how recent it really was.
As the president was speaking, the markets were closing, and it was an ugly, ugly close. Worst point decline ever for the Dow Jones Industrial Average, finishing lower almost 3,000 points. A decline of 13%. For the S&P 500, down 12%, making it the worst day for stocks since 1987. The Nasdaq falling 12.3%, and the Russell 2000 index of small caps down 14.3%. Every group got battered on Wall Street.
Yeah, I mean, look at those percentage declines. Hard to comprehend now, but 1 year later, we're at record highs. Not only have we recovered all that and more, we are at record highs for many of the indexes and individual stocks. The markets and smart investors realizing last year that the combo of the pandemic that will come to an end, and trillions in government spending, what we just talked about, should send stocks soaring, and they have. So let's talk about where we go from here. Joining us now, Tracy McMillan, Head of Global Asset Allocation Strategy at Wells Fargo Investment Institute, and Jeff Crumpleman, Chief Investment Strategist and Head of Equities at Mariner Wealth. Tracy, I'll start with you. Not going to ask you to relive 1 year ago. I mean, I was there. We were on air in a studio. Barely remember it at that point because it was so dramatic. What was the turn like around the summer or fall when everybody started to become more bullish? What was the basis behind the thinking that the markets ultimately and the economy and our lives will recover?
Yeah, so we've certainly come a long ways from where we were a year ago. While we expect, growth to accelerate to 35-year highs this year, it really was not at all clear back then in March. And I think the turning point was really in November when we got the news of an more effective vaccine than we even imagined. So, backing that up a couple months to your time frame, I think that was really when we started realizing that we were going to get a vaccine. We were starting to get more information about the illness itself, and we had that timeline in mind of when we might get back to some semblance of normalcy.
Yeah, and those vaccine news, I mean, honestly, hard not to be a little bit emotional about that, Jeff, when that occurred and watching the vaccines roll out. And it looks certainly like they are working with cases, hospitalizations, and deaths way down. Let's keep our fingers crossed that with the variants and everything, that certainly continues. It looks like it will. Let's hope. Only the future will tell us. That said, when we look to invest out into the future, that recovery already appears to be priced in. Now we actually have to look at the next 3 to 5 years, maybe on their own, albeit with a little help from the Federal Reserve. What looks attractive still to you and your team?
Well, at the macro level, I would agree that the fundamentals, the valuation levels, which are reasonable, fundamentals that are really strong with the economy and earnings are very positive. And technically, if you look at the breadth of the market, the leadership in the market that's more aggressively oriented, not in the defensives, that, the outlook still looks very favorable. And we maintain a positive view because of, this data. And at the micro level, it's just really hard at the macro level to be bearish at this point with favorable fundamentals, the valuation that's reasonable, and the positive technicals. At the stock level, we're very interested in those areas that benefit from reopening, secular growth, and we think a balance between value and growth is very important right now. Not just a run to value and reopening, but some of those same drivers will also benefit secular growth stocks as well. So we think balance is very key, and some of those secular growth stocks are on sale. Albeit we find attractiveness in some of these reopening plays as well.
Tracy, we're rich as a nation in so many ways. We're rich in vaccines. We are the most vaccinated large nation in the world, second by population percentage among large countries. A lot of the world does not have our resources or access to vaccines. They will eventually. So do we look to emerging market investing with the idea that they will also have our path from a vaccination and a case reduction perspective? It just unfortunately may not be where we are now.
Sure. So we do think that emerging markets presents an opportunity for investors here for the reasons that you've elaborated. Plus, we think the reflation trade is also going to be a tailwind for emerging markets, and also commodities. Commodities increases in prices could also benefit other parts of emerging markets. So there are several reasons why we favor higher beta parts of the market, including emerging markets.
Tracy and Jeff, wish we had more time, but we'll get you back both on soon. I'm sure there's a long way to go and a lot of questions that still remain. Have a great day, though. Talk to you soon. Take care. All right, on deck. Are more states ready to legalize pot? The CEO of Columbia Care is here. We'll talk more about it. And coming off his championship win, golfer Justin Thomas will join us. We'll talk about the changing face of sports 1 year into the pandemic and the advice that Tiger Woods gave him before his victory. The Exchange. Back after this with the Dow down 100.
This is The Exchange on CNBC.
Well, share of cannabis provider Columbia Care higher after reporting results. Stock ticker CCHWF. The company went on a shopping spree last year, buying up dispensaries in California, Colorado, as well as buying Greenleaf Medical. The deal will make it one of the largest cannabis operators in a number of states that now expect revenue to double this year. And that's not even taking into consideration the possible legalization of cannabis in many other states and the legalization of pot. here in New Jersey. Joining us now is Nicholas Vita. He is the CEO of Columbia Care, based in New York City. Nicholas, thank you very much for joining us. If you had to pinpoint a date at which the majority, there'll be a few that may not do it, but call it 40 states legalize cannabis in some way, any way to pinpoint when that might be?
You know, I think that it probably happens before you have federal normalization, so there's a lot of road to hoe. But we already have most states either with programs in existence or that are considering some form of program to be launched. And so I think it's just a matter of a brief period of time.
Well, I'm sure you're talking to lobbyists and people in a variety of states. I mean, even the states that haven't come out publicly, are you getting the sense, are you getting the word, maybe the back channels, that there are many more states that are considering this possibility because they don't want to miss out on tax revenue when somebody wants to drive 15 miles over the border to the neighboring state?
No, that's a great point. And I think compounding that is the fact that states that could create their own laws are able to preempt federal lawmaking and federal regulations. And that's very important in terms of establishing an ecosystem that the states can manage, can really drive employment from, and can really drive tax revenue from. Every single state in the country, because of COVID, because of what you hear all the time, is looking for ways to increase their availability, not only of good jobs, but also tax revenue. This is the way to do it. And it's a program and it's an initiative that's really found its feet. And I think that you're seeing resounding support on both sides of the political aisle.
You got 12 analysts that cover the stock on the sell side, Nicholas, and their average price target's about $3.50 above where it is. The point I'm making is you've got sell side coverage. This is not some sort of outcast industry anymore. Do you feel like Wall Street has stepped up? Do you feel like you're getting the appropriate representation on the sell side, on the buy side, that funds are saying, you know what, we may not have bought a quote pot stock a few years ago, but we will now?
So I think you're seeing a lot of structural changes in the financial services environment. The U.S. investment banks really haven't played catch up, with the exception of, say, Cowen and a couple of others. But as we look at the landscape, I think what's fascinating is that we've always had a very institutional bias from a capital structure and from sort of an operating perspective. We had our first $1 trillion U.S.-based mutual fund make an investment in the company just a few weeks ago. We were the first plant-touching company that this particular mutual fund decided to invest in. And I think what it shows is that the velocity of the capital is finally going to start piling into the industry, and people are going to pick their favorites. We were very fortunate to be in the position to be the first. We definitely don't think that this is the last such type investment that you hear about or that you see, but it really has been meaningful.
Nicholas Vita, CEO of Columbia Care, showing that's up 10%. Everybody else is down today. Nicholas, doing something right. We appreciate you coming on. Have a good day. Good luck. Take care.
Thanks a lot. Take care.
Thank you. All right, coming up, what do Lady Gaga, Michelle Obama, Meghan Markle, and Walmart all have in common? Here's a hint. It has to do with fashion. Story coming up. And move over, Robinhood. There's a new trading app in town hoping to mow down the competition. The story of eToro coming up. Dow down 106. We're back after this. All right, welcome back to the exchange. Well, overall, stocks are mixed. The Dow is down for the first time in 8 days. Yeah, the market is down for the first time in more than a week of trading. The Nasdaq, though, continuing its recent bounce back. All this, the Federal Reserve kicks off its two-day meeting today. Of course, their decision on rates tomorrow. The bond market, as Rick Santelli told you, expecting a very dovish outcome. If it doesn't get that, you could have a taper tantrum. It could hit stocks, but we'll have to wait and see what happens at the Fed tomorrow. Let's check the stock sectors. IT, comm services, consumer staples, all your leaders. Financials and energy, which have been leading the market overall this year, are some of your bigger laggards right now, though none are down too much. Energy down a little over 2%, but on top of what's been a big-time year. Now, let's get to Courtney Reagan for a CNBC News update. Courtney.
Hi, Brian. Here's what's happening at this hour. A lawyer for a former police officer charged in George Floyd's death wants the jury to hear about a previous arrest during which Floyd was found with drugs. A prosecutor says it is an attempt to smear Floyd's character. For all the latest developments on the trial of Derek Chauvin, watch the news with Shepard Smith tonight at 7 p.m. Eastern Time. Meantime, in Britain, a court date has been set for a London police officer charged with kidnapping and murdering a young woman. 48-year-old Wayne Couzens will go on trial on October 25th for the death of Sarah Everard. And a warning, the following video may be disturbing for some. I'll give you a minute to look away. A horrific plane crash was caught on camera in Florida. A car was driving down a road when a small plane slammed into it. Officials say 2 people in the plane died, as well as a child in the car. An adult in the car survived the accident. I hate to end on that story, but Brian, back over to you.
Absolutely speechless around that video, and thoughts to the family in the car losing their kid because of, 1 in a trillion odds there. Just terrible stuff.
I know.
Courtney Reagan, thank you very much. By the way, Courtney, we'll see you again in an upcoming segment. All right, your hot topics of the day. On that upcoming segment, something called eToro going after Robinhood. Walmart goes from fast fashion to high fashion. And Lululemon's latest challenge comes from Pittsburgh, as well as Tiger Woods making a new deal. We'll get to that. But right now, they call it show and tell. We show you the chart and then tell you the story, or we tell you both if you're listening on the radio because you don't have a TV there. All right, today's chart, United Airlines down right now, but it's up 150% since the March lows of last year. All this is TSA passenger volume surpassing 1 million, going through a checkpoint for the 5th straight day yesterday. Wow. Here's United CEO Scott Kirby on where things stand now.
There's still a long ways to go. Revenue's down 60% still in aviation, and demand is still 50% lower than it was before. But we're clearly on the upswing, and as more and more people are getting vaccinated, particularly leisure demand is coming back at almost 100%. My guess is business demand is still 6 to 9 months from really hitting its inflection point and coming back. But it really is encouraging to see and feel like we've turned the corner and are the road to recovery now.
Pace of tomorrow. It's people and machines uncovering opportunity. Cloud computing providing endless capacity. Blockchain making transactions safer and faster. New markets born where they weren't before. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't change. pace, the pace of tomorrow. You said it. NASDAQ. Rewrite tomorrow.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the Watch List. I'm Nicole Petalides, coming to you live from New York City. Thanks for being with us. 2.5 hours left in the trading session, and we have a mixed bag here and losing some steam in some cases. So the Dow is down almost 0.5%, 147 points lower. The NASDAQ, off its earlier highs, is up 0.9%. The S&P 500 now fractionally lower, and the Russell 2000, those small caps, the worst of the bunch, down 1.4%. We're watching home builders. Lennar in particular is set to report its earnings after the bell today. Stephanie Lewicki, contributor for the TD Ameritrade Network, is combing through the numbers and the expectations for Lennar earnings. What should we look for here, Stephanie?
Well, analyst expectations are looking good right now, with the stock being up over 35% in 2020 and up 15% so far this year. On the EPS side, they're looking for $1.65, which would be up 37% year over year on revenue of $5.08 billion. That would be up about 15.5%. Now, the home builders have been benefiting Lennar Homes from higher deliveries, from those lower borrowing costs, from the improved economy, and then again, more stimulus. Just got that second round of stimulus this weekend. And the company has also been shifting its business mix to include lower priced home. And this is expected to have boosted its sales absorption pace to some extent. Now, they expect deliveries in the range of 12,200 to 12,500 homes. That would be an improvement from the year ago figure that was 10,321 homes. And the estimate for this quarter is 12,400 homes. That would be an increase of 20% over a year ago. And the company expects average sales price on the home to be $390,000, which is a slight decline of about 2.7%. A year ago, it was $401,000. We look at what the analysts are saying. Well, they have an average price target of about $97.40. The 10 analysts, covering, 7 have a buy, 3 have hold, 0 have sell. We look to the options market and an $89 stock, looking at about a 4.7% move in the stock in either direction, Nicole.
Okay. And then we also got some news on the home builder confidence, which dropped a little bit. Tell us about the NAHB Housing Market Index.
So we did get that out this morning. It did fall slightly down to 82, but still a very solid number. Anything over 50 is a positive number. So a year ago at this time, the number was at 72. It hit a high of 90 in January. So this number coming in lower than expected. Again, now that we have rates on the rise, the 10-year sitting right around 1.6 basis points, is that going to start to weigh on new loans, new homeowners getting loans out there? And then the surge in lumber prices that have been happening for quite some time right now, that has also been hurting home builders. One thing too is if the higher interest payments, not only with rates being on the rise, not only would that knock some buyers out of the market because you have a higher monthly payment, but again, today's environment, it's really a tighter lending market. So they may no longer qualify for the loan. So I think it will be interesting to see, especially in their guidance, what they might say, if they'll comment on rates on the rise and anything to do with the higher commodity costs that have been hurting some of their supply chain.
Right, but to your point, 82 is still pretty great and well above 50, because below 50 is contraction, above 50 is expansion, like you were saying. So 82 rather than 83 is certainly not a terrible pullback. Just a little bit of a breather there. Stephanie Lewicki, always great. Thank you so much. Stephanie Lewicki, contributor for the TD Ameritrade Network. Thank you. Achilles Larrea is standing by, founder, CEO, Larrea Wealth Management, to talk about the market action, the economy. You feeling bullish or not necessarily, only in certain areas? How are you feeling, Achilles?
Nicole, I am always bullish. You know that about me. I'm so bullish, sometimes I think I glow in the dark. But here are the reasons to be bullish, especially in this type of market. First off, the stimulus. It's a big thing where we're going to see more growth in certain areas and sector rotations that's taking place with stocks, and we're going to get to that in a moment. But more importantly, a lot more spending is going to take place because of the stimulus and those checks rolling out, which people are going to start seeing in the next few days if they haven't seen them already. So let's get to those stocks if you're ready.
You're not surprised to hear that some people are going to be putting some of their stimulus money into investing, right? And you recommend that they at least pick one of your many names that you have here, one of which is Philip Morris. Tell us why you like Philip Morris and the upside potential here on that one.
Absolutely. Philip Morris International is one of these stocks that for the longest period of time has been underperforming. However, the dividend has been above 5.6%. Now we're starting to see the movement on the upside because of that sector rotation from the techs. I don't think that the story is over with the techs, but this is one of those situations where the rotation into the value stocks has companies like Philip Morris International improving. Also, the CEO has mentioned that there is more money coming in from duty-free, from Indonesia, from other parts in the Pan-Asian region that will add more growth to their stock price long term. We're looking at a solid double-digit growth by the end of the year at around 11% or so.
Ah, okay. And then you have a thought on some of the travel stocks as we talk about people and the pent-up demand and reopening and the vaccines rolling out. Tell me why you like Hilton, because there's so many things in the travel and leisure, but out of all of them, you picked Hilton. Why?
Well, Hilton's a very interesting play. And the reason being, if you look at the other stocks, which have been decimated in the past year because of the pandemic, now as we start to roll, Hilton hasn't had as much of a problem. Yes, it has not had that growth, but its growth has been better than its peers in the area. So that's one of the things we like. Second thing, we believe that this is going to be one of the stocks that's going to benefit first from that rotation where the pandemic had affected this sector immensely. Now, as it starts to play out, the vaccinations are taking place. We're well on our way to 100 million people being vaccinated by May. We feel that they're going to be one of the first names, and we see a solid double-digit growth in this stock going forward. I'm really happy about that. Really, and we see the same thing with other companies in the sector too.
Yeah,
but they're the big one.
Big tech. Apple is on your list, huh? Why do you like Apple?
Yeah.
Because Apple has not been the greatest of late, but everybody loves all things Apple.
Well, Apple has its own cult, and the more they innovate, the more they come out with these products that everybody seems to love. They've been a tech darling for quite some time, and last year they did not perform as they had in the years previous. But let me tell you, there are some companies who wish they had that growth out there. So Apple is, with the innovation and the domination in their sector, they were starting to see, I don't know if you've seen the stock just the past couple of days, stocks on the rise right now, and we could see a further, I would not be surprised if we see anywhere between 25 and 30% for the rest of the year. I believe that the innovations that they're coming out with pose well for the stock, and they should do very well in that.
So do you think it can really retest some highs here? I just want to look at the price at this moment when I look at Apple, because people love it. So it's at 125. The high was 145, January. Where do you think this stock is headed?
I wouldn't be surprised if we're going to retest some of those highs going forward, but I don't see it till third quarter, fourth quarter of the year. I don't see it right at this moment, but this is the beginning of a wonderful trend.
I see. Okay, and Starbucks, which is at highs, positive comments from the analysts, a reopening trade as well. Tell me more about Starbucks.
What I love about Starbucks is they had an advantage. They were in the pandemic 4 to 6 months before it came to America in China. So they have had the growth and the experience to know what to do once it came here to the United States, their biggest market. And China was 10% of their market at the time. So Starbucks, looking forward to 2023 and 2024, we see easily manageable growth targets that they're going to hit. And we see earnings per share growth of 10 to 12% in that same time period. So we see something going forward that looks really good.
And I know that you were focusing on Home Depot, which is up about 6%, but you said it could really have a modest double-digit increase this year, which to me means 10 to 14%. We're out of time, Achilles, but thank you very much. As always, Achilles of Achilles Larea Wealth Management. Thank you very much. Great to have you on the show. Still ahead, we're going to bring in our panel to discuss the very latest outlook for cybersecurity. We'll preview CrowdStrike and Coupa Software. The earnings come out today after the bell. Don't you want to hear what the pros have to say? We're going to head to break. We're going to check in on those airline stocks. Down today, but quite the run in the last few months.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
I added futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
I'm Maria Schrader. Here are a few stocks moving this hour. Stifel raised JetBlue's price target to $20 from $17 and kept a hold rating on the stock. The analyst expects transatlantic service to begin this year from Boston and NYC to London and then Western Europe. He says JetBlue benefits from lower reliance on business traffic. He also points out JetBlue ended 2019 with 259 aircraft and should end 2021 with about 282, which should provide pretty significant upgauging over time. Shares are currently down around 4.5%. JP Morgan raised Carnival's price target to $33 from $23 and kept a neutral rating on the shares. The analyst increased price targets on the cruise lines based on positively evolving expectations for potential pricing power. He sees a strong U.S. consumer spending environment, sizable pent-up leisure travel demand, and several cruise-specific catalysts in the near term. Carnival is down about 4.5% today. Wolf Research initiated D.R. Horton with an outperform rating and a $94 price target. The analyst likes the company's above-average growth and profitability and management's consistent execution. He adds that D.R. Horton has favorable entry-level exposure, and its transition to an asset-light operating model should drive strong free cash flow and returns. D.R. Horton is up about 2% today. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Maria Schrader, thank you so much. Now let's turn our attention to cybersecurity. What do you need to know in 2021 all about cybersecurity? Let's bring in our pros, Alex Hammerstone, GRC practice lead, trusted SEC, and Peter Tran, Chief Information Security Officer at Inversight. Thank you both for being with us. So Peter, I'll start with you. Cybersecurity is so very important. I know we have some names to watch, but what are your thoughts on the group?
I think that first I'll start off with general trend in cybersecurity. So particularly as we move from legacy third platform IT infrastructures to what the fourth platform is, which is cloud, mobile, social, IoT, smart living, smart cities, companies particularly like a CrowdStrike or any company in particular that needs to stay competitive needs to start to bridge that gap and have transformation around how they're going to address multi-cloud, native cloud environments and platforms as a service and software as a service, which is a shift from on-prem data centers to hybrid cloud environments, and those applications that are being served up, whether you're brick and mortar or click and mortar, that's going to be imperative from a monitoring and early detection, and also being able to find bad things, detect for it, but also do something about it. So generally, that's the trend, and to be competitive, we want to really see that.
Alex, why don't you expand on this? Because it's a very crowded field, and investors will want to look at certain names, but it's probably the right time for cybersecurity, right? Everybody's working from home and a lot of devices that probably don't have the right protection.
So absolutely, Pierre have some great points, and I would agree with those. But also, if you look at just the size of the market, it's just everything seems to be moving online more and more. I mean, everything's connected now, right? I mean, your car, your dishwasher, your stove, your refrigerator. And more information is also being shared online. And so the market and the space, it just continues to grow exponentially, as well as all these threats. I mean, you just need to turn on the news or open a newspaper, to see how much risk there is out there. And so companies that are able to help organizations mitigate these threats and really lower their risk have the potential to do really well. It's a crowded market. There's some really big names out there and a lot of smaller upstarts that are coming out with new technology. But there's also a lot of space. I mean, there's a lot of room for all these organizations because really everybody needs these services.
Tell me, Peter, what you think about Crowd, because you said it's certainly adapted, and names like Crowd and Coupa are in a unique position. Peter, tell me more about those two names.
Yeah, I'm a big fan of what CrowdStrike has done. Even back when it was a point solution only, EDR, endpoint detection and response, they've done a phenomenal job in transforming and addressing multi-cloud environments, both from a software as a service, so they have a managed detection and response service for their customers, also from an endpoint and looking at beyond the perimeter and beyond the network, they're looking at cloud solutions. They're integrating well with Azure, AWS, mobility, and looking beyond that. So they had the first mover advantage of really trying to take that risk really to just be more than a point solution provider, because the risk there, what happens is in a crowded space, you have point solution after point solution, and enterprises are trying to adopt that and then adding more and more and more. And what happens is you have tech debt. And you can't just unwind these technologies, especially in security. So a lot of companies start to get in trouble by buying too much technology. And with Falcon, which is the core platform of CrowdStrike, they've managed to focus and keep the customers focused on Falcon, its early genesis around endpoint, and then expanding that beyond and covering cloud.
Yeah, and you make a good point there, Peter. I mean, each company brings something different to the table. I mean, we could say tech or cybersecurity, but Alex, I know you look at these companies closely. Are there some that stand out more to you than others? And Crowd and Coupa are two that are reporting today.
So they absolutely, do stand out. One of the things that is obviously there's a couple of things that can really drive these companies forward. one is just having great technology. The other is, of course, marketing and being able to kind of be at the tip of everyone's tongue. And so these larger companies that you think of, nobody at a large organization is ever going to necessarily have problems if you bring in, a certain vendor that's well known and well respected, which can create a challenge sometimes for some of these smaller companies that don't necessarily have that advantage. But really, if you look at CrowdStrike too, it has other services, so they do threat intelligence and they have response services and other things. And I think that's certainly something that's important, for these companies to really provide multiple things. Number one, so if there is a change in technology or another technology comes out that maybe does something a little bit different, and as an advantage, you still have other services you're able to provide and really are in these companies, helping them with more than one thing. So they're really thinking of you as a true cybersecurity solution and not just for one, element of the whole program.
Peter, quickly, is there a name that we didn't talk about that you like a lot? I'm out of time, Peter, but is there one that I may have missed?
Well, yeah, I mean, given Coupa, so in that vein, when companies have a product line and they start to look at security built in the zero trust model, a name is Carbon Blacks, right? A direct competitor of CrowdStrike, but they're integrating it with VMware, right? The acquisition of Carbon Black into VMware really is a very good thing to watch.
Peter Tran and Inversight, thank you. Alex Hammerstone, Trusted Sec, thank you both very, very much. Kevin Hinks, tell me about midday trade.
What can you do with a $1,400 stimulus check, Nicole? I'm going to show you 2 trades that you can make, both of them under $1,400 next on midday trade.
All right, well, watch for that. Thank you, Kevin Hinks, Midday Trade. Thank you for watching the watch list with me here every day at 1 p.m., 5 p.m. Eastern Time. I will see you for Market Overtime, where we plan your long-term portfolio. I'll see you there. I'm Nicole Petalides. Have a great, safe afternoon, and I'll see you later. Thanks.
24/7 access to diverse global markets. Right here. That's why I added stock index futures to my trading strategy. Now when I see ups and downs coming, I'm ready. Well played.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
It's 1 o'clock in Chicago. Good afternoon, everyone, and welcome to Midday Trade. I'm your host, Kevin Hinks. I'll be taking you through the next half hour. I've got an interesting show for you today. What can you do with a $1,400 stimulus check? we're going to show you how to make 2 trades in 2 very popular names and still have a little money left over from your stimulus check. First, Alex Caulfield will stop by the show. He'll look at the risk-off assets and what they're doing today. And then we'll trade PayPal, the digital payment company, for much less than $1,400. And then Jenny Horn, John McNichol will stop by the second half of the show. And we'll look at Apple and how you can trade Apple and PayPal. We'll give you a trade to do on both. Both trades will be under $1,400. So stay tuned. We're going to show you what to do with those stimulus checks. Now, before I bring in Alex Coffey, let's take a look at the 4 major indices and see where they sit at 1 o'clock Chicago time. The S&P 500 down 0.1%, 4 points to 3964. The NASDAQ 100 up 0.8%. That's off the highs, but still up 0.8%, 106 points to 13,188. Dow Jones Industrial Average down about, we'll call it 0.4%, 147 points to 32,806. And the Russell, the biggest mover on the downside, down 1.5%, 35 points to 2325 and some change. Now, let's bring in my co-host from Fast Market, Mr. Alex Coffey. He's going to take a look at what the risk-off assets are doing today. And I think some of the big news today, Alex, VIX resting below 20 is a pretty significant threshold. Let's see how long it lasts, though, Alex.
Yeah, it's very interesting, too, that it's happening before the FOMC tomorrow, which you look at the market action today, it's kind of quiet, choppy, particularly in stocks. You see that in some of the risk-off assets. It seems like a skittish, nervous market ahead of the event, yet you see volatility pushing towards 52-week lows. Very interesting. But 10-year yield had some intraday volatility, but overall, it's actually been a quiet day for yield. The 20-year auction went off pretty spectacularly. There was a lot of optimism and demand for the 20-year treasuries, a pretty solid auction. I think this was a little bit of a surprise. You saw yields sharply repriced right as that came out, but it's since recovered. Maybe a little bit of a whisper that was going to be a disappointing auction ahead of the FOMC, but it actually came out very, very nicely. So interesting move in 10-year treasuries, 1.618. They're actually trading basically on the highs of the day, though, after recovering some of those sharp, quick losses around that auction time. Volatility, as we mentioned, 1966 is in below 20 here. Kind of a quiet day for volatility, but holding below 20 really for the first time meaningfully in over a year. So very interesting to watch that. Gold has been quite volatile relatively here. It's traded up to 1740.5 and is trading towards its low end of the range since the market opened at 8:30. At 1729. It's basically unchanged, though, however, on the session. The dollar index slightly higher. It has been all over the board as well, trading from around 91.67 to 92.04, trading towards the middle of that range, 91.86 right now, basically unchanged. And crude oil bouncing back after some early morning weakness is just below 65, 64.97, Kevin, down 42 cents. So crude oil pretty quiet here.
Little consolidation ahead of API inventories this afternoon and EIA inventories tomorrow morning. So not really surprising too much on crude oil as it consolidates second half of the day. All right, Alex Coffey, always a pleasure to have you on the show, sir. Thank you very much for stopping by and talking about the risk-off assets. Have a great day, sir. All right, our first trade of the day. Remember, we have a theme for today's show and several going forward now. We're going to look at trades that you can make in high-profile names. We're looking at PayPal today and Apple. Trades that a beginning option trader can trade, or a intermediate, you can trade more. But what you can do for under, in this case, we're going to do them both for about $500 in margin. So make no mistake, this will be significantly under $1,400. So, and the way you do it, obviously, you've got to control your margin if you're doing that. But let's look at PayPal right now. First, PayPal. How about this? How about the digits that PayPal is putting up during this period? 72.7 million active users in 2020. 377 million total in PayPal and Venmo. So this company continues to just be the leader in digital payments. Now, Square's got a great product. Their Cash App is very popular, but PayPal is still the leader in this name. So let's look at a chart of PayPal. As you can see, it's had great movement. It's corrected pretty significantly though, and now has rallied back up to at or near its 50-day moving average of 255.23. It sits just below it as we speak. Now, how do you trade a name like this? Well, think of these three things. And no matter if this is the first time you've ever watched an option program, if you're an intermediate option trader or you're an advanced, still think about these fundamentals when trading. And that is risk definition, high probability, and try to, if you can, collect theta when you trade. So how do we trade PayPal? We're going to look at the expected move. Let's go to the board first. We're going to trade both of these April 1st, so 16 days out. We're going to go to the April 1st because PayPal has earnings on the 28th of April and Apple has earnings on the 29th of April. So we're still 5-6 weeks away from earnings in both these names. So you can trade ahead of that event safely. And as you can see, PayPal has gotten down as low as $225 and now sits about $250, just under $251. Well, if you go out to that April 1st date and look at the expected move, about $18. Okay, $18 takes you down to about 233, 232 range if we round off. So right around there. Now, what I suggest, what I do on a regular basis is take that expected move, right? Down to about 232, 235, and just go one strike above that. And what do we get in terms of our our probabilities for finishing out of the money? If we use the 235 strike, look at that, 75.6% chance. So 3/4 of 75% chance that at expiration, this will be out of the money and you can get almost virtually a full profit on this trade. So as you can see, this is trading right now around 88 cents. It's a one lot, $5 wide, high probability put vertical in PayPal. Selling the 235, buying the 230 put. That $5 on one lot is the margin on this trade. So you can look at it. It's about 6 deltas long. It's collecting about less than $3 theta per day. And as you can see, it's short vega, implied volatility is going down. But all you need now is between now and April 1st is that PayPal stay above $2.35. Now, the break even, set slices to break even, put it on the chart. As you can see, it's the short strike minus the amount of premium that you take in. So depending, let's say we sell it for 90 cents, it would be 234.10 would be that break even on that trade. Anything above that, you're profitable, right? The risk on this trade, $410. It's the $5 wide minus the 90 cents, leaves you about $410 in risk. Now, one thing about high probability put verticals or call verticals, whichever you think, if you're bullish or bearish, the risk reward looks a little outmanned. Well, that's because you have the chance here to be wrong and still be profitable, right? This stock could sell off $10 between now and April 1st, right? It could sell down to $239 and you would be 100% profitable on this trade. That's what high probability trades allow you to do. They allow you to be wrong and still profitable. So this is a way, using $500 of your credit. Remember, think about this too. You got $500 in margin. You've only got $410, like I said, in risk. So if you think about the risk reward on this trade, 90 cents on about, $450, $500, $410, that's more than 20% over the next 2 weeks. So think of it like that. There is risk, obviously, but we're going to create a duplicate order and send one of those PayPal spreads off. And now when that fills, you will be short long deltas in PayPal, with about $500 in margin, and you will be in for our first trade of the day using our $1,400 stimulus check. All right, now let's take a quick break, come back with Jenny Horn and John Nickel, and we'll look at our feature stock of the day, and that is Apple, coming off of making a big bounce the last 2 days off of some of its lows. So take a quick break, come back in 2 minutes with more midday trades. See you then, everybody.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Futures to my trading strategy. Now, I have 24/7 access to diverse global markets, including crude oil. Like I always say, leave no opportunity untapped. I'll just sign that. Yeah, got it.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Welcome back to Midday Trade, everyone. Kevin Hinks back here for the second half of our show. Now I'd like to bring in a contributor across the TD Ameritrade Network, Miss Jenny Horn. She's going to look at our feature stock of the day. Another good fundamental trade that we can make using our stimulus money. Bring in Jenny Horn to talk about Apple, who's made a nice bounce off some lows yesterday, having a great week. Jen, what do you got for us in Apple? I think the word of the day here is recovery. The last 2 days, Jen?
Recovery, yes, and some of this rotation we're seeing. They're up over 3% this week so far, Kevin, like you mentioned, and up over 1% today. But interesting enough, they were up over 70% in 2020. And then, of course, sort of, seeing this rotation out of some of these tech stocks actually through February 16th through the beginning of this week, the NASDAQ 100 index was down over 10%. So this was definitely reflected in Apple, which is, of course, one of the largest holdings in the NASDAQ's price when we saw Apple sort of slow down its roll. But make no mistake, Kevin, this name still is an absolute incredible growth story, which seems ironic to call it that because it's, of course, not a new company. It actually, in the first quarter of 2021, reported revenue above $100 billion for the first time. This company holds $195 billion in cash, offset by about $112 billion in debt. And over the last 12 months, it generated $80 billion in free cash flow. So this company, is doing well. And this is due largely in part to their greatest success, which continues to be their iPhone. It's the largest revenue driver and it has been for the last decade. The pandemic, of course, we saw drive iPhone demand higher with the launch of the 5G iPhone. But another thing that's interesting really is that Apple has sort of regained its pricing power over its iPhone because now they say they can offer the fastest iPhone ever. And I actually have the iPhone 12. I'm not so sure if it's necessarily that much faster, but I do understand the draw to 5G. Another thing is wearables are continuing to grow for this company. They grew 30% in the last year. And now with the watch and Fitness Plus, they can boast all of these really cool features like maintaining your oxygen levels, your blood pressure, your heart rate. So they're getting, more fitness savvy with some of their wearables. And lastly, but equally as important, is their services unit, which of course is their App Store and their iTunes Store. This grew about 24% in the last 12 months, but also some analysts believe it could actually generate half of Apple's revenue by the mid-decade point, so about mid-2025. So that is, outstanding. So when we're talking about what you do with this upcoming stimulus, say you took the $600 you got back in January and then took the $1,400 that's coming now, that's about $2,000. So you could get a pretty decent model of a Mac, say, if that's where you were choosing to invest your stimulus, Kevin.
Yeah, I mean, think about it. If you do the two trades that we're talking about here in PayPal and Apple, you can easily still have money left over for a pair of AirBud Pros or something like that. So lots of things to do with your stimulus. We're teaching you how to make money with your stimulus money, not just spend it, though, Jenny.
Come
on, we're talking about investing here. All right, Jenny Horn, always a pleasure to have you on the show. Thank you for coming on and talking about other things that you can do with your stimulus money. All right, Jen. Thank you for coming on. All right, now let's go out to John McNichol in Salt Lake City, Utah, and take this discussion from the fundamentals over to the technicals. And John, both the stocks we're looking at today, PayPal and Apple, have both bounced off some pretty significant corrections here. Apple, obviously the most high profile of those names. What do you got for us today in Apple?
Yeah, well, it's great to be with you once again, Kevin. So, we talked about Apple last month, around the middle of the month, about the same time. And Apple has continued to lag the S&P 500. It's down about 5% year to date and off a little bit more from that high set back on January 25th. Stock's still off about 13% since that time. Now, today's price action is we're looking at the 127 area as resistance. It recently broke the downtrend line, and we're kind of setting back at around that 127 level. We actually talked about this last month, how that was more support. And this is kind of a principle of technical analysis, how broken support can potentially act as new resistance. And, with the Fed announcement coming out tomorrow, we've seen a lift in a lot of these FANG stocks at the expense of a lot of value stocks. And so it'll be interesting to see with that rate decision, if that momentum is going to shift back into some of these FANG names like Apple.
John, what do you guys do when you look at a name like this and it looks like Apple is right in the middle or pretty close to the middle of its 50 and 200-day moving averages? How do you treat that, or what do you do? How do you look at that?
So a lot of it's going to be a matter of time frame. As we look at this chart, we talked last month about that head and shoulders pattern, how that was a bearish pattern. And if the price was to break below that 127 mark, we can test that 200-day moving average, which it did. We came down around that 115. So that 115 area would represent more of a longer-term support, and that's still rising. The long-term bullish trend of Apple is still intact, but we can see more of the intermediate trend represented coming off of those highs, and that 50-day moving average, which was falling, that is a little more of a bearish sentiment. So it's kind of a squeeze, so to speak, between what's been more of the nearer term trend and then what's the longer term trend between these two moving averages.
Yeah, I mean, I think that, Apple's bounce, and Apple, as we know, John, is not void of corrections. I mean, just the end of last summer, right around September 1st, it had a pretty significant correction where it broke significantly down below that 50-day moving average. But a lot of things that Apple has done here, it's extremely how do I say this? Well owned, right? It is a high profile company owned by most funds, most individuals. It's in 3 of the 4 major indices. So it really is affected by everything that the stock market does. All right, John, final thoughts on Apple before I let you go for the day, sir.
Yeah, so we mentioned about the 127 level. Certainly would like the bulls to see it trade above there. Ultimately, getting above 130 and holding would at least put Apple in more of a neutral, more of an overall consolidation to see where the next leg up potentially would be.
All right, John Michael, always a pleasure to have you on. Come on today talking about Apple. This is a name that should be on the front of everyone's burner. Right? Looking at the overall market, it's a bellwether. It's owned by a lot of people, a lot of funds, a lot of indices. And so we should always be looking at our core holdings in Apple. John McNichol, thank you for coming on. As always, have a great day, sir. Now, remember, we've already used up $500 of our stimulus money, so we've got about $900 left. What do we do with it? Well, in this case, you're going to use $500 more, doing a high probability put vertical in Apple. Remember, John was just talking about that 120 and 115 level. Well, look at the expected move out to April 1st, only about $7.30. That takes us down to about 118, 119, right in that range. And so what do? Round up to that nearest strike, which in this case is the 120. You look at the 120, the probability of finishing out of the money. Nope, that's 3 days. We'll go out to April 1st. There you go. The 120 put trading about 73% chance of finishing out of the money. If it starts with a 7, I think you're in a nice level in terms of high probability. So this one about 73% on the 120 put. And that gives us one. Remember now, what could you, well, let's get the analyst tab and I'll take a look. Now, very similar trade that we're looking at here in Apple that we did in PayPal. $5 wide, collecting about a similar amount of theta. Look at a little more delta though. Why? Because we slid that short put vertical. It's a little closer to at the money than the PayPal one was. So $500 theta. So if you do both these trades, right, you would have about $2.50 in terms of theta in Apple. And let's just do this. Let's hit up PayPal, hit up the exact same thing, and about $2.65 in PayPal theta per day. So between these two, for about $1,000 in margin, you'd be getting about $5, $6 a day in theta. And that number would only go up as you get closer to expiration. Remember, you're about 16 days out on both of these April 1st expirations. So this is, again, collecting about $2.50, long 13 deltas, and short 3 Vega. So both these names are names that you would feel comfortable putting on for about $500 margin apiece. Both you're collecting about 70, 75 cents. Remember, how could you change this? What if you wanted to do differently? How would you trade this? Well, how about if you did something like this? You could do the 120, 118 put vertical. Now that's only 40 cents. That's $2. But what if you did 2? Now you've done $400 in margin, but you've got less risk going on. And you're collecting less premium, right? You are your theta level is a little lower, but you have less risk. You've only got $400 in risk there. So you've shorted the exact same put, right? Same probability of finishing out of the money, but you've adjusted your risk tolerance and everything that you're doing. You've let it so you don't have as much risk on the downside. Maybe if you wanted to think about that. If you found enough of these, you could do 3 trades in $400. That would only get you to $300. So there's a lot of ways that you can do high probability trades. Remember, the probability on this trade is exactly the same because the short put strike is exactly the same. All you did was bring that $5 wide, make it a $2 wide, and then add another contract. So it went from $500 to $200, then you added another one and made it $400. So both these would fit well inside a beginning account that maybe just got stimulus money, throw it in an account and put these trades on. These are both fundamentally sound trades, doing the three things we talk about all the time: collecting data, trading with high probabilities, and risk defined. So all these are just the way that we would teach you the fundamentally sound way, whether you have $1,000 in your account or $100,000 in your account or $1,100,000 in your account. The fundamentally sound theories of these trades stays exactly the same. All right, that's our show for today, everyone. Ben Lichtenstein is coming up next with Midday Movers with Ben Lichtenstein. He's coming to us live from the TD Ameritrade Studios in Chicago, Illinois. Ben, what do you got for us today?
Hey, Kevin, a busy show. We're going to start the afternoon off with a look at futures. We've got the SPX into a new all-time high. Crude oil, which is coming off a bit. Energy products are lower, and Treasuries, a volatile day. Some intraday movement in reaction to that 20-year bond auction. We'll take a look at all of that, in addition to a couple individual stocks that are on the move. I've got Jabal up in reaction to earnings. We've got Avis, CAR, that is, lower. And we'll take a look with Kevin Street at some airlines after Goldman is lifting some price targets on a few names there. We'll talk home builders with him, Lennar earnings, and Wolf Research initiating some coverage on a few names. And then my chart of the day, we're talking Discovery on the move higher again today. And Mr. Ben Watson's going to break it down in terms of some of the AstraZeneca news and what that means for price activity from a technical look. We'll talk Starbucks and Cintas.
Yeah, Ben Lichtenstein coming up next from the TD Ameritrade Studios with Midday Movers with Ben Lichtenstein, and then Oliver Rennick will be up right after that with Market on Close. All right, we've got a market that is kind of drifting down towards mixed here today as the Russell is now down almost 2%. For all of us here at the TD Ameritrade Network, have a great day and a great afternoon, everyone. We'll see you tomorrow with more editions of Fast Market and Midday Trade. Have a good day, everybody.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Feel that? That's the beat of global markets, the rhythm of the world. But to us, it's the pace of tomorrow. With ingenuity, technologies, and markets expertise, we create the possible. And when you do that, you don't chase the pace of tomorrow. You set it. NASDAQ. Rewrite tomorrow.
Good afternoon, ladies and gentlemen, and welcome to Midday Moves with Liechtenstein. I hope you're ready for 30 minutes of stocks, bonds, ETFs, and futures. I hope you're ready for a double dose of energy here on the TD Ameritrade Network. Let's get things started with a look at the new all-time highs in the SPX and some of the selling we're seeing into the late afternoon trade. Take a look here, ladies and gentlemen. As earlier this morning, we topped out around 39.81. That's a new all-time high. As mentioned, you can see, though, some of the weakness that's been playing out here back down into, well, just shy of that 39.50 level, just above it, I should say. Take a look here, ladies and gentlemen. This is being led by Russell. Small caps down almost 2% today. You can see the trend environment to the downside. Small caps have been taking it on the chin, and Dow Jones Industrial Average, ladies and gentlemen, also down on the day by about 0.5%. Last but not least, the NASDAQ just posted a new intraday low, but still holding on to some gains here. They're up by about 0.33% here, ladies and gentlemen. We've got a couple individual names reporting quarterly results to keep an eye on still this week. A couple names that, well, we're going to be discussing with our guests here today. Take a look, ladies and gentlemen, this afternoon. We're talking Coop, we're talking Lennar. We've got, again, as you can see, some other big names, some retail names to keep an eye on as we move throughout the week. We're talking Synthes with the chart master a little bit later on in the show here today. But, well, in addition to some of those names, ladies and gentlemen, I think you should be keeping an eye on energy products here, which have been on the move. But first and foremost here, let's take a look at the treasuries here, ladies and gentlemen, because I did want to point out the bonds, which saw a bit of a volatile day here. Take a look here, ladies and gentlemen, at some of the intraday movement we've seen. And this is reaction to that 20-year bond auction. If we could just pull up those results here in terms of this afternoon, we had results in the longer dated. Again, there's been a lot of focus here on these auctions. The 20-year, take a look here, ladies and gentlemen. The coupon rate came in at 1.875. This was on 24 billion. The bid to cover was 2.51, as you can see. And, well, take a look there, ladies and gentlemen, again at what we're seeing here in terms of yield awarded at 2.29%. Now, take a look at where things stand on the bigger picture, because we noticed the intraday volatility. They actually spiked them up, and then they've been selling them back off since. You can see, again, even though we've seen some intraday volatility, still holding up above those lows that we posted in March so far this year, the lows, and that's got rates which are still holding off those recent highs. Now, ladies and gentlemen, I mentioned the energy markets, which were lower. I do want to point out the trend environment we've been seeing to the upside, but as you can see, they're holding off those recent highs. The WTI got up to that $68 level, the Brent up to, well, just through the $71 level. As you can see, we're currently trading down on the day here, fractionally lower here, ladies and gentlemen. This comes ahead of the inventories report today. Again, we'll get the API today on the close, the EIA tomorrow. Keep in mind, we've seen some large builds the last couple of weeks in inventories. And, well, speaking of the inventories, take a look at some of the other economic data that you should be keeping an eye on that could not only move these energy markets, but also the indices and the treasuries. Take a look here, ladies and gentlemen. Well, first and foremost, focus is going to be squarely on the FOMC announcement tomorrow. I want to remind everybody that we got a full hour, 60 minutes dedicated wholly and solely to the Fed. We're going to begin the show at 2 p.m. Eastern tomorrow. That's going to be right on that Fed announcement. We'll talk about the question and answer session. There's some of the other data points you should be keeping an eye on. Let's move away from the futures on over into a couple stocks that are on the move. And, well, first we've got Jabil, ticker symbol JBL, getting a lift from better than expected quarterly results and guidance. Let's begin with the news, and then we'll dive into investors' reaction to EPS, which came in at $1.27 a share. This was on revenue of $6.83 billion. You can see EPS last quarter $1.60 a share. EPS last year 50 cents a share. Take a look here, ladies and gentlemen, again at the daily time frame. The gap up, the net change, they're currently up by about 3.5% to the new high, ladies and gentlemen, today all the way up to, well, into, hold on a second, because that high, there it is, it came off the screen, up to $52.03, ladies and gentlemen, in part due to the news that the company saw operating income helped by restructuring charges in addition to research and development expenses, which have been falling. Now, in terms of guidance, they said to expect third quarter adjusted EPS to be 90 cents to $1.10. They said that'd be almost a 10% year-over-year increase. And I said revenue of $6.6 billion to $7.2 billion is expected. Analysts are looking for around 94 cents on $6.3 billion. So that would be better than expectations. As a result of strong tailwinds, they said for the current year, we can expect $28.5 billion in revenue and adjusted profit of $5 per share. Now, CEO Mark Mondello said that the $285 million in core operating income on revenue of, as mentioned, $6.8 billion was the result of the combination
had been. Matthew Shea is president and CEO of the National Retail Federation. Matt, I know that the NRF has a pretty rosy outlook for retail sales this year. I know we're getting a new round of stimulus measures, but forgive my skepticism. I don't know that all of that money is going to flood into the arms of retailers. People are saving more. There's debts to pay off. We've got 10 million folks unemployed that, I don't know, might be using that money for something else other than new clothes and shoes. Why are you so optimistic about retail sales this year, growing as much as 8.2%?
Yeah, well, Courtney, I think one of the reasons, and you sort of alluded to it about things flowing into the arms, one of our big assumptions, and you've heard the president talk about this a lot in that last little hit there, we've got so much vaccine, we're talking about giving it to other countries now. Lots of vaccinations in arms of Americans are really the underlying assumption here in much of this. We know that over the course of the last year, consumers have really been powering through the economy. And Bob Pisani talked at the top of the show about those 3 massive stimulus bills that were enacted early last year. There was another one at the end of the year, the one that was just signed last week, another $2 trillion. So there's plenty to go around in terms of firepower in the economy, and consumers are sitting on $1.5 trillion. They paid down $500 billion in debt. So I think we're on the cusp, as Kevin Johnson said yesterday, the cusp of a great human reconnection, and plenty of that will flow into retail.
You know, the National Retail Federation, of course, has members that are very large, but also smaller members, smaller retailers. And small business has really, really been hurt. What is your expectation, and what are you hearing from the smaller retailers out there about 2021 and their prospects for recovery?
Yeah, Courtney, you're absolutely right. And that was one of the great challenges of last year. I mean, many families, organizations, businesses suffered, but small businesses in particular really suffered. And they didn't have the access to the same kinds of resources. They didn't have the same relationships with suppliers. They didn't have the same ability to reach markets outside of their local market. And so they did get a lifeline in the form of some of the relief that was enacted, the Paycheck Protection Program, of course, especially. And we and a number of other industry groups here are encouraging the Congress and the administration to consider extending the Paycheck Protection Program eligibility later into this year to help those businesses. So I think they'll benefit similarly. Many of us really focused on staying closer to home and supporting those smaller businesses. And the real key here is reopening the economy. And when the economy is reopened, as we see the vaccine do its job, we see more and more Americans getting vaccinated every single day. I think that's going to be a real possibility for these businesses to rebound and recover this year.
There's an awful lot going on in that $1.9 trillion relief package that we just saw the government pass. But I know at least earlier on in the pandemic, the NRF was urging the Treasury Secretary and others to take a look at the retail industry for some additional relief. Is that still something that you're pushing for, or are those stimulus checks and the relief that's been enacted so far enough, along with the vaccinations?
Yeah, you know, Courtney, as you recall very well, as you just said, the beginning of the year, last year, as we headed into the pandemic, we worked very closely with Congress, with Treasury and the administration on a number of programs like the Main Street Lending Program, like the Emergency Disaster Recovery Loans, and of course the PPP. But, you know, the retail industry is so diverse and there are so many categories and segments. One of the challenges was there were some businesses doing extraordinarily well and others not as well. So I think the effort to really support consumers and small businesses is the right place to put it. And, you know, it's been an unprecedented level of support over the last year. And you alluded to it. There are lots of things in that $1.9 trillion. We'd like to see maybe more of that having been really directed at supporting small businesses. Nevertheless, the relief is going to be very critically important to making a full recovery, and we're looking forward to what we think is going to be a great year.
I hope you're right about the great year for all retailers, big and small, as the economies reopen and those vaccinations get in arms of Americans. Thank you very much, Matt Shea, for joining us here today.
Well, the expected retail revival also leading to hope for the sit-down restaurant stocks. Look at these gains in names from their lows last year: 300, 400, 500, 900%, 1,000% almost for Brinker, as you see there, the company behind Chili's. But are the numbers matching the optimism? Kate Rogers is looking at the data. Kate.
Hey, Tyler. Well, we did get some welcome news for the restaurant industry, posting its best traffic and sales numbers since mid-January, according to Black Box Intelligence. The numbers, of course, are still negative, but they do mark a big improvement. Comp sales down 4.9%, comp traffic down 11.4%. Growth in average check per guest grew nearly 7% for the week ended March 7th, consumers continuing to spend more. The group is pointing to better weather, a drop in COVID cases as vaccines roll out, and the promise of new stimulus checks was on the way when the data were collected. We saw a similar spike in January tied to stimulus and the new administration. Now, the industry, of course, still has a very long way to go, but we did get some welcome news in the latest stimulus package with the creation of the Restaurant Recovery Fund. The $28.6 billion in aid will allow eligible businesses to receive a tax-free federal grant that's equal to the amount of pandemic-related revenue losses the company had. Aid is capped at $10 million. The SBA will prioritize these grants for small businesses that are owned by women, vets, and the economically disadvantaged. Now, this is in addition to the aid that's already being distributed via the PPP.
And
Tyler,
how much?
back over to you.
And how much, Kate, of the PPP is left? And how are restaurants going to benefit?
Well, restaurants can borrow a bit more under the PPP than other businesses. There's still more than $100 billion left, so quite a bit of aid there left up for grabs. And these grants will really be another vehicle for businesses to continue to recover. But we should note that this fund is really just a fraction of what the National Restaurant Association and other advocates were really calling for. They wanted much more money, meaning that they believe more aid will continue to be needed by so many of these struggling businesses and restaurants in particular around the country.
All right, Kate, thank you very much. Kate Rogers, Court.
Well, pot stocks are pulling back right now. The group jumped yesterday on hopes for legalization in New York State. And as more and more states come online, the cannabis industry has become an area that people are looking for growth, especially women. We'll have that story coming up on Power Lunch. Plus, a check on Disney, down nearly 2% today, coming off last week's news that Disney Plus topped 100 million subscribers much earlier than the company had planned. CEO Bob Chapek will sit down with Julia Boorstin for a first-on interview tomorrow at 11:30 Eastern Time to talk about streaming, parks, sports, and more. You don't want to miss that one. Power Lunch, we'll be right back. The boom in the marijuana industry has created a lot of job opportunities, and more women are getting involved, seeking to break that glass ceiling. It's a good one, right? Frank Holland joining us now with more. Hi, Frank.
Hey there, Courtney. The cannabis industry, it added 77,000 new jobs in 2020, and the majority of those hires were women, according to a new report. Women made up 39% of the industry in 2019. That grew to 42% last year. Also, according to the report, nearly half of all cannabis workers, they've been in the industry a year or less. Now, that creates opportunity for female advancement, according to Bankst, a cannabis staffing service.
To be able to come and join a company, get equity in the early days, and work in a business for a couple of years, and then technically be considered someone with a lot of experience in cannabis is great, and a great opportunity for women.
Women buying cannabis also growing. Ease, a California delivery service, says women are now nearly half of their customers in 2020. We spoke about these trends and being a woman of color in the cannabis business with Hope Wiseman, co-owner of the Marion, Maine dispensary in Maryland.
It's an advantage right now to be a woman-owned business in the cannabis industry. People definitely look at that as something that's unique, and they want to support it and help advance that narrative.
And with the growth of cannabis, Bank says there's also increasing need for professionals like accountants and attorneys for women who want to transition into the industry that way. Back over to you.
Frank, are there cities or places?
Frank,
I was going to ask this question, if you don't mind, where the opportunities to advance for women are greater rather than others, or is it pretty much the same across the country?
You know, Tyler, the cannabis business is growing, but as a matter of fact, New Jersey, the state you're in right now, is one of the best states. According to Banks, it's going to add more than 20,000 cannabis jobs over the next 5 years due to legalization.
All right, Frank Holland, thank you very much. We've seen something of a SPAC-lash recently. The once hot SPACs going a little bit cold. The CNBC SPAC 50 index down 20% this year. CarLotz went public in January via SPAC. That one's down nearly 30% since then. Even down today after seemingly strong results. We'll talk to the CEO about that next on Power Lunch. Well, since the start of the pandemic, roughly a year ago, this is, of course, a historic day with the stock prices way down, the price of used cars and trucks have risen more than just about any other consumer good, rebounding sharply from a spring trough when they fell 20%. Prices peaked in the summer, 15% increase over the pre-COVID levels. The reason for the spike is just as much a demand problem as it is a supply problem. CarLotz is a used car retailer that looks to capitalize on that rapid rise in prices, but it noted in its earnings call yesterday that it is struggling to balance supply and demand. Let's talk more about this with Michael Bohr. He's the co-founder and CEO of CarLotz. Michael, welcome. Good to have you with us. The company had an EPS loss of 7 cents a share versus an expectation of a nickel's loss. Revenue was up, however. That's a good sign. You point to an inventory issue. Did you take on more cars than you could resell?
Yeah, thanks for having me on, Tyler. Appreciate it. Yeah, so, the last year has been pretty remarkable in the car industry. About a year ago, we went from executing into the biggest quarter we'd ever seen, and then virtually from one day to the next, the world stopped, as we all know. We battled through that, but the whole supply chain was disrupted. So as you know, OEM factories shut down. They started making ventilators. There were moratoriums on repossessions. So a lot of banks weren't getting their vehicles back. And so the whole wholesale side of the car market just shut down. And that created, in conjunction with stimulus checks and other stimulus measures that made demand spike, it created a demand for vehicles without supply to support it. And so we saw, a lot of changes in vehicle values, as you mentioned. As we saw over the course of the year, our inventories dropped as we were selling more than we could take in. And so around Q3, Q4, we really ramped up inventory dramatically. And what that did was it allowed us to grow very well through Q4, through 2020, and frankly into this year. We're seeing great demand. We've got a lot of inventory to support it. So we're very excited about what that means for us and our growth potential.
But if you were selling more, and there was great demand in that fourth quarter, what explains the loss that was worse than analysts expected?
Well, there's one analyst that covers us. We're brand new on the market. I think people are still.
So it's a party of one. Well, then throw that out. Okay, fine. But
so we have outperformed at the top line per where we guided, and it's a result of the very strong demand we're seeing in the market. What's interesting is our business, much like many retailers, auto retailers, it's like a big sink, and there's a faucet. And that's the vehicles that come in, and there's a drain, and that's the vehicles that we sell. And our job, if we want to be great at what we do, is we need to match the faucet, the flow of the faucet with the flow of the drain. And if we can do that well, then we'll win, as will other retailers. And so around the end of last year, when we were so low in inventory, we dramatically increased the volumes that we took in. Obviously we're a very operations-heavy business. We need all those vehicles to be in tip-top shape when they hit the website, so people can buy very high quality cars. And so there was a log jam in processing, and what that did is it slowed the vehicles down from hitting the website and getting sold. And so that created a little bit of a log jam in supply. That's all working its way through now, and we're seeing great volumes both from the faucet and through the drain.
And so so once you get that flow issue taken care of, you would expect then that your profits would grow, the stock will recover, and on you'll go. Obviously, you can't tell me what you think the stock's going to do, but I know you would hope that it would perform better than it has. Let me understand your business model a little bit, because it's an interesting one. You provide a service to the seller mostly. I come with a used car to you, and what? You pay me, the seller, a price for that car. I pay you a fee for selling and fixing up the car to get it ready for sale, and then you make money on the resale? How does it work?
So we're the only consignment to retail sales business in the used car market. And so we do this for consumers, and we do it for businesses that have vehicles to sell. So Tyler, for you would come to us with your vehicle because either you were dissatisfied with the dealer trade-in offer, or you were not satisfied with taking it to a service that buys your car with the price that they were going to give you, and you didn't want to go through the hassle and potential danger and risk of selling it yourself.
Right.
And so you'd come to car lots, you'd say, hey, please sell my car for me. We would evaluate your car, and we would let you know what we think we'll sell the vehicle for. So then you drop it off, we fully recondition it, we professionally merchandise it and market it, and ultimately we'll sell your vehicle and we'll take a flat fee from the sales price, and you'll end up with what we've seen and experienced is a number that is several $1,000s above what either the trade-in value or what you could have sold it for privately. And so we're essentially providing a service to you to sell your car for you, net you more cash than you otherwise would get, and we do all the work for you.
So,
and we do this for companies.
So then you pay me back on the price you get for the car, for my car, and you make your money off of the fee. I'm sorry, Michael, we got to leave it there, but you make your money off of the reconditioning fee and another service fee, right?
Sales fee. That's right. That's correct. And you end up with.
Go ahead. And you end up with more than you might, and less hassle than you might have experienced otherwise. Michael Bohr, thank you. Courtney.
Thanks for having me.
Well, the Dow right now falling about 100 points. That's not bad, considering on this day last year it was down nearly 3,000. Our anxiety is in a better place today, too, probably. We'll be right back with more on the markets. And don't forget, you can always watch or listen to us live on the go and on the CNBC app. We'll be right back.
Well, the markets have turned court a little wobbly right now. The industrial's off about 1/3%. The S&P 500, after being in the green for much of the day. I don't know what we did to it. Maybe we messed it up. I don't know. But Nasdaq is.
I really hope not.
I hope not too. Nasdaq is also down at this hour.
Yeah, exactly. The NASDAQ is here sitting about session lows. It had been higher for much of the session, but now it is sitting in the red just by about 18 points or so at this point in the session, but getting closer to that flat line.
And everybody watching, of course, the yield on the 10-year. It's above 1.6. I think it's at 1.63, 1.62. We'll be watching tomorrow the results of the Fed meeting and Chair Powell's press conference. Court, great to be with you. Thanks, everybody, for watching Power Lunch. Closing bell right now.
Tyler, Courtney, thank you very much. Welcome to the Closing Bell, everyone. I'm Wilfred Frost, along with Sarah Eisen. The Dow, S&P now lower, retreating from record highs. The Nasdaq had been clinging to gains, but also just fell into the red moments ago. Let's have a look at what's driving the action. FANG tech stocks were in the lead. They still are, but less of a lead now. Energy is the big decliner today. That sector down over 2%. A notable decline in monthly retail sales. The XRT down 2% off the back of that. Industrial production, housing numbers coming in a bit soft as well. And we're seeing momentum plays lag. The likes of Peloton, Tesla, Zoom, all off by 3 or 4%. Hotels, cruise lines losing steam as well. The Dow down 0.4%, 130 points or so, Sarah, near the session lows with 59 minutes left in the session.
Kind of drifting lower all afternoon. Coming up on today's show, a rare sit-down with the CEO of Palantir. We'll hear from the head of the secretive software firm about life as a public company and the big opportunities in big data. It's been a hot stock. Plus, a stern warning about ESG. We're going to talk to the former chief investment officer for sustainable investing at BlackRock, who now says the financial world is, quote, greenwashing the public with PR hype about climate-friendly investing. Let's focus in on the big stories that we are watching. 1 hour left of trade. Mike Santoli tracking the market action. Steve Leisman with a look at today's soft retail sales number and a preview of tomorrow's big Fed decision. But Mike, start us off with the market feeling kind of soft across the board.
Yeah, we sagged a little bit in the last hour or so, Sarah. The story for much of the session was large tech stocks, the big growth stocks, were able to get a little bit of a bounce and firm up further as Treasury yields receded a little bit. And then after a bond auction, Treasury yields kind of inched higher. A lot of the inflation compensation within the bond market was going higher. Therefore, people wondering if they're getting pre-Fed jitters. Really, though, not a lot of net movement. If you look right here, we're still kind of within that zone of what had been the top end of the range. 39.50 before yesterday was the all-time intraday higher, so 39.60. So it's not as if we've necessarily gotten any kind of escape velocity, and often we go into a Fed meeting in something of a neutral condition. Definitely still shows you, though, the acute sensitivity right now of big growth stocks to the Treasury yields. Take a look at a longer-term view as we get up toward 4,000 on the S&P. In fact, at the highs of the day, we're about 0.5% below 4,000. This is a log scale chart, so each percentage move is the same distance on the chart. And I just wanted to show how the market has sort of taken a chance to pause around these 1,000-point levels. It took actually 2 years to really get free of the 2,000 level. We got there first in late 2014, and then it really was after the 2016 election before there was really a release to the upside from that 2,000 area. 3,000 was not all that dramatic, although January here of 2018, we got to within about 4% of 3,000. Then it was really much more a 2019 story when it was kind of give and take. Finally, in the fall, got above it. And then, I don't really consider that to be a struggle with a big round number. That was obviously just a crash from an exogenous source. So that's sort of the context. Doesn't mean there's technical significance to 4,000 or fundamental, but sometimes it's an opportunity to hang out a little bit. Here's the volatility index going back to 2008. And I bring that up because we spent much of the day below 20. We cracked below 20 yesterday. The last time we were above 20 for most of the year, 2009, you got below it in early 2010. April of that year is when you saw this spike. That was when you got like the first kind of serious correction after that huge ramp off the low. So, similar shape right here. Nothing says it happens necessarily synchronously, but something to keep in mind in terms of how these cycles have tended to go, guys.
I would just note today, Mike, it is technology and communication services leading us on the upside.
Yeah.
And groups like semis, biotech, software, all the groups that were caught in the crosshairs of those rising rates. Are people breathing easier now because we're not seeing a spike in rates?
To some degree. I mean, I think a
sectors.
combination of rates stopped going higher at a fast pace, and you got a 20-25% pullback in some of those areas. So, it self-corrects a little bit, and I think it's still the case. You're still sitting on a decent-sized drawdown from the highs in things like semis and some of the cloud software stocks.
Mike, thanks so much for that. Turning now to today's big data release, retail sales for February missing estimates, dropping 3% in the latest reading. Steve Leisman has more on the economic picture ahead of tomorrow's all-important Fed decision. Steve, what can you tell us?
Hey, Wolf, the CNBC Fed survey, I'll take that first, shows the market has sped up the timeline for Fed tightening, potentially putting the Fed and the market at odds over the policy outlook. Our Fed expectations charts show respondents now see the Fed hiking rates for the first time in November 2022 and ending asset purchases in November 2021, both of those several months earlier than at the beginning of the year. 63% of our 43 respondents, they say the $120 billion the Fed buys every month, they're not needed either for the economy or the markets. 83% saying the $1.9 trillion Biden relief package, too big. The meeting comes with a report this morning of disappointing retail sales, as Wolf said, but there really wasn't much reason for concern about the consumer because their pockets, as we speak, are being filled up with a new round of relief. Retail sales down 3% in February, ex-autos down 2.7%, both worse than estimates, but it came with a huge revision to the January numbers. In fact, the best way to think about it is to take them both together. Look at this. Motor vehicles down 4.2 in February, but they were up 5 in January. Electronics down 1.9, up nearly 17 in January. Internet, the non-store retailers down 5.4, but they did 17 back in January. The question for the Fed is not whether consumers will spend too little, it's whether they're going to spend too much in the months ahead, potentially sparking inflation. Wilf?
Steve, thanks so much for that. Today, anyway, the 10-year holding steady, though inflation break-evens, of course, have been picking up, particularly late in the session. Banks suffering a little bit today, despite yields holding steady up at 1.6%. We are down 0.2% on the S&P. Still ahead, shares of Palantir have climbed more than 250% since the company went public back in September. Up next, we'll hear from CEO Alex Karp about the journey as a public company, the retail investor frenzy, and his issues with Silicon Valley. You're watching Closing Bell on CNBC. Shares of Palantir surging since its market debut back in September. I sat down for a rare interview with Palantir co-founder and CEO Alex Karp at a virtual event held by the Executives Club of Chicago, in which we discussed how big tech and Silicon Valley are positioned to evolve over the next decade.
America's made great strides and very optimistic, much more optimistic than we were years ago, precisely because we've changed procurement, because of the realization that people running these things in a clandestine military services realize that America can do very well and win, but not if it's bringing the 50,000 hours of services and that thing instead of rallying our very best of the best to our cause. The real problem on how America does in that context also comes down to the unwillingness from my myopic perch, totally impossible to understand unwillingness of a number of tech companies and engineers to support the U.S. government. Now, I don't think everything the U.S. government does is right. I don't agree with a lot of things. I'm a citizen, and like many people, I'm sure everyone listening, we have our agreements and disagreements. But the odd reality that many in Silicon Valley are not willing to support the U.S. government in military context is something that should be a source of great discussion. And I, for one, always want to hear, well, if that's the case, how do you justify the fact that you're building your company in the U.S. and driving on our highways and getting protection from countries that are unhappy with the encroachment on their sovereignty simply because they don't want to offend the U.S. government and our taxpayers? So that is a really big issue in America that many of our software elites have a very different view on how you should support the country that has supported us than, say, we do at Palantir and I do personally.
Why do you think that is? I mean, please call out some company names if you want to, but even if you don't, what is the motivation not to zip?
There's a long answer. I think the short answer is that some of them just don't have the sense God gave a goat. And they confuse having a high IQ with being sensible. But in any case, the longer answer would be something like, I think there's just a not an understanding of the historical reality of tech. We get away in those of us who are entrepreneurs for looking weird and living our own lives and not being particularly conformist because people in America see that we're creating value for them. The Silicon Valley of the first generation was building things that Americans understood would help them. If you're sitting on your perch in Silicon Valley and you're only creating value for yourself, monetizing the natural resources of your fellow Americans and others in the form of monetizing their data and providing no value to them, except for disrupting the businesses that people work at, you're going to find that your level of trust, it goes really down really far quickly. And I don't think this is something you can kind of IQ your way out of, which is, I think, essentially one of the problems in Silicon Valley. They just think that they're so smart that they can smart their way out of this. But it's just so obvious.
Who are the worst offenders?
Well, they shift. I mean, I don't know if it's helpful. Like, people, it comes in a rolling set of offenses. And by the way, I'm hopeful there at some point could be some reform, because now this is something that really most people are very, very aware of. And by the way, it's a reason why a lot of us, as I mentioned, I believe we were the first company to leave the Valley. When we left the Valley, it was looked at as something completely crazily ridiculous. Who could leave the Valley? Now, lots of people are leaving the Valley. And part of the reason they're leaving the Valley is because the brand of the Valley is not good. And it's not good because they can't answer simple questions. What does your software do to help somebody? And the answer will be, I give a lot of money to philanthropy. Well, I'm all in favor of philanthropy, but there has to be a more direct answer. What does your business do? Or maybe there should be a more direct answer. Our company does nothing to help humanity, and we're okay with that. But there's so in any case, I think that there's a rolling set of offenders. I think the rolling set of offenders will probably change over time, not for the right reasons, but simply because it just can't go on like this.
To what extent do you blame them personally? Because, for example, their motivation is just profit maximization without any other consideration, versus accept that they have a duty to their shareholders, and also if regulation doesn't exist, they have every right to continue operating in the way that they are.
I don't dispute anyone's right to work within the context of the law, and I very much believe these things should be regulated so that people can have work within the context of the law, and it is true that it's so. But If you are on the cutting edge, just to take the very simple example of that our myopic perch, helping the Western world stay as strong and become stronger in the future, and so that the West structurally wins the battles of both the software battles, but also the narrative battle of what it means to organize a society where there's wealth provision, education, civil liberties are protected, and we can have open discourse. If, in fact, you are profit maximizing in your country and that country is protecting you, you have a duty to protect the country. So, you can have, I mean, I love academic debates of this sort, and I'd be more than happy to go down the rabbit hole of, at what point is it incumbent on someone to diverge from their actual economic interest and do good? And that's a really, really important debate. But in the context of we are the global winners of X, and we are partly the global winners because we are in a country, the answer cannot be we do not support that country. And that would be my first baseline. And then after that, we can have a more erudite debate.
I'll try one last time to ask you, and again, I understand if you don't want to say it, but which company or CEO is the big offender today on that front?
Well, I'm not trying to evade the answer and invading the answer. I really think it's a cultural problem. They're sitting in their perch in Silicon Valley where they're the smartest, the best, and the richest. They don't understand how they're viewed in society or how that's viewing our society. And then when asked, can they help America, they tend to think this is a super difficult question that should be litigated with the 1 or 2 or 5 engineers in their company that don't agree with helping the U.S. government. And I think it's a cultural problem. And that's why so many of us have left this culture.
I wanted to ask about being public. You've mentioned the short-termism in the past that can come out of Wall Street by having to report every quarter. And clearly you're more in the public eye and the crosshairs once you're a public company. Do you weigh up going public and wonder sometimes whether it would have been better to stay private or not?
To some extent, battling away with short-termism on Wall Street, which I think is one of the most destructive, corrosive attributes of an otherwise interesting and largely functioning system. We told the Wall Streeters that we will focus on building the long-term health of our company, that we are going to invest in our product development and in our clients. And then, you just have to battle it out with them. But, I would say, from the perspective of Palantir, we've been at this a long time. I have a lot of people at Palantir who stayed at Palantir because they believed in our company, and to some, because they believed for reasons that sometimes are hard to understand, and I struggle to understand, they believed in me. And they, unlike many people in tech, their share price was both going in the wrong direction and illiquid, and they stayed for years and years and years and years. And now those people have shares that are actually quite valuable. And I'm very proud of that, despite the fact that we have to battle it out. We've been battling it out with Silicon Valley and venture for people. Now we have to battle out the short-termism of some people, not all people on Wall Street. And that may be the price. But I'll tell you, the fact that these people at Palantir that have been at Palantir for a long time, that stayed while all their friends who may not be helping the world very much were making big money, and their share price was both in the wrong direction and illiquid. I'm very happy for them. And it makes my life better too, because I feel even freer.
On the short-termism point, clearly it's been good for you on the share price front, and you've been in the crosshairs in a good way on the Wall Street Bets Reddit forum. Did you keep an eye on that? Is there an aspect where you worry, gosh, it's been too hot in the short term, and that means next year people are going to be asking me why the share price is falling? Do you worry about that?
Of course, you worry about a lot of things when you're somewhat neurotic and introverted. I'm not saying it's never occurred to me, but I have a lot of other worries that worry me a lot more. And I like the so-called retail investors for lots of reasons. First of all, unlike many people, they're investing their own money with no safety net. Many of them are engineers, so they actually go out and evaluate our product. And by the way, they dispel a lot of kind of what I would call slanderous critiques of Palantir written by people that don't ever seem to have engaged with our product. I really like these people. I'm very happy we DPO'd. As some of when you DPO, you give investors a chance to make money and not just big hedge funds on Wall Street. I'm very proud that normal people investing their own money with their own risk, making their own opinion, made a lot of money. And we are working at Palantir for a long-term outcome. What I would say to everybody, you, your audience, retail investors, we're in this for the long haul. If you are speculating or you are, or you're thinking about the short term, there are plenty of other things to invest in. We're building the company we believe in. We're going to do it for the long haul. There'll be ups and downs. My lawyers won't let me say more than that, but it's obvious. And if you want something else, it's a huge world. Buy some other stock. You don't have to buy Palantir. No one's forcing you. We're completely liquid. Do something else. There are a lot of other great companies, less great companies. Who knows? Everyone has their thing. I'll see you in a couple years. We'll see how we've done. We're busy in our working in our shop, basically, building the products of the future, delivering them in the present.
No argument, of course, about the share price performance so far since listed. It's been on an absolute tear. Alex Karp there, Sarah, and more to come in terms of their business, particularly on the defense side as well in the second hour of the show. But I just thought really interesting to get him there on the record about Silicon Valley culture as a whole, saying the brand of the Valley not good. What's your software doing to help people? And that many of the companies there at the moment are failing to get that message across. I pushed on names, specific names. Of course, he wouldn't quite give them, but we can guess. We can guess some of the companies he was implying.
Well, that's why it's so funny, because I kept thinking, he didn't name names, but I kept thinking Facebook, Peter Thiel, who's a co-founder of Palantir, is one of the early board members and investors and still sits on the board, I believe, of Facebook. So maybe that's why he wouldn't name names. I also thought it was a great conversation, Wilfred, because you revealed a lot about him and just his personality, however introverted and neurotic as he claimed himself was. We don't get a peek of him that often, and it was interesting to hear how passionate he was on drawing a distinction between Palantir and Silicon Valley, really on the patriotism, which is what he laid out in his letter, right, to shareholders in the very beginning when they announced that they were going public. They're working for the U.S. military and the U.S. government, and they're proud of it. And he really does call out there, I think, in a number of ways in your questions, why other Silicon Valley companies don't do that and why that's a bad thing.
Yeah, he's also proud of his eccentricities and the way he is versus, say, how Wall Street CEOs or corporate CEOs might have been, and thinks, embrace us if you want to, but don't worry if you don't. And that came across over the full 50-minute conversation, which I do believe the Chicago Economic Club Executive Club will be posting later tonight. But first, we've still got another segment to come, as we said, in the second hour of the show, particularly on their work in the defense space.
Really good stuff. Haven't heard from him since they went public. More to come with Alex Karp and Wilfred. 38 minutes left to go, though, before the bell. Take a look at the markets. We're down 100 points or so on the Dow. S&P 500 is flat. The NASDAQ is positive now, which shows you what's leading today. Technology, communication services, semiconductors are up, biotech is back up, software stocks. The Russell 2000 getting hammered, small caps down almost 2%. Up next, Moderna opens up its vaccine trials for children, and European Medicines Agency weighs in on AstraZeneca's vaccine. We're going to round up the latest COVID news headlines for you next. And as we had to break, check out some of today's top search tickers on CNBC.com. 10-year yield right up there again, always lately. GameStop also a regular on the list, only down 5%. It's a minor move compared to what we've seen lately. Apple, AMC, another meme stock up there, and Tesla down 4%. We'll be right back. 35 minutes left of trading. Time now for our virus tracker. Despite the vaccine rollout accelerating, 111 million doses have been administered. The U.S. is still recording at least 55,000 new COVID cases and at least 1,300 virus-related deaths each day. According to the TSA, at least 1 million people have passed through airports every day since Thursday as travel begins to rebound. And in vaccine news, Ohio says everyone in the state will be eligible for the vaccine by March 29th, less than 2 weeks from now. Moderna says it's studying the effects of their COVID vaccine on children in a mid to late stage trial. Stocks up 7%. And AstraZeneca, more news here, more countries pausing their rollout over fears of side effects. Now Europe's regulator is weighing in, saying that it remains, quote, firmly convinced that the benefits of the vaccine outweigh the risks of the side effects. Sticking by the AstraZeneca vaccine, boy, Wilfred, this has become so controversial. And whether justified or not, it has to be doing a number on public opinion of it.
And yet we're still waiting for the full final decision from the EMA in their review, which is expected probably on Thursday this week, when then maybe we'll see those countries lift their temporary ban. I mean, it does feel extraordinary when you see cases spiking there and at least temporary guidance from the EMA and from the WHO to say people should keep using it. But politicians know best. Yeah. After the break, Robinhood competitor, nope. Time for a CNBC News update. Rahel Solomon has that for us. Hey, Rahel.
Well, I like to keep you on your toes. Hello, everyone. A new U.S. intelligence report says that Russia and Iran spread misinformation in an attempt to influence the 2020 U.S. elections. Intelligence agencies also investigated multiple attempts to manipulate the election results and found no evidence that vote tallies had been compromised. The group that puts on the Golden Globes is being told to change or face a boycott from Hollywood stars. More than 100 PR firms have signed a letter calling on the Hollywood Foreign Press Association to end what they're calling discriminatory behavior. Changes are not made. The firms say that many prominent actors will refuse to attend the Golden Globes. And 6 NCAA officials who were getting ready for March Madness have now been benched. The referees had traveled all the way to Indianapolis for the men's basketball tournament and all had dinner together, while one later tested positive for the coronavirus. Be sure to watch the news with Shepard Smith to see how they're being replaced and what's being done to avoid infections during the tournament. But Sarah, one is the only one that actually tested positive, but everyone else has to go back home because, of course, tracing and exposure.
Of course. Yep. Rahel, thank you. Rahel Solomon. A potential rival to Robinhood will debut on the public market soon. Israeli trading platform eToro will go public via $10.4 billion SPAC, backed by banking entrepreneur Betsy Cohen. eToro, which is already available in dozens of countries, plans to start providing stock trading services in the U.S. this year. The company offering zero commission trading, but unlike most popular trading platforms, eToro does not make money by selling trading data to hedge funds. Earlier today, Betsy Cohen joined CNBC, discussed eToro's business model. Listen.
This is a year in which eToro added 5 million new registrants to its list, topping 20 million altogether, which is a significant increase and shows the acceleration of growth and acceptance of the product in the marketplace. As you've seen with other companies like Robinhood and Stripe and some of the others, valuations can grow quickly because the businesses are growing quickly.
eToro, Mike, going public, starting to expand business on Robinhood's turf. How do you see that matchup?
Well, first of all, the end market is growing so fast. I don't necessarily see it as this really scarce resource for, younger people trading stocks and crypto. It seems like everyone is kind of feasting on a pretty strong market here. Zero commissions, it kind of grows on its own. It seems in the numbers that they had this great trajectory in terms of revenues overseas without being in the U.S. market, more than 100% revenue growth last year, without a lot of profitability, but still kind of cash flow positive. What's fascinating about eToro is, in addition to having the zero commission access to crypto and stocks and other trading instruments, and in addition to going public by way of a SPAC, it also has this social investing angle on it where you can essentially just plug into somebody else's trading strategy and automatically copy it. I don't know how much that's necessarily going to take off, but it formalizes a lot of this, kind of we're on the same team and we're going to all run in a herd at certain ideas, and you can kind of surf from one or many other kind of lead traders to another. So that's an interesting wrinkle versus what Robinhood offers.
It also has spread betting, which is a way that a lot of Europeans actually invest in stocks anyway in certain countries, because then you don't have to pay tax on the gains in the same way that you can't offset your gambling losses against other capital gains. Now, that doesn't really apply in the US, where gambling wins are taxable, but the spread betting ability is interesting if that can be applied into sort of sports area as well, and whether we start to think of one of these companies as not just retail trading, but also sports betting. Long way from that, but it's a slightly different platform.
Well, it's all, I mean, it's interesting because, I mean, people have made the case that if you look at Robinhood's screen on the app for options trading, it essentially just looks exactly like FanDuel. I mean, there's just not a lot of difference. It gives you kind of the payoff amounts and all the rest of it. So it's functionally on the back end not a very different thing. And by the way, the fact that they don't sell order flow in the same way because it's not allowed in most of their markets, they're big in Europe for the most part, revenue-wise. It doesn't really mean that that the customers get all the benefit. It means they keep the spread. I mean, somebody earns the spread, whether it's a wholesale market maker or it's the the introducing broker itself.
Either way, unsurprisingly, good first day for eToro. Much more on the markets as we approach the close. There is the Dow for you, down 0.3%, 100 points or so. The low of the session was about 30 minutes ago. It was down 175 points, so we're just off that low at the moment. As we head to break, let's also check in on bonds. Still hovering around that 1.6 level on the 10-year. 161, so actually the long end of the curve, just picking up a little bit this afternoon on the day. 238 on the 30-year. Back in a couple.
Improving here into the close. S&P has gone positive. Up next, when it's bad to be green. A former BlackRock exec is speaking out about the flood of ESG messaging on Wall Street, saying the financial world is greenwashing the public with deadly distraction. He'll join us next to discuss. A provocative new op-ed from BlackRock's former CIO of sustainable investing claims, quote, the financial services industry is duping the American public with its pro-environment sustainable investing practices. In the piece, Tarek Fancy calls out Wall Street for greenwashing the public and making sustainable investing, quote, merely PR. He joins us now to discuss. Tarek, thank you for joining us. You were at BlackRock, which is front and center in promoting socially and environmentally friendly practices for investing. Why are you calling out the industry?
Well, I think that having had the experience of being there, I can say quite confidently that ESG is not as good for investing processes as people claim. And that's very important because it effectively is a financial jargon sort of proxy way of saying, does it pay to be responsible? The reality is it doesn't pay that much to be responsible. It works in a few instances, in a few strategies. It's being blown out of proportion, and none of it has any real social impact. And it got worrying to me enough that after I left for personal reasons, and I started to wonder if this was, at first I thought this is kind of like giving wheatgrass to a cancer patient, right? The world is suffering from the growth of climate change and other ills. And, wheatgrass is a nicely marketed idea, but there's no reason to believe that it'll help stop the cancer. But at least it might, make people feel a bit better or whatever. And after I left, I started to wonder that the messaging was so aspirational and just out of touch with what I'd seen about the reality of that thesis, that I started to wonder, is it actually worse? Is it wheatgrass that's convincing a cancer patient to actually delay chemotherapy? So I talked to the president of a university I know in Canada, and we teamed up and did a study. And it showed definitively that the more you give people messages around a whole bunch of ideas around social purpose and business will do the right thing all by itself, all voluntarily, all stakeholder capitalism, the more you mislead the public into believing that free markets will correct themselves and that we don't need government regulation. And that comes directly at the expense of the youngest and the poorest in society.
I just want to stop you because we did reach out to BlackRock on this, got a very long statement from them, but what BlackRock says is that they believe greenwashing is a risk to investors and detrimental to the asset management industry's credibility, which is why we strongly support regulatory initiatives to set consistent standards and increase transparency for sustainable portfolios. So it sounds like a little bit what you're saying. They also go on to say that they have launched some ETFs that do remove all fossil fuels, which is one example you called out, that some of these funds do still invest in oil companies or other non-sustainable businesses. So what specifics are you pointing to here?
Well, so let me say two things. First of all, BlackRock is not the worst offender in the industry. I would actually tell you that probably we're better than average. The issue is that the entire system doesn't work. And where BlackRock is culpable is that it's promoting a thesis that tells people that these products, whether done correctly or incorrectly, whether they're sloppily made and they include a name that they shouldn't, or the opposite, they're telling people that these things have social impact. And I can't stress enough, there is no evidence that any ESG ETF has any positive social impact that I've seen. There's no evidence that by buying a low carbon ETF, you are actually going to lower emissions. There is evidence that fixing the rules of society through government regulation actually can do that. We're doing it through Wall Street makes no sense. They're capital allocators and they're going to chase yield and profitability. And if you put a carbon tax on, every portfolio manager at BlackRock and elsewhere will adjust their portfolio to change the changed reality. If you go and you tell them that, fighting climate change makes money and that this is great for the world and, you should lower your carbon footprint because it's good for the world, the vast majority of those strategies don't do it because they're too short term, they're structured in ways that those risks don't matter. And in general, it matters very little and it creates little social impact. But what it is doing is creating a giant societal placebo that's lowering the chance that we're actually going to have any kind of regulatory reform. And I think that that's irresponsible. We're 13 years after the financial crisis. We're decades after we've known that climate change is the greatest market failure in history. And right now, business leaders are peddling a silly markets correct themselves idea. And that I have a problem with. I think BlackRock is doing an okay job, but when Larry says in January that I prefer the capitalists self-regulate, I think he's doing a massive disservice to society, and that the people who are going to be left holding the bag as we delay are going to be the youngest and poorest.
What about the rhetoric, Tarek, when certain asset managers, not necessarily naming names, say it's better to keep holding these stocks and engaging with the companies and try and get them to change? Do you think that's disingenuous given how long we've been broadly talking about ESG? If that was a new initiative and you try for a year and then sell, perhaps, but this has been going on for a while, even when you're at these companies. Is that fair?
Yeah, it is. I mean, look, selling a company is even worse. Divestment has absolutely zero impact whatsoever. I mean, there's no reason to believe that you selling the stock of a company is going to stop them doing whatever you find objectionable. The way you actually stop them doing what's objectionable is you fix the rules. And the issue I have with the messaging coming out of Wall Street is that it's implying that they can do things that they can't. They're capital allocators and they react to the reality on the ground. If you want to make changes, you have to regulate the actual companies doing it. You have to regulate emissions. You have to regulate, if companies are paying employees at levels where, they can't have a living wage and most of them are on food stamps, there's probably a solution that includes higher taxes or other such things. It's not a private equity fund that claims to fight inequality, right? And this is where Wall Street, they should just be honest. We need regulation. It's decades after we've known that climate change is the greatest market failure in history. And by the way, I would add that right now we're facing a systemic crisis that science has told us is going to kill us quickly if we don't move fast. When it came to bending down that curve, every single business leader understood we needed government action. They understood we needed restricting travel. We needed to make masks mandatory. We needed to close high-risk venues like bars. Now, a young person who's 25 years old and works at BlackRock would be forgiven for wondering why it's not almost a conspiracy that when it comes to something that science is telling us to kill us slowly, we have to bend down a curve, the greenhouse gas emissions curve. Those exact same leaders that agree with government action on something coming quickly that affects their near-term interests suddenly think that the free market is a good enough answer for future generations to preserve their livelihoods.
Tarek, thanks for joining us today. Much appreciated.
Thank you so much.
We'll talk much more about ESG investing in just a bit when we're joined by the CEO of Investment Manager.
All right, you guys, let's give a little update here. We got only about 13 minutes until the market closes. I apologize. I've been over here working on other meetings and other things for the majority of the day, so I haven't been able to chime in, but that's fine. Been watching the market along the way and see what things go. I'm sure you may have noticed that I've replaced the top graph with FTCV. So this is the FinTech Acquisition Corporation 5. Basically what this is a SPAC that is merging with eToro, the online trading platform, to go public. They announced it and started trading early this morning. So it's the second relatively high profile SPAC that went public in a row. Yesterday it was AEVA or AVA, and today it is FTCV. I'm sure they will change their name of the ticker to eToro, or I'm not sure if maybe there's just the merger itself may not have actually happened. It's just been announced today. Was not listening to all the specific news this morning, but that's what that is. So basically similar to CCIV is the high profile Lucid Motors SPAC. This is the higher, somewhat high profile, maybe not as high profile, but somewhat high profile SPAC merger for eToro. So when they went on CNBC this morning at about 9:30, right about here, you see a little bit of growth, a little bit of volume, and then it tapered off. And then they went on probably a different news channel right here at 10:30, and you see another increase, and it tapered, and then another one right here, and then it tapered, and then another one over here. So you see they're probably making the rounds on all the TV channels today doing interviews, and then finally another one here. Usually when they do that, you see the big volume spikes right there. What's interesting about this one compared to yesterday's and some of the others is it didn't just spike once and then taper for the rest of the day. It's spiking and then slowly coming down, spiking and slowly, spikes slow. And each time it creates a new level of support, which is awesome. I mean, I just watching one like this in a day, haven't seen that happen as well as it has in the past. So it might actually prove to be a fantastic thing for the stock's longevity. You'll see it's up quite a bit today, up 42%. I did, when it first got on CNBC this morning, I bought 50 shares. And that was at, let me see, what was the trade price I bought that at? It was relatively cheap because it was right when they first got on, about 1 minute into the interview. $12.69, and it's now at $15.15. So I've already, just since I made that trade buy this morning, it's up 20% on that investment. Obviously not a huge investment, only 50 shares, only a few $100, but it's already returned me $120 in profit if I were to sell it now. I do have a sell order in at, I had it at $16.99, brought it down to $15.99, ended up going back up to $16.77 because that would net me $200. Actually, you know what? I didn't do this. I was going to take that down to an order of only 49 shares. So then I can keep one share. I like to keep one shares of a lot of it. Change down to 49. And that'll give me a $200 profit for the day, and I can still keep one share. And that allows me to track it a little bit easier than, say, just keeping it on my watch list. But anyway, I'm very interested in this. I mean, I think even eToro itself, some of the other trading platforms that are going to go public or currently are public, are good speculative investments for me. Of course, you do your own research and decide whether it's right for you. But for me, I like getting on those. So we'll see if it takes a little bit of spike here in the last 9 minutes. It might not. We'll see what happens after hours. Either way, I'm up 20%. I don't think it's going to play 20% overnight. So I'm probably safe in my investment if I happen to not sell it today. We're also seeing Express making a late afternoon run. GameStop, which was a dog earlier this morning, down about 20+%, has made a pretty solid comeback up here. And I think it actually went positive for a moment here around 220. And now it's at 213. Costs have just been non-eventful today. A little bit of a run here, but nothing else. They're down 6.82. GameStop down 3. AMC down 7. Express down 9.3, but it is making a run. If it can maybe get up closer to 5, might be a good finish. So overall, not a bad day. I've got Apple posted up here with just news on the chart. They're having a pretty solid day. They're only up 1.3%, but for such a high cap stock like Apple, that's not a bad day. Overall, Dow and S&P barely red. S&P might, if it gets lucky, eke out some positive territory today. It's very close. Nasdaq is green and it is barely. So all three major indexes, not a whole lot of movement. Oil's down slightly, down 1%. Bitcoin, although it's moving up, is down a little less than 1% for the day. Ethereum and Doge are a little up, but all three of the major cryptos, these three major cryptos that I'm watching anyway, took a hit overnight last night. Treasury index yield still going up to 1.62%. It's not translating into a massive sell-off, which is good. I think people have, rather than being shocked by the increase like they were 2 weeks ago, now sort of getting used to this increase in stock price or in interest rates, so they're adapting to it and going along the way. Overall, I think this is not really a great day, even though stocks are not largely negative, or the indexes are not largely negative. A lot of individual stocks are not doing super hot. And a lot of the more popular stocks are the ones that are particularly not doing that hot, with the exception of maybe Apple. Amazon's also slightly up. So, those two are probably really driving Nasdaq and S&P to be positive or near positive. But overall, a lot of other stocks are really not performing the best today. So it's likely just going to be one of those slow sideways days. That's kind of what it looks like. So that's all right. Every now and then you need those days. If they eke out a positive number today, it'd be fantastic. I think it's the seventh day in a row that the Dow's been positive, which is fantastic. I didn't even know that until this morning. I think every day since March 4th or March 5th, it's been positive. So if it somehow comes back and takes a positive turn in the next 5 minutes, that'd be great. But I think it's got too much room to make up. 0.28 doesn't sound like much, but in such a low volatility day, that's quite a bit. So that's about all we're going to see. I'm going to turn it over to the news here and round out the day for the last 5 minutes. And otherwise, I'm sure glad you guys joined again today. I've got 17 views right now, 2 people watching, 17 overall views. On a record yesterday with 20. I know it sounds terrible, and if you're watching this in 2022 sometime when I've got 100,000 subscribers, you're thinking, why the hell is he excited about having only 20 views? It's because we just started last week, and so I'm happy to have 20 views. 20 views at an average of 30 something minutes per view is 10 hours of people just staring at my screen. So that's pretty cool. I'm not going to lie. That's pretty cool. I didn't really expect more than 5 to 10 views per day from some of these, and so we're doing what we can. If some crazy thing takes off, and I do happen to have 100,000 subscribers a year from now, I'm sure we'll have much better looking systems. I hope, even though I like Thinkorswim. I might have a partnership with, I don't know, maybe eToro. Maybe I'll use this investment into something, or maybe I've seen some of these guys um, have their partnership with Webull or something like that. But either way, that's not really the bet is to have 100,000 subscribers next year. It's just to slowly grow, and you guys can watch the market just like I'm watching the market. If I have it open all day anyway, why not have it open all day on YouTube too? And you guys can watch what's going on, see what trades I'm making while I'm making them, see what else I want to talk about when I see some news or I see something going on with one of these stocks. I'd rather do it with somebody than alone. So that's why we're here, and I appreciate you guys joining. So I'll turn it back over to the news so you guys can listen to Closing Bell with CNBC.
Interest rates are hurting home builder sentiment. Diana Olick's got the details on that for us. Diana.
Wilfred, homebuilder sentiment fell 2 points to 82 in March, according to the National Association of Home Builders. Anything above 50 is considered positive, but rising interest rates and higher costs are weighing on the builders. Supply shortages and high demand have caused lumber prices to jump about 200% since last April, adding $24,000 to the cost of a new home. Home prices are likely why current sales conditions fell. Sales expectations are improved, and buyer traffic was unchanged. Now, Lennar is out with earnings after the bell. Demand continues to outstrip supply, so the builders are definitely in a sweet spot heading into the spring. Back to you guys.
Diana, thanks so much for that. Mike, clearly a sweet spot's been at play for these names for quite some time. I guess the question is, when do mortgage rates get to a level where that could start to change the bargain a little bit?
Yeah, I mean, I guess it probably could start because the affordability issues are starting to squeeze some parts of the market. But for new construction, I think most things should be pretty conducive because what we have is a shortage of available homes on the market. I think that's a very well understood, very well established reality, and that's probably largely in a lot of the stocks. Also, on the other side, I think one of the bigger benefits housing-wise for the economy is you have this wealth effect that's already kind of filtered through. You had some reports recently of a big round of cash-out home equity refinancings, and that's all just continuing to refresh the system, even if perhaps the home builder side of the direct housing plays have already been pretty well exploited.
It'll be interesting to hear Lennar's comments on that front. Joe, rising rates, headwind for the home builders?
I agree with Mike. I don't see that it's going to dramatically impede the housing demand. I still think there's further to go. I do think material costs rising is going to be a concern. I have exposure to Louisiana Pacific, ticker symbol LPX. That's a second derivative play on that. And listen, I also think the comps are going to be much more difficult for these home builders, whether it's Lennar or the ones that are actually outperforming year to date, which is Toll Brothers and D.R. Horton.
We've got 2 minutes left now, a little over that in the trading day. Mike, what are you seeing in the market internals as we head into the close?
Well, on the weak side in terms of market breadth, and that's been pretty much the case all day. This is one of those days when those very large stocks kind of flatter the S&P 500, and under the surface, it's more than 3-to-1 to the downside in terms of New York Stock Exchange volumes. But however, if you want to look at new 52-week highs versus lows in the New York Stock Exchange, and a lot of people who study the kind of box scores of the market like to say, look at this enormous number of new highs, 388 today on the New York against 21 new lows. This continues a streak of the last several days, an abundance of new 52-week highs. But guess what? We're almost 52 weeks past a market crash. So a lot of stocks, just by sitting still, are getting to 52-week highs because they're managing to eclipse the first price back in that study. So I think it's helpful. It's on a forward-looking basis. It's a good thing, but it's not too surprising considering where we are in the calendar right now. The volatility index mentioned earlier, it had slipped below this 20 mark, which has become very widely watched. It kind of ended up being the support for this indicator. Not surprising we're not crashing ahead of a Fed meeting here, even though the market itself has basically been sitting still all day. But it looks like right at 20 right now as the S&P pretty much goes near the flat line, guys.
Just above 20 for the VIX. As Mike was saying, it had been lower early in the session. We've got just under 1 minute left in the session. The S&P's down by 0.1%. The Dow's down a third of 1% or 106 points. The low is down 175 points. The Nasdaq is holding on to slight gain, 0.1% or so. The Nasdaq 100, though, up 0.6%. Communication services and tech, the two best performing sectors. In fact, the only two sectors that are really meaningfully higher. A couple of the others are just positive, and then about half of the sectors are negative today. Energy down nearly 3%. Industrials down over 1%, as is financials. Those three recent outperformers pulling back today. 10-year yield just pulling back again to be 1.608 at the close. The 30-year is higher, fractionally 237 on the day. Oil slightly lower, gold slightly higher. At the bell, Sarah, we are down 0.1% on the S&P, a third of 1% for the Dow, and the Nasdaq Composite holding on to 10 basis points of gains.
Nasdaq only one there to close in the green. Welcome back, everyone, to Closing Bell. I'm Sarah Eisen, along with Wilfred Frost and Mike Santoli, CNBC Senior Markets Commentator. Take a look at how we finished up the day on Wall Street. The Dow closed down 128 points. Looked like we were recovering through the final hour of trade and then dipped lower there in the end of the day, breaking the winning streak we had. We're coming off of 7 straight up days for the Dow. So taking a pause today, down 0.4%. S&P 500 closing lower a little less than that because you did have strength in the S&P in groups like technology and communication services. Those were the top performers. Weakness, though, in energy, industrials, financials, consumer discretionary helped lead the index down. Earlier, just after the open, we hit an intraday record high on the S&P, but couldn't hold that momentum throughout the day. The Nasdaq closed positive, which speaks to the gains we saw in sectors like the chip stocks. Moderna had a very good day, 8.6% after announcing trials for young kids. Software starts, big cap technology worked today. As Mike was saying, a little defensive there. The Russell 2000 index of small caps, big pullback there, 1.7% lower. Coming up this hour, NYU finance professor Aswath Damorodin on why the current market rotation will continue to gain steam as long as interest rates keep rising. Plus, we will bring you quarterly results from CrowdStrike, Coupa Software, and homebuilder Lennar as soon as they are released. All of them close lower today. First, though, let's talk about this market. Joe Terranova from Virtu's Investment Partners still with us. Michelle Meyer, head of U.S. Economics at BofA Global Research, joins the conversation. Welcome, Michelle. But first to you, Mike, on what we learned today. You called it a defensive feel. And certainly, if you look at sectors like utilities and consumer staples, they're at the top of the pack.
Right, and it really reflects, Sarah, this kind of benign rotational action that we've had for a little while right now. You know, the cyclical groups, you mentioned 7 days up for the Dow, was it? Well, it was primed to pull back. You had the financials ready to probably just ease back because they've had such a good run. So when that happens, is it going to be about defensive sectors like the NASDAQ 100 and utilities and such taking up a little bit of the slack, or is it going to be a broader pullback? Today, it was just rotational. Market often likes to glide into a Fed day kind of in neutral, not really laying heavy bets on either side. It seemed like it basically did that. A little bit of a flutter of concern once yields did perk up in the afternoon, but seemed to dissipate by the close.
Michelle, why were the February retail sales so weak? Is it easy to explain it away, or is it something to be concerned about?
It's very easy to explain it away. Three factors stand out. First, you have a payback after the stimulus-induced increase in January, which, by the way, was revised even higher. So it was exceptional growth in January. Month-to-month basis, you end up seeing a bit of a payback. The second and important factor is that we had a winter blizzard that hit the country, particularly in places like Texas, and there was considerable weakness in spending as a result of that. And finally, and I think importantly that people might not necessarily realize, is tax refunds this year were delayed by about 2 weeks. And typically the low-income consumer receives quite a boost in February as a result of the tax refunds. And that didn't happen this February. It's going to be pushed into March. So as we look ahead, we think we're going to see phenomenal spending in March as stimulus checks kick in, as those tax refunds kick in, and you have a weather reversal.
How do you expect, Michelle, Chair Powell at the Fed tomorrow to address what's been happening in the bond market? And do you think he'll change his tune at all with regard to his policy?
Yeah, so Chair Powell has to strike a very delicate balance. On the one hand, the outlook has become more positive, and he has to allow that to be reflected in his comments. Certainly the forecast in the SEP will be revised higher. And the risk profile has also changed. When you think about the sentiment throughout last year, it was really concerned about downside risks. And those concerns have abated given what we've seen from fiscal stimulus, given the recent economic data and the progress on COVID. At the same time, he doesn't want to come across too hawkish where interest rates spike and you get too much tightening of financial conditions earlier than the Fed would like to achieve. So to me, it's about acknowledging the better data, but also reinforcing the idea that there's asymmetry in the reaction function right now, and that they are trying, quite determined, in fact, to get this inflation overshoot and a broad and complete recovery.
Mike, what would spook the market tomorrow from Chair Powell?
Well, I think the main thing the market is on alert for, maybe clenching up against, is a lack of concern, which he's already established, about how high longer-term bond yields might go. In other words, not saying that, look, the market is got to find its own pain threshold there if yields are going to go higher, as opposed to the Fed getting nervous about it. So perhaps that's the area of concern. I'm not sure that bond yields are set to rip higher no matter what. I mean, obviously, there's all the fundamental reasons for them to do so, but in the short term, there's a lot of people short the treasuries right now, so I'm not sure if field position-wise yields are going to fly, but it does seem as if that's the main area. But really, Powell can say, our mandate and our self-appointed mission is not GDP forecast for this current year. It's not, is the economy going to feel like it's running hot? It is employment and getting back to full employment. And there's still a long way to go on that and years. So I can see that being a little bit of a flare-up of concern. And then sometimes the market says, actually, after all that, nothing has actually changed, has it? So you never know exactly what we're positioned for in terms of a reaction. But I can guarantee there'll probably be more than one reaction afterward, whether it's, up and then down or down and then up.
Joe, is there anything Powell could say or do that would change your thesis on stocks here or your positions?
Well, no, listen, I'm bullish as it relates to equities. And I do think, as I said before, the momentum targets another 20 to 25 basis points higher for a 10-year Treasury. I don't think that takes the air out of equities overall. I think we're growing comfortable to normalizing the environment. The one concern that I would have is that we make a policy mistake, and the policy mistake wouldn't be monetary, would be fiscal. And that would be, there seems to be this eagerness to introduce a higher tax structure for individuals and corporations. Let's make sure the economy has fully healed and that we are on the path to restoring labor to where we were previously before we actually enact what is going to be a fiscal tightening by raising taxes.
Michelle, what is your forecast for inflation for the rest of the year? And when do you have it peaking? My point being, if it does pick up more than expected, will it only be temporary?
Yeah, so I think it's actually extremely important to think about your short-term forecast for inflation versus a longer-term forecast. Short-term inflation is heading higher. Obviously, the base effects, but beyond that, you have a lot of inflation bottlenecks that can lead to increases in inflation. So we can, and very likely will be at or above target in the next few months. But much more important than that, especially to the Fed, is how much what is the path forward for inflation? Can you see a continued above 2% target? And that, I think, is going to be a function of, one, a broad-based improvement in the labor market. They have redefined their target for unemployment. It is this broader measure of maximum employment where wages are rising across the economy. And number two, it's inflation expectations. Are inflation expectations elevated, and are they rising? If so, I think you can reasonably argue that inflation in the longer term will be higher. So yes, the trend is higher for inflation, but at the moment we don't see alarming signs yet.
But how high, what do you think Powell's threshold is in terms of an inflation rate? Because we are seeing expectations rise, and we could start to see these numbers come in hot. So how high can he tolerate it?
So I think in the short term, he's going to ignore the spikes. And I think that's the right thing to do. And you can look at the components and see what's driving inflation. And that's not going to be worrisome. In terms of kind of that medium-term outlook or even the next few years, I would say core PCE between 2 and 2.5% is probably a reasonable range for the Fed before they start to get really concerned about a troublesome inflation environment. But also it's more specific measures. It's what's the trimmed mean inflation measure doing? And again, what are survey measures of inflation expectations doing? Because that's going to tell you what the future holds as well.
Coupa Software earnings are out, and Frank Collins got the numbers for us. Hey, Frank.
Hey there, Welp shares in Coupa Software up 8% right now after a beat on the top line and a surprise beat on the bottom line. Estimates were for a penny loss. Instead, the company posted EPS of 17 cents a share. Coupa focuses on business spend management software. That's helping companies manage their supply chain and their inventory. Their Q1 guidance a bit mixed, but the full year guidance was very strong, and you're seeing the result right now. Again, shares up over 8% in after hours trading. Back over to you.
Frank, thanks. CrowdStrike earnings also out. Let's go to Josh Lipton with those numbers. Josh.
Sarah, CrowdStrike reporting Q4 results here. 13 cents earnings per share. That's a beat. Street was at 8 cents. Revenue also a beat. 264.9 million. Street was at 250.4 million. For Q1, they say they're looking for between 5 and 6 cents on the bottom. Street was at 4 cents. They are well above on the top line in their Q1 guidance, calling for between 287.8 and 292.1 million for the year. They're basically in line on the bottom, but again, well above the top in terms of expectations. CEO George Kurtz here saying in a statement that combined with strong secular tailwinds, he says, including digital transformation and an unprecedented threat environment and our expanding tech portfolio, portfolio. He goes on to say, we believe we are in an ideal position to further extend our leadership in the security cloud category that we pioneered. Remember, heading into this print, the stock had come under some recent pressure. It was down about 10% so far in March, but let's keep that in perspective, up about 500% in the past 12 months. Back to you all.
Josh Lipton. Josh, thank you. And don't miss Jim Cramer's exclusive interview with CrowdStrike's CEO to talk about the quarter tonight on Mad Money. Mike, a pair of beats there, both stocks higher after hours. Coupa's up 7%. And to Josh's point, for a name like a CrowdStrike, it had gotten caught up in the sell-off and the concerns about valuations after it had been a big winner.
Yeah, I was going to say it's a little bit of a test for whether there's still the nerve to get aggressive in some of these very high value names that did get caught up in the big sell-off, and they still have a lot of ground to make up. The highs in both cases back in mid-February.
We will have to leave the conversation there. Joe, Michelle, thank you both very much for joining us.
Thank you.
So to come, NYU finance professor Aswath Damodaran on why he says the market is delusional when it comes to the Fed's ability to slow down rising interest rates. Plus, Nuveen CEO responds to the claim last hour that Wall Street is greenwashing its ESG practices. We're back in 90 seconds. The recent run-up in interest rates and recovering economic numbers has been boosted by the rollout of vaccines, and it's put eyes on Chair Powell. While change to the Fed's accommodative policy stance is not expected, the two-day meeting will produce updated forecasts for the economy and interest rates. Here to talk more is finance professor from NYU Stern School of Business, Aswath Damodaran. Aswath, thanks so much for joining us. Good to see you.
Glad to be here.
So let's start with your outlook for rates and the ability that the Fed has to control them. What is your take on that for the rest of this year?
And ultimately, I think the Fed can influence rates. It can't set them. And the simple rule is that if growth goes up to 2 or 3%, inflation kicks up to 2%, I don't see how the Fed keeps rates at 2% or 1.5%. I think the market, if it believes the Fed can keep rates at whatever it wants them to while getting the good stuff, the earnings growth and the economy coming back, is being a little dysfunctional and delusional in its expectations.
So is your expectation that they will get the growth in the earnings, but rates will follow, or that they won't get the growth in the earnings?
I think we're going to get the growth in the earnings, the growth in the economy, and rates will follow. By itself, that's not deadly for stocks. As long as earnings kind of keep up with the rates going up, I think the market will be okay with it. After all, that's what we've had since the start of this year. The T-bond rate is up from 0.93% to 1.61%. That's a pretty hefty rise, no matter what the Fed might think about it. So I think the Fed can live with rising rates, but it depends on why rates rise. It could be because of inflation, which is much more deadly than I think a growth in the economy.
You're always asked about Tesla as the dean of valuation. We need to know what the professor thinks about the valuation of Tesla now at 676. It's certainly come off the highs. It had a pretty steep sell-off. And I know you've been in and out of the stock. Yeah. What do you make of it now?
Well, I'm sorry I sold so early, but at the same time, I think the stock is on a momentum ride that's been unmatched, I think, in market history. But I think it's time to give back some of those gains, and I think there'll be some consolidation. I think with Tesla, it's always you get 5 steps forward and then 2 steps back, but you look back and it's always net 3 steps. So I think that at 676, I still think it's too richly priced. Hey, but what do I know? The stock went up to 900.
In terms of rates and their impact on different types of stocks, are you confident that rising rates will hit more broadly, maybe Tesla aside, some of those more richly valued momentum names? Or is it possible for the next decade we see growth and momentum outperform once again?
I think in general, when rates go up, growth companies feel the pain a little more than mature companies for a simple reason. Their earnings and cash flows are way out in the future, and higher rates make them less valuable. That's always been true. But if you add to that the fact that growth stocks have had a tremendous decade, I mean, you're looking at gains that have mounted over the years. I think growth stocks have a little more price appreciation to give up. So I don't think growth is going to beat value in the long term, or that value is going to beat growth in the long term. I think the steady state now is you're going to go back and forth. And I wouldn't be surprised to see value have its moment in the sun, at least in the near term.
What do you think that's going to mean for some of these IPOs and SPACs, which have received so much attention and a warm embrace from Wall Street? Do you see that as frothy?
I think that depends on what the overall market does. If you're getting an overall market it's not dropping, it's up 3% or 5%, the IPOs and the SPACs will continue, even if growth stocks are not doing as well as they used to. But if you get a pullback on the market, then I think you're going to get a re-examination of these growth stocks. So I think that's what's going to drive the reception you're going to get for growth stocks and for IPOs and SPACs going forward.
What do you think of the traditionally negatively correlated assets to equities in the year ahead? I mean, it seems like bonds aren't going to be rising in price, even if we see a bit of a pullback in stocks, given what we've been talking about. Are there any other assets that are going to act as good protection in the year ahead?
The question I was going to ask was what negatively correlated assets? I mean, last year, in fact, I looked at the correlation across every conceivable asset class. There wasn't a single asset class that was negatively correlated with stocks. Gold had the lowest correlation, but was still positive. And Bitcoin behaved like very risky stocks. So there's really no place to hide. If you think financial assets are overvalued, there's really no place to park your money right now. And that's a reality we face as investors. And I think, when we securitized every single real asset on the face of the earth, we've kind of, got what we wanted, which is everything moves together.
What about Bitcoin? Have you taken that up as a valuation case study and attempted to put any sort of number on that? I think you've spoken before, said it's speculative. But what do you think now?
It's a pricing case study, not a valuation, because whether Bitcoin is a currency or a collectible, it cannot be valued. It can be priced. And the question we can ask is $50,000 or $60,000 a fair price for Bitcoin? From my perspective, I don't see it as a fair price. Why? It's not a very good currency. It's not used very much. And as a collectible, it's gone up a lot, but it's not gone up at the right times. In fact, last year when stocks were collapsing, Bitcoin went down even more. That's not what you want in a collectible. So based on what it's done so far, I don't see why people are so upbeat about it. The only pitch I hear for Bitcoin is I've made a lot of money on it. But that's not telling me much about why I should be holding Bitcoin in the first place.
Well, there are those that say crypto is going to change the world and that the US dollar is going to eventually become more worthless.
And I don't have a problem with that, but it has to be a better designed crypto than Bitcoin. Bitcoin is a crypto designed by paranoids for paranoids. And it's really not a crypto that you can use as a currency on a broad basis. So I think there'll be a good cryptocurrency. I just don't see how Bitcoin can be it.
Not a believer. Aswath Damodaran, thank you very much for joining us.
Thank you.
Good to get your take. Up next, Mike Santoli looking at what happened the last time Wall Street was all in on value stocks. You may be surprised by the answer. Plus, homebuilder Lennar set to report in just a few minutes. The stock has been a big pandemic winner, up nearly 150% over the past year. We'll break down the results coming up on Closing Bell. Minor declines today for the Dow and the S&P. NASDAQ closed positive. Let's go back to Mike Santoli, who's looking a little deeper at the value trade. Mike.
Yes, a little slippage in that value trade, but really coming off a great run. What we normally talk about, let's say the S&P 500 value versus growth, well, it has had a great advantage over the last 6 months or so. This is where you take the S&P, more or less split it in half, assign companies to either growth or value. But look at the pure value index. S&P 500 pure value, I think about the 100 cheapest stocks statistically based on price to book, price to sales, trailing price to earnings, all of the metrics that people a year ago were saying it's broken, it doesn't work anymore. Well, now it's been flying. And this is from the B of A Global Fund Manager Survey today. How many people think that value will outperform growth from here on out? Well, look at this. It's a record high percentage of managers saying that that's in fact going to be the case. It's obviously chasing this trend. And the last time we saw this was about late 2013, was also when yields were rising, the Fed was tapering, we might get an economic acceleration. That was really almost the birth of FANG, and growth did take over from there. I'm not saying that's what we're poised for here. However, there has been a big comeback in a short period of time for value. It might not be as much of an either-or market, although on a 10-year basis, value is still way, way, way behind. So if you believe in mean reversion over the long term, there still are some tailwinds here that could make these managers look right for a while.
And Mike, I
So
guess,
you're saying it's getting a little crowded?
It's certainly getting crowded, at least psychologically. Sarah, it's not clear to me that people genuinely have their positioning in the same place as their minds at this point. But I think everyone has bought into the notion that they should be in more cyclical and value stocks. Although what's very interesting is this week, a lot of strategists on the sell side are saying that they're getting a lot of questions is it time to take profits in cyclicals? Is it time to lighten up on the value trade? That suggests that maybe there's not a lot of high conviction behind this trade. It's much more about just making sure you don't get left behind.
But Mike, the other big difference, I guess, to that 2013, 2014 peak in this chart is the market cap comparisons. And in that sense, you could argue there's still a lot of catch up for the cyclicals versus some of those growthy names.
That's right, yes, because in the intervening years, those growth companies became so enormous. So that's where it is still pretty lopsided. I just think that, in the short term, a lot of times this is just kind of predicting the last few months as opposed to being very forward-looking.
Mike, thank you. Up next, the CEO of asset manager Nuveen on how the coronavirus pandemic has changed ESG investing and the big 3 risks his company is focusing on. Plus, March is Women's History Month, and we're spotlighting some of our CNBC contributors. Here is Requisite Capital's managing partner, Bryn Torkington, with advice from some famous Texas women.
Ann Richards, former governor of Texas, used to say in a crowded room that Ginger Rogers did everything Fred Astaire did. She just did it backwards and in high heels. Beyonce. She always says, never let success go to your head, and more importantly, never let the failures go to your heart. And finally, some dime store advice from me. Work smarter, not harder. Most important, believe in yourself, because if you believe, you will be believed.
There is no evidence that any ESG ETF has any positive social impact that I've seen. There's no evidence that by buying a low carbon ETF, you are actually going to lower emissions. There is evidence that fixing the rules of society through government regulation actually can do that. We're doing it through Wall Street makes no sense. They're capital allocators and they're going to chase yield and profitability.
That was former BlackRock CIO of sustainable investing himself, Tarek Fancy, last hour, calling out Wall Street and its sustainable investing practices as being merely PR. However, the latest data from Morningstar shows there is still strong support for these funds, with more than $51 billion in new investments added last year. For more, let's bring in Nuveen CEO, Jose Minaya. Nuveen manages more than $33 billion in ESG-focused strategies. So, Jose, you're a perfect person to ask about this claim that a lot of it is just nonsense, and it makes higher profits for asset managers like yours with higher fees, but that doesn't really address the problem.
Sure, and thank you for having me. Look, I think that narrative, in especially the term around greenwashing, it has been accelerating over the last several years, but you got to understand it's a byproduct of demand, right? As you mentioned, what we are seeing today is significant demand for ESG, labeled products. There's also been a different narrative, though, around clients, wanting to understand ESG risk factors better. How does it impact their returns or potentially even hurt their returns? Just about every inquiry we get from a new client today is asking us, for information around how do we deploy that? How do we look at these risks? What is our approach to ESG as a firm? So that, of course, is leading a lot of firms to go out there and make statements, whether you're an issuer or an asset manager, right? Trying to respond to that need for transparency and accountability from stakeholders, clients, and shareholders alike. And I think that's a good thing. It's a good thing that these things are popping up and they're being called out. It's a lot harder today, though, to do greenwashing, because what you're seeing is individuals like Tariq, and now you're also seeing consultants, whether it's a Morningstar that's rating managers and providing transparency on how they do this. You're seeing policymakers, regulators looking at this issue. So I think what you're seeing is a sophistication in the industry and bringing this more to light. And I think it's needed because there's a lot of acronyms, whether it's ESG, responsible investing. There's a lot more that we need to bring in terms of consistency and what it is and what it's not. Because for Nuveen, I could tell you, we would never claim to own the cleanest companies on the planet, but we do claim to try to drive and understand those risks and drive engagement and transparency.
So you mentioned the regulators. The SEC does have a new task force devoted to looking at ESG disclosures and transparency there, and make sure that the commitments are followed up and are not misleading. Do you expect that to work? What do you think is going to be the result of that?
I think this is the process of any industry and kind of the maturity of it, right? As again, what's driving this today is demand, right? And it's there. And one, it's also people not just, it used to be that narrative of I'll get lower returns, higher fees. I just don't want to invest in sin stocks. Today is people can look out the windows and see forest fires, natural disasters, and these things are impacting portfolios. It's driving demand. So policymakers are waking up to this. The flows are coming in, and there is a lack of transparency. So what I do believe is that combination of, as asset managers, what we do is manage risk. That's our job, and it's our fiduciary duty to optimize returns. Where policymakers can come in and regulators is helping drive consistent standards, have the right language and transparency, so that we can all play in a better level playing field.
Jose, as you look at the decade ahead for your broad industry, what do you think will see the largest inflows? Individual stock trading by retail investors or others, actively managed funds that maybe command a 1% or higher price, or ETFs?
I think you'll continue to see a trend towards from active to passive. Now, I will say that the next 10 years will probably be lower. There'll be more volatility, lower rates. So I think you will see active managers kind of do better than they have done in the past. But it's going to be around more outcome-driven solutions, right? Clients, they are no longer asking a question around, do I buy this particular bond or this particular stock? They're looking for outcomes, right? So how that plays into the mix, and they're looking for things that drive alpha, right? So I think you are going to see increased flows in ESG. You're going to see more increased flows in alternatives and less liquid vehicles, because today it's very hard to hit your targeted returns in your traditional 70-30 or 60-40 type of portfolio. They're going to be looking for better correlation, They're going to be looking for better income because I do think over the next 10 years, you're going to live with more volatility. You're going to live with lower returns. And there's going to be a lot more uncertainty in the markets.
How are your clients positioned overall now that we've had this tremendous run up from the March lows last year, 1 year ago to the week, and a bit of a pullback here on fear of rising rates? How would you say they're positioned?
Well, I think the advice we gave along the way to all our clients was, one, as we saw the massive volatility back in March of last year, was to stay the course, right? It's about keeping a long-term view. Then as the market started moving, we said it's time to rebalance. It's time to kind of look and drive diversification across your portfolio. But the two big things we pushed with our clients was something we were already pushing in January, which was it's about yield. What are the different ways you can go out and increase yield in your portfolio? What's the type of dynamics in the diversification you can get? Alternatives, right, as a source of bringing in and bringing down that volatility profile, but increasing your income profile. So it's been about staying the long course and being truly diversified in your portfolio.
Jose Minaya, thank you for joining us.
Thank you for having me.
We appreciate it. Lennar earnings just out. Diana Olick with the numbers. Diana.
That's right. Lennar is reporting blowout first quarter earnings of $1 billion or $3.20 a share. Now, while Lennar's core earnings are quite strong, the company's huge quarterly gain is from its investment in Opendoor, one of the original iBuyers. These companies give you cash for your home so you don't have to go through the selling process. They then fix them up and flip them for a profit. Now, Opendoor was acquired late last year and taken public via SPAC specifically. And I spoke to Chairman Stuart Miller, who told me that while the profit is sizable, what's more important to us is that these tech investments are all about taking a company that has been in business for a lot of years and modernizing it, keeping it in touch with where the world is going. Now, revenue did come in at $5.3 billion versus estimates of $5.131 billion. New orders up 26%. But again, it's that Opendoor SPAC that gave us the big numbers this quarter. Back to you guys.
Diana, thank you. Diana Olick. It's been called the drizzly of marijuana. Coming up, the CEO of Dutchie on the demand for pot delivery and the big name investors like Howard Schultz and Tiger Global that are betting on this company's growth. And as we head to break, here's a look at the big winners and losers in the Dow today, which did close lower, breaking a 7-day win streak.
Time for a CNBC News Update. Rahel Solomon has it for us. Hey, Rahel.
Hi, Wolf. Hello, everyone. Here is your CNBC News Update at this hour. President Biden is meeting with small business owners in Pennsylvania to promote his stimulus package. He promised more help for small firms who were shut out of earlier pandemic relief plans. Kansas Senate Majority Leader Gene Suellentrop has been arrested for driving under the influence, speeding, and fleeing an officer. Police say he was driving the wrong way on a highway in Topeka. He has since been released. Alaska's GOP reportedly does not want Senator Lisa Murkowski to run for re-election as a Republican next year. Alaska Republicans censured Murkowski for voting to convict former President Trump at his impeachment trial and have said that they will seek someone to challenge her for the Republican nomination. And this is a pretty cool sight. Take a look at this. In Japan, a bullet train put on a light show there to mark the anniversary of a line that runs through the southwest part of the country. The aptly named Shooting Star bullet train was seen by thousands along a route that runs for more than 150 miles. Pretty cool. Guys, I'll send it back to you.
All right, Rahel, thank you. Rahel Solomon. Up next, e-commerce platform Dutchie raising $200 million in its latest round of funding, valuing it at $1.7 billion as the company pushes to bring marijuana mainstream. It's now got a brand new valuation, and we're going to talk all about it with the CEO right after the break. Silicon Valley not passing on the Dutchie. The cannabis e-commerce platform Dutchie raising $200 million in a Series C round, putting the 4-year-old company at a $1.7 billion valuation. The company also announcing the acquisitions of Greenbits and LeafLogix. Joining us now is Ross Lipson. He's the CEO and co-founder of Dutchie. Ross, 8 times the valuation that you got just last August. How did that happen?
Yeah, thanks for having me. It's great to be here. So Dutchie is an all-in-one technology platform powering the dispensary's operations while providing consumers with safe and easy access to cannabis. And it's a great time to be a part of this industry. It's an explosive industry. The pandemic really accelerated this industry, and Dutchie's always set lofty goals and have been a very ambitious company, and we're happy to exceed those expectations.
You've attracted Howard Schultz in previous rounds, Kevin Durant, Snoop Dogg, lot of famous investors in your company. So is the goal here to be like a Grubhub or an Uber Eats for marijuana? Yeah, it's a similar business model. We're streamlining the operations for dispensaries and bringing an omni-channel solution to the consumers. Really, it's important, especially this day and age, to meet the consumer where they feel most comfortable. So they have the ability to order online from the comfort of their own home for delivery or pickup, or consumers can choose to go into a local.
What a world we live in, right? I mean, this guy literally is a billion-dollar completely legal drug dealer or drug transporter. Maybe not dealer, transporter. That's just hilarious. But, I mean, good for him.
And delivery is a trend
I'm not against what he's doing. Good for him.
Industry, but in industries across all sectors. And it's a very convenient way to order, but also having local brick and mortar.
But at the same time, does he or does he not look like McLovin? Like if McLovin on Superbad blew up, and he's like 32 now. That's this guy. Come on, you gotta admit that. And it character-wise makes sense too. Federal law, it's still illegal in this country, marijuana. Obviously, states are changing that, but big banks aren't touching it. So how do you navigate that?
Yeah, so it's a very fragmented and nascent industry, and fortunately, there's a lot of regulatory tailwinds behind the industry. I think the world is waking up to the positive societal changes cannabis and this industry as a whole is bringing to the world. And with that, regulations are allowing for, there's a lot of movement on the regulation front. So we're excited to see acts like the Safe Banking Act passed in the coming year, which will allow payment processing and this industry to normalize like other industries.
We've seen a lot of competition, a lot of players in this space, and their stocks have been volatile, but pretty strong. Do you see yourself as sort of agnostic as to the manufacturer, to the brand, because of your sort of shape of your business, and therefore kind of able to just ride the broadly positive theme in this sector and not be involved in the competition so much?
Yeah, so Dutchie really stands for the industry, and we're here to be the backbone and the infrastructure that powers the industry and allows the industry to move forward. And again, really normalizing this industry. I previously came from the online food ordering space, and I'm bringing a lot of those learnings and that education onto this space. So, we're excited. We're here for the industry, and as the industry rises, Dutchie will be there to support it.
In that industry, the restaurants end up having to pay big fees for those delivery services, and the consumer also has to pay big fees. Have you learned from that model? Is it different when dealing in the pot industry?
Yeah, so our true north metric here is to provide value to the dispensaries and consumers, and we'll always make sure our business model supports their economic piece of the puzzle there. So, the industry is in its infancy. It's got a long way to go. It's evolving and changing very fast, and we'll always look to provide value to the industry as a whole.
And finally, Ross, tell us about these acquisitions and the latest fundraising.
Yeah, so we're excited today to announce the close of our Series C. We brought in $200 million led by Tiger Global, with participation from DFJ Growth and Dragoneer Investment Group. Phenomenal investors to bring in to the cannabis space, and really a landmark deal and a testament to this industry. And again, the positive change it's bringing to the world. We're also announcing the acquisitions of LeafLogix and Greenbits, two leading point of sale and enterprise resource planning tools for the cannabis space. We'll be combining all three of these companies together to create an all-in-one technology platform that really streamlines the operations for the dispensaries and ultimately makes this industry more successful.
Ross, thanks for joining us.
Thanks for having me.
Still ahead, green across the screen, we just got numbers from CrowdStrike and Lennar. What's driving those stocks higher? After hours coming next. 7% movers there, Lennar up 2%. Plus more from my interview with Palantir CEO Alex Karp, his take on the defense race and the United States military power when Closing Bell comes back.
I am interested to see what CrowdStrike did. I did not notice they were posting their their earnings today, and I do have a little bit of stock in them, and they are up. Very nice. Very, very nice. Not bad. Shot up from a low of 193 before closing. Looks like it closed right at about 196, and it shot up to 211. So good for CrowdStrike. CrowdStrike's one of those that are kind of under the radar. If I could go back a year though, weren't they on about 100 not that long ago? Yeah, I mean a year ago they were $31. Now they're 200. Had a high of 251. So I mean I've bought and sold CrowdStrike a few times over the past year. I think the last time I sold it, it was like 180, maybe 190 when it was the last time I had a huge spike. That looks like that was like late 2020, like December maybe. So it's definitely been up and down. It looks like it took a huge hit a couple weeks ago, like pretty much every tech stock did. But goodness, I mean, 1 year it's got 7x gains. So definitely a good one to be a part of for the long term. And it's good to see their results coming in positive today. Lennar, I don't own them, but it does not surprise me that almost every volume home builder is looking positive right now. They are just selling like hotcakes. The question really is, how sustainable is that? Is that going to be a sustainable trend for the long term, or when inventory sort of comes back, hopefully, I'll again knock on wood, hopefully comes back to normal in the next 6 months, once it's safe to put your house on the market and have strangers come through it, then we'll see. I think people will then be more inclined to buying a pre-owned house. But right now, the industry with little on the market, still a high demand for people wanting to move right now, especially out of urban centers, and also the pressure from Opendoor, Zillow, and these types of companies that are buying houses off market. On market houses are just going for astronomical prices, and that's also translating to new home builds. So let's see what they say.
Lines, those shares moving higher. CEO on Mad Money. Coupa Software spiking after topping estimates across the board. That stock up more than 7%, issuing strong full-year guidance as well. And homebuilder Lennar reporting a big earnings beat. The company saying the Opendoor IPO helped boost its results. New orders, Wilfred, up 26%. Good gauge of future activity, and that was a beat.
Yeah, some nice movers there. Palantir finishing the day down around 4%. Earlier, I caught up with the CEO, Alex Karp, in a rare interview and got his take on the defense space. And we've got more of those comments coming up next.
All right, guys, we're going to use this opportunity to sign off. We're about 4 o'clock. That was about the shortest break in between commercials I've ever seen. So I was going to wait till the next commercial break, but if they did one that short, then the next one might be really long. So we're going to go ahead and sign off. It's near 4 o'clock Central Time, 5 o'clock Eastern. So didn't get a whole lot of aftermarket movement from FTCV. I'm going to hang on to it. It might get some legs tomorrow. Sometimes on day 2 after an IPO or a SPAC news conference or SPAC, what do you want to call it? Announcement? I don't know. It gets some legs and goes up. So hopefully it will. I'll hang on to this stock at least through tomorrow to see what happens. If it goes down, so be it. I'm up 20%, so I'm not that worried. It's down a little bit after market from 15.29 down to 14.88, but I'm not that worried. But overall, down day for these guys. GameStop, AMC, Express. I like to see the GameStop make at least a little bit of an attempt to come back. Didn't really do it though, and cost was down as well. So overall, very sideways day, a little bit down, even though the NASDAQ did finally end positively, but just barely. And then the Dow and S&P were both negative. So overall, a slightly negative, mostly sideways day today. Hopefully we'll have some more action tomorrow. But until then, adios.